I'm fine. This is Ria from Samaya, and today we are going to discuss about audit of banks. Okay, why do there is a special kind of chapter only for banks? Why can't this the standards of accounting would suffice the audit of banks? Because banks were in a very competitive environment, and they have a regulatory framework which is aligned with international best practices. Why like that? Because banks have more of forex transactions and it involves various kinds of people all around the world, and it also have branches all around the world. So it has to meet those international standards also. That is why, since they have a very kind of public money involved as they accept public deposits. So mostly the regulations also very high. So because of that, we require some special considerations for the banks to audit. Now I'll see what are all the bank characteristics. You see, these kind of words you cannot memorize it and retain for a longer period of time unless it's a direct question or any kind of dates or due dates like that. How could you manage to write answers in examination with regards to such kind of questions? Were you see what we think of banks? When we think of banks, we think of their transactions, banking transactions, and how those banking transactions have been conducted nowadays through internet banking, GPay, PhonePay, QR codes, etc. Right? That is what involvement of IT. Because there's a lot of public money involved, there's also so much of regulators have been stringent regulations have been there so that the bank should comply with that. So with regards to these three things, we'll write whole any question from the bank with regards to these three topics like transactions, IT, and regulatory. And because how about the large volumes of transactions? What do banks have? Banks have transactions which are of large volume. Transactions initiated in one location and managed at another location, like checks, demand drafts, etc. Direct initiation of transactions by customers, like ATM transactions. Significant commitments with off balance sheet items like bank guarantees or letter of credits. Integration and linkage of national and international systems like Nostro accounts. And regulatory requirements often influence accounting and auditing practices. For every question in bank, what you have to write like just a gray area. You have to write for everything about its regulators, because there's so much of public money involved. Whenever there was any answer or any question that was asked in banks, mostly they asked about the regulatories. You have to at least mention at least a point with regards to regulatories. And with regards to banking transaction, what we have discussed, large volume of transactions initiated in one location and managed at another, direct initiation of transactions. These are all with regards to transactions and significant commitments of off-balance sheet items. These are also transactions. Integration and linkage of national and international systems. Regulatory requirements often influence the accounting and auditing practices about the regulatory requirements. What are the special audit considerations we have to take with regards to banks? That's what the purpose of this bank audit chapter. Particular nature of risk associated with the transactions, obviously, the risk with regards to the transactions, scale of banking operation, as we have already seen, there were large volume of transactions for a bank. So there was a large scale of banking operations, so the exposure was so high in a very short term period, like call monies, etc. And continuity development of new products and services. A wide range of loans or schemes or debit cards or new plans, credit cards were often released by banks to meet the competitive environment here, because banks have a very competitive environment. Extensive dependence on IT to process transactions. Obviously, what we have discussed, net banking, ATMs, these are also kind of IT. Statutory and regulatory requirements. See, this is comes every time. Regulatory requirements. What are the special considerations with regard to transactions? Because transactions risk and the scale of transaction and its products and services have newly introduced. They develop new products often, and an extensive dependence on IT and regulatory requirements. Everything revolves around transactions, IT, and regulatories. And they have been talking so much about regulatory authorities. What are the acts under which banks get governed? These were all the banks. You see, you need not remember anything. This is just like for your information. Nobody asked these list out all the acts that were governed by the banks, that banks get governed by. You just give it a one time go, and before the examination, if at all they ask whether this act governs the banks or not in an MCQ for a mark or two, you could easily write that. We'll just we'll just read it one time, and we'll go to next topic. Banking Regulation Act 1949, State Bank of India 1955, RBI Act 1934, Companies Act, Banking Companies Acquisition and Transfer of Undertakings Act 1970, RRBs Act 1976, Banking Companies Acquisition and Transfer of Undertakings Act 1980, Information Technology Act 2000, PMLA Act 2002, SURFACE Act 2002, Credit Information Companies Regulation Act 2005, Payment and Settlement Systems 2007, Cooperative Societies Act 1912 of Cooperative Banks. That's it. And financial statements of banks. What kind of forms that in which forms do the bank should prepare their balance sheet in? Form A, balance sheet. Form B, P&L account. You see, Form B and balance sheet were in a crisscross manner like this. It's so simple so that we don't get confused in examination. So think of like this. This is B, okay, of the third schedule of Banking Regulation Act 1949. Okay, who is the authority appointing the auditor? As we auditors, who appoints us? For a banking company, it is appointed by AGM. Sorry, it is appointed in AGM by shareholders. Before that appointment, we have to take prior approval of RBI. For a nationalized bank, board of directors appoint us. But before such appointment, we should take the prior approval. No, we banks should take the prior approval of RBI. For SBI and RRBs, C&AG and concerned banks gives the appointment. They have to take prior approval of central government. Why for SBI we have to take prior approval of central government is because that it's a public sector undertaking, right? That's why C&AG appoints the auditor in the, with prior approval of central government. For any banks, RBI is the most the regulatory authority we have to take prior approval for, because it's a public sector undertaking. Even RBI's RRBs. For RRBs, the concerned bank appoints with prior approval of central government. They need not go for the RBI. All small banks and banks that were having a share of central government takes prior approval of central government. All other banks, any banking company or national bank, takes the prior approval of RBI. That's it. And now we'll see what's a bank audit process. For the first stage, we'll have to talk about the initial considerations. When we think of initial considerations, what should come in our mind is SA 200 series, all the 200 series, with regards to prior to the acceptance of and continuance of the audit engagement, what the auditor should consider. The assessment of engagement risk, which affects the decision of acceptance and continuance of audit. Yes, as per SA 210, agree to the terms of engagement in engagement letter to prevent any confusion. Assignment of qualified and experienced professionals for managing engagement risk. You see, all this comes in SA 200 series, right? All 200, 210, 220. Assessment of engagement risk. What do we have to? We have to check whether we should accept or continue the engagement or not. That's the first point. And as per SA 210, we have to agree to the terms of engagement. And later on, we have to check for our competence, right? We have to check for our competence. Assignment of qualified and experienced professionals for managing the engagement risk. And RBI decided that this is a normal kind of regulation that internal auditors cannot be appointed as a statutory auditors. This is what they have said. RBI decided that the audit firms associated with the internal assignments in the bank during the same year should not undertake the statutory assignments. Communicate with previous auditor. There's also SA 200 series, we have learned that bank should obtain declaration of indebtedness from auditor. These two were some special points with regard to RBI. Others were with regards to SA 200 series only. They have to take declaration of indebtedness. The auditor should not take loan from the bank. That's what the condition is. After that, the stage 2, it's about understanding. When you think of understanding, what comes in our mind? I said 300 series. Understanding the business environment, including its internal controls, right? The same thing is applied here. Understanding bank's environment, including its internal control, what it does to it enables the auditor to identify and assess the risk and develop an audit plan. Obviously, understand why do we have to understand bank's accounting process? Because what accounting process does, accounting process produces financial and operational information. What we went for, we auditors went to check the financial statements, so we have to go through how the financial statements have been prepared, and this accounting process contributes to internal controls also. And why we have to check for, why we have to understand the bank's accounting process is to identify and assess the risk of material misstatement, whether due to fraud or error, and to design and perform further audit procedures. Understanding bank's risk management process. Why we have to check for risk management process that were in our entity? Because we have also gone to check the internal controls, right? We have to also provide a letter of weakness with regards to internal controls. Now we'll see how the risk management process was within the Indian entity. First, we have oversight by TCWG. Why do we need to understand the risk management process? Because we have to also check for the internal controls. Because we have to give letter of deficiency, matter of weakness, right? So that's why we have to check whether what the risk management policies that were given by TCWG, what the TCWG do. It approves the risk management policies that are consistent with bank's objectives, strategies, and regulatory requirements, and the type and amount of risk that is acceptable. Okay. Do we need to remember all the things that were in the brackets? No. But just give it a go. Just one day before the exam, read it one time, and you could write it easily. But all they ask, it's not so much important. And what's the second thing? What after the implementation of policies, what do? They identify and measure and monitor the risk against the pre-approved limits and criteria. Pre-approved limits and criteria were in risk management process. In entity, they have to identify the risk. Okay, what's the golden rule after any kind of identification of any irregularities or risk? What we have to do? We have to put some remedial. We have to give some remedial measures, and after giving remedial measures, we have to do follow up or checking those remedial actions whether they were consistently applied or not. Okay. After identification of risk, what are they doing? They are doing control activities like segregation of duties, verification and approval of transactions, reconciliation, fiscal security, and contingent planning, like that. And after that, what do they have to? They have to monitor. Monitoring activities like risk management models, methodologies, assumptions means they are putting some systems or models in order to follow up the process conducted by independent risk management unit. Okay, after that, reliable information system. What's the output? We need to, what do we want? We want a reliable information to prepare the financial statements, financial and operational information on a timely and consistent basis, and that's it with regards to risk management process. Oversight by TCWG, that is approval of risk management policies, identification, measurement, and monitoring of risk, and control activities, monitoring activities, and reliable information system. That's it. Now we are moving on to the third stage of our bank audit process, that is risk assessment. Again, 300 series. What the risk assessment is mostly talking about, the risk of material misstatements, fraud, IT, and outsourcing. This outsourcing is something you have to write in the third stage. Even if you don't remember this, no problem. Write the first stage, you're good to go. Identifying and assessing the risk of material misstatement as per SA 315, and assessing the risk of fraud, including money laundering, SA 240. Okay, there were so much of standards that were going on, right? We are also have a PDF that was in our Telegram, and we also launched a PDF where all the standards that were prepared as per auditing pronouncement. As most of us don't read the auditing pronouncement, even I does when I was in studying like you. And one of my friends suggested me that auditing pronouncement is the only book that separates the rankers and the passed out. So I just highlighted that and read all the auditing pronouncements, and then I prepared that for the exam. And I wanted to make it like a book and also make it available to you too. And if you want to buy and have a colorful notes, you could buy it from the link was in our about section. And if you don't have that much time to wait for the book to come, you could also take a printout of the book or PDF that was already available in Telegram. Do check it out. I think it would be very helpful for you. And it has not skipped any single point that was relevant for the exam, and it was not included any single point that was irrelevant for the exam. And with that said, we'll just continue our risk assessment process. Here's what we have to do. As they are saying about risk assessment, we have to talk about the risk of identifying assessing the risk of material misstatement as per SA 315. Assessing the risk of fraud, including money laundering, SA 240. Why money laundering they have included? We have seen here, right? Even money laundering, PMLA Act was also governs the audit of governs banks. As a specified risk of financial statement level of banking industry and often use of IT. They're talking about again IT here, and risk associated with outsourcing activity. 315, 240, and as a specified risk at financial statement level and a risk with regards to IT. That's it. And this is all the stage 3, which is so simple if you think of 300 series. And 4 is execution, which is most important part. That is engagement team discussions. You see, whenever there's an execution that was going on, you have to talk about mostly with regards to, let's say, 500 series. 500 is mostly with regards to during the audit process, like engagement team discussions that we have during the audit. Response to the assessed risk after identifying the engagement risk that was happening in 200 series and all, and 300 series is about the planning that is just before the audit. And what do we do after having that risk that were identified? We respond to that. I say 330. And overall audit strategy involves key engagement team members and overall audit planning memorandum, audit materiality, consider going concern. You see, these were all like 300 series, and this is all talking about the audit strategy, audit plan, and audit materiality concept. These two comes in a category wise. When you remember something in a category wise, it's easier to remember. And going concern is 500 series, and we are talking about stage 5 audit reports. You could go and refer what all you remember in SC 700 series. Like think of, you see, mostly these were asked not in a direct question, in a situation based question. You could just refer to that and write, okay, this is most persuasive evidence, and it has more of risk of material misstatement, and there was a disclaimer of opinion should be given, no sufficient and appropriate audit evidence have been obtained, and you could write anything else you remember, and that's it with that. And we have audit planning memorandum here, right? We'll see the definition of audit planning memorandum here. It's a summary of audit plan. Okay. It since memo is a short form, right? We are talking about audit plan. It's a memo. That is it's in the question. It's in the title only itself. It is a summary of audit plan. Okay. To describe the expected scope and audit procedures. It's describing the audit plan now. It's talking about the scope and audit procedures that have to be performed to highlight all significant issues and risk. Why memo? Why there should be a short form for the scope and audit procedure? It highlights all the significant issues and risk to provide evidence that planned the audit engagement appropriately. They're talking about the benefits of such audit planning memorandum is that it provides evidence. Obviously, it provides evidence for that audit engagement was planned appropriately and responded to engagement persuasive and specified risk. That's it. This is what definition of audit planning memorandum. And what are the special considerations for IT environment? Not only with regards to bank, if you get in IT risk in automated environment or 2-3 times in audit, in our audit syllabus it repeats. So you could write these points only whenever you remember only one question and repeat that and try to personalize that. If they are asking about something in an automated environment, you could do some customization over there and use that specific words. That's it, nothing much over that. We'll also discuss how to write audit answers in examination by reading minimal content. And that's what smart revision also called. And okay, here are the special considerations for IT environment. We are talking about categories, right? Categories of IT, bank or transactions, or bank transactions contain some data, and the bank's transaction, how they are performed with use of IT. And we have reports and controls over here. We'll see what are the special considerations in IT environment. Overall IT policy structure and its environment, accounting manual and critical accounting entries, their process and involvement of IT, process of general information to disclosures in financial statement and involvement of IT. This all about IT. Since as we have discussed here, right, in risk management process, there are about the risk management policies, right? Here also, with regards to IT environment, they're talking about the IT policy, IT structure, and its environment. And accounting manual, whenever you go for a bank audit, you will get a manual, right, for the bank managers to comply with few kind of certain regulations, or like how to do what and how to do what. Uh, and they're talking about that, and about the critical entries, accounting entries, and the process of generating information to disclosures in financial statements and involvement of IT systems. And with regards to data, data processing and data interface, data integrity, and data security. Data processing is like how a general entry was traveling through P&L account, trail balance, and balance sheet, and data interfaces like a format of report, how the data is being shown, tables, charts, or likewise. Data integrity is like it is not contradictory. One data set is not contradictory with the another. They were integrated together. And data security, obviously, when it is maintained in a IT environment, and like a lot of data security has to be in place. And with regards to reports, MIS reports, MIS reports generation and that periodicity. That's what we chartered accountants do when we go for our industry. We do mostly MIS reports, unless we go for a big four. Major exception reports, including embedded logic. Most of us in our bank audit had checked for the exception reports. And with regards to controls, business continuing plans and disaster control plans. Control over account heads, expense booking, and overdue identification. And controls on recording products and channels of e-banking and internet banking. They're talking about the internet controls here. We are talking about the going concern concept, and here about the whether the management had some significant influence which they are using for undue purposes. They're talking about this controls over all the accounting trade or expense booking or overdue identification, not overdue identification, but they have specially mentioned it because it helps it helps in window dressing of the banking financial statements with regards to NPAs, etc. Controls on recording products and channels of e-banking and internet banking. And with regards to that, and moving on to next topic, key security controls that the auditor need to address in a computerized bank audit. What security we have to talk about? We have already discussed that for data we have to need data security, and with regards to that, in addition to that, human security is also there. That is, involvement more of human could lead to some irregularities in internal control system. Internal control system might not be that efficient. We'll see how it could be. Processing authorized, accurate, and complete data. You see, the data has to be first, it has to be authorized, and it has to be accurate, and all the data has to be processed. That is, the complete data has to be processed. And in case of power or processing failures, the system has to resort without distorting the completion of entries and records. And the system prevent unauthorized amendments to the programs. This is all with regards to data. It's mostly about the processing of the data, and the system has to restart, and there has to be no unauthorized changes to the programs. And with regards to human, verify that changes made are in parameters are authenticated. That is, they have to be the changes have to be made by the designate persons only who have authorized. Verify that segregation of duties ensured while granting system access. We have seen some segregation of duties somewhere here, right? With regards to control activities, segregation of duties to reduce the risk in management risk assessment, risk management process. And verify all account master and balance can't be amended except authorized personnel. They're talking about the authentication of the person and the data. With regards to the data, it is only the authorized personnel have to amend the programs here, and all the account masters, etc. here. and the segregation of duties over granting system access. And all the security controls were here with regards to data plus human here. And we'll move on to the next topic, that is Central Audit and Inspection Department in banks. It is headed by Chief Audit Executive. It's RBIA, that is Risk-Based Internal Audit, stipulated by RBI. We have often seen that there was a HO inspection that happens in branches, right? They're mostly talking about that, and identifies branch for revenue audit, appoints concurrent auditors and review works of concurrent auditors. It's mostly like an audit committee for audit committees with regards to the company. Here, in kind of bank, it is Central Audit and Inspection Department, stipulate as per RBI, which was headed by the Chief Audit Executive. And what does it do? What functions it have? It has to undertake risk-based internal audit for what? It has to identify branches for the revenue audit and appoints concurrent auditors and review the work of concurrent auditors. Obviously, we have to review the work, those who who gets appointed by us, right? Concurrent auditors we appoint and review the work of the concurrent auditors. With regards to concurrent auditors, what we have to do? You need not remember this. There's a separate section for concurrent auditors also, but just remember simply determine the scope. That's what we do, obviously. Meetings with the concurrent auditors and discussing the issues and training. This is simply any kind of regulations or any kind of duties that anyone who appoints an auditor should perform. What do they have to check? They have to check for the scope, and they have to give meeting. They have to attend the meetings, or they have to meet with the concurrent auditors, and they have to discuss the issues and training. And now we'll see in detail what is risk-based internal auditor. It's identification of inherent business risk, assessment of level and direction of various risk areas, and overall business and control risk, assessment of effectiveness of control, and drawing risk matrix. You see, first, anything that's related to risk, what we have to do? We have to identify that risk. What risk? Inherent business risk. Okay. Then what do we have to assess? Assess the level and direction of. We have to assess the risk, right? What risk, in what matters or what parameters, the level and direction of various risk areas, okay, and overall business and control risk, okay. You see, here this mostly talking about inherent business risk, right? That's why they have concentrated on the level and direction of business and control risk. Assessment of effectiveness of controls, okay. And controls were something like control activities. Since we have identified risk here, what we have to do? We have to put a remedial actions. What are the remedial actions? The control activities. We have to check for the effectiveness of those controls. And we have to draw the risk matrix. That's a tabular form of diagram, and that's it with risk-based internal auditor. Now we'll see few examples of internal controls in categories wise. We'll see what are a few general internal controls that could put in place in a bank. So the staff and officers should be shifted from one position to the another without a prior notice. Shifting of the staffs and officers from, like, cashier is shifted often, right, for every 1 to 2 months, and work of one should be checked by the another, obviously. And all bank forms, for it has to be under custody of two officers. For the first officer, it has to have the possession, and the second officer, what he has to do, he has to verify the issuance and the stock of the all bank forms. First one consists of all the possession of bank forms. Second one should verify all the issuance and all the verify the stock that was there in the bank, all with regards to the bank forms. And the mail should be opened by the responsible officer. And a HO should give a surprise inspection for the branches and all the financial, what extent the bank manager could give the loan, or how much amount of money they could hold in the bank chest. And with regards to the cash, internal controls with regards to cash is that cash should be joint custody, and the cashier should have no access to customer ledger and daybook because he could manipulate the accounts. And receipt or payment scrolls compared with the cash column of daybook by independent person. That is like mostly the concurrent auditors or the internal auditors. They have to compare the cash column of the daybook with regards to receipt and payment scrolls. And the high value cash receipts and payments by bank manager remit excess of branch retention limit to currency chest. when there were high value cash receipts or payments by any branch manager, you have to remit that excess for the branch retention limit. Every bank branch has some retention limit, right? In excess of that cash, they have to send it to the HO currency chest. And the counterfoil of cash receipt vouchers should be signed by the officer in cash department and the receiving cashier. It has to be signed by the cashier and officer in the cash department. And with regards to clearings were mostly like a check or a e-check that was submitted to the bank for payment or under the check truncation system by RBI. This was a system which was stipulated by RBI with regards to clearings. And electric image of check, that is e-check, that is transmitted to paying branch through a clearing house. That channel from paying branch to receiving branch, the channel is known as clearing house. It's mostly like a Razorpay or Instomojo in our e-payments, right? That's the delivery channel. That's a clearing system delivery channel. And what should it consist of? We have to write about the details of the customer, and the bank has to be given in that e-check with details of MICR bank and date of presentation and presenting bank. Check the signature of the drawer. If not, liability would be on the paying bank. If the bank do not, the paying bank do not have the proper signature of the drawer, the liability would be shifted to the paying bank itself. As per RBI guidelines, bank should call or email if the amount is more than 5 lakhs or inward earnings. Then the officer in the cash department or payments department has to call or email. That is for extra confirmation if the amount is more than 5 lakhs or more. 5 lakhs or more. 5 lakhs is included. If it touches 5 lakhs, they have to give a call or a mail. Unpaid checks in outward clearing sent to the customers. Okay. These are with regards to the internal controls of the clearing. What? Under check truncation system by RBI, there should be an electronic image of check transmitted from paying bank to the clearing house. Through a clearing house, they have to mail. What all it should contain? It should contain details of customers and bank. What the customer details? You have to have the details of MICR bank, that is a barcode like, and date of presentation and the presenting bank details. And the with regards to customer, that signature details of the signature. The presenting bank, the paying bank do not check the signature of the drawer, that liability would be on the paying bank. If that amount is 5 lakhs or more, the bank has to give a call or a mail, and unpaid checks in outward clearing sent to the customer. And with regards to bills for collection, all the documents accompanying the bills received are entered in a register, and at the time of dispatch, all such documents should be sent by the responsible officers. All documents accompanying the bills received, that was the money that was received for the bills sent for collection, have to be entered in a register, and the time of dispatch, as we have got our money back, we have to give all such documents. Who has to give? Responsible officer has to give. The customer account is credited only after bills were collected or sent for collection. Okay. And bills sent from one branch to the another, the receiving branch should reverse the entries for the purpose of amalgamation at the end of the year. That is, not to duplicate the entries while in case of amalgamation. So this is with regards to the internal controls of bills for collection. And for the bills purchase, officer should verify that all documents are properly assigned to the bank, that is in favor of the bank, and all the documents have been given. And the sufficient margin should be kept by whom? The manager. How much money he has to give by putting a sufficient margin to the bank for any decline in value of security. If the bills purchased are outstanding for the year end, the discount received shall be apportioned for 2 years. That is, if the bills purchase have a outstanding for the 31st March, what they have to do? 31st March falls in between, so the discount should be apportioned. And if the bank is unable to collect bill on due date, immediate steps has to be taken to recover that. Okay. All the irregular outstanding accounts have to be reported to HO. And these were all the internal controls with regards to bills purchase. What we have to do? We have to say, check for that all the documents of title have to be properly assigned and sufficient margin has put. And discount, it should be apportioned. And if unable to collect, what I have to take? They have to take immediate steps for the recovery, like factoring or something other remedial actions for recovery of that bill. And all the irregular outstanding should be reported to HO. And with regards to the internal controls of loans and advances, prior to making advance, prior to giving advances, what they have to do, what the bank manager has to do, what the officer should do, have to check the credit worthiness of the borrower. He have to check whether the sanctioning limit was within his authority or not. That is, within the powers of the bank manager or not. If they wanted for more than 5 CR and all, HO has to handle that. So have to check whether Who has to sanction that? Sanction from proper authorities. And documents executed by the borrowers, whether they were legit or not. These have to be checked prior to making an advance. And sufficient margin should be kept to cover any decline in value of securities, while giving any kind of loans. And with regards to securities, securities should be of joint custody, likewise in cash. And it should be registered in the name of the bank. These securities, like any other property, has to be registered in the name of the bank. All accounts should be kept within. They're talking mostly about the overdrafts here. All the overdrafts accounts should be kept within drawing power and sanction limit. For the drawing power, additional 20% could be given as a temporary enhancement, temporary limit for a period of 90 days. Please remember this, it could be attached in an MCQ format. And this operation shall be reviewed once in every year. That they have to check, follow up, or monitor these controls at least once in every year. And with regards to the DDs, demand drafts, internal controls have to be the officer having signature book shall verify signatures on DD. Likewise, in e-check, they have to check the signature of the drawer, right? They have to also check the signature here. All DDs issued should be informed by paying branch by an advice. Advice is a kind of like a letter or type of information that was used mostly in banking systems. If the This is a kind of format of communication between bank branches. If paying branch do not receive proper information or do not receive credit, it should take immediate step. That is, it had not received the amount of the money that it has to receive. What it has for the recovery, it has to take immediate steps by communicating. And with regards to inter-branch accounts, the account should be adjusted on advices. That is, proper communications received, not on strengths of the entries received. That is, not on the entries that were received. What they have to do, only for the advices received, they have to adjust that. Adjusting is mostly like a reversing, not to duplicate the entries in amalgamation time, etc. And central authority should take prompt action if any entries are not responded by any branch. That's a gray area. And with regards to credit card operations, which is Asia's favorite question, credit card operations were so they have a lot of individual points, but it's so simple if we read it like this. With regards to customers and with regards to merchants. Customers, they have two categories. Payments, about customer payments, few internal controls. About customer balance or customer overdue, few internal controls. And with regards to merchant, this is mostly like a process kind of thing. Merchant, they have to check the limit and acceptance, reimbursement, periodic bulletins. Remember this as a category, and you are so easy to go to write the credit card operations fully, and you get on points. A system to monitor and follow up customer payments. A system or an internal control system to monitor and follow up customer payments. A payment overdue beyond a reasonable period shall be identified and attended carefully. That is, customer overdue should be identified and attended carefully. A system to send statements regularly and promptly to customers. That is, about the customer balance, you have to send statements regularly and promptly to the customers. And with regards to merchants, a system where merchant confirms the status of unutilized limit of credit card holder. That is unutilized. That is still what balance that the credit card holder can do the payment for. System to prompt reporting by merchants of all settlements accepted by them through credit cards. That is a statement that all the payments that they have received with regards to credit card transactions. A reimbursement to merchants after verification of validity of merchants' acceptance of cards. Not only the acceptance of credit card holder that the merchant checks, but while payment, bank also checks the merchant's validity in accepting the cards. After that, merchants get their amount credited. Credit for defaulting customers is stopped by issuing their details in periodic bulletins to merchants. In addition to that, in addition to the reporting of the transactions that all settlements accepted by credit cards to merchants, they also give periodic bulletins with regards to defaulted customers, to stop the issue. And in addition to all these three kind of categories, there were extra 2 points. That is, effective screening of applications with reasonable good credit assessment. Credit cards were mostly like a loan, right? A small kind of loan. So while giving loan, what we should check? We should check for the credit worthiness. They're talking about that. And the strict control on storage and issue of credit cards have to be given. And these were all the credit card operations, internal controls with regards to credit card operations. That's so simple. Now we'll move on to the next topic, that is CRR and SLR. This is a quite important topic. It gets more often questions that were asked in bank audit. CRR is cash reserve ratio. What is cash reserve ratio? A minimum fraction of total deposits of customers, that is bank's customers deposit some money, right? A part of that money has hold as a bank shall hold as a reserve in cash or deposits with central government. They should not give all the deposits as a loan to other customers. They have to hold a portion of that either with them or with central bank, that is RBI. And SLR, that is statutory liquidity ratio. Every scheduled commercial bank shall maintain in form of liquid assets like gold, cash, or government approved securities. Liquid assets means mostly like financial assets, approved securities before providing credit to customers. Here they have to hold it as a cash. That is CRR. Here in a liquid ratio, liquid assets, that is in gold or cash or approved securities. Likewise, and SLR compliance is verified by statutory central auditors on 12 audits, not on Fridays, and send report to top management and RBI. It's an RBI. Okay. What that report shall consist of? That report shall consist of correctness of completion of demand and time liabilities position and maintenance of liquid assets under Section 24 of Banking Regulation Act. Once again, SLR compliance is verified by whom? Statutory central auditors. They have to give a report to whom? Top management and RBI on what? 12 audits not being Fridays. Okay. And what that report shall consist of? It shall consist of correctness of completion of demand and time liabilities position and maintenance of liquid assets under Section 24 of Banking Regulation Act. And with that said, how do we audit the CRR and SLR? Again, we are categorized into three to four portions actually. Circulars and with regards to trade balance and consolidation and demand time liabilities. What are the exclusions and what are the inclusions? Exclusions with regards to few amounts have to be excluded while calculating demand DTL. And I will see. First, the circulars. Understand the circulars and instructions given by RBI and request the branch auditor to send weekly trail balance as on Friday. Here you see, the branch auditors should ask for trail balance as on Friday, but you have to check the SLR compliance or not on Fridays. Remember that. And these are consolidated at HO, okay? On test basis, examine the consolidation done by bank with respect to returns sent by branches. That is, branches send those returns, right? Trail balance reports that have to be consolidated by HO. What you have to do? You have to check on test basis the consolidation adjustments and that information that was relevant from all branches that is received. And auditor shall what? Describe the audit procedures performed in the report. Specify the unaudited branches. Develop audit procedures as ADF, that is automated data flow. And what are the exclusions for the demand time liabilities were? These were all the exclusions for demand time liabilities that were mostly the equity portion and mostly equity portion, the paid up share capital reserves and the P&L credit balance, and that is profit for the year or previous year, and a loan from bank, that's also credit balance, and a refinance from Exim, NHB, SIDB or NABARD. Any kind of, you need not by heart these things, any kind of refinance. Remember it as that, they do not test so in depth. Part amounts of recoveries from bad debts. You have to make a note of it. This is something really important. Part amount recoveries from bad debts. Amount received in rupees against import bills and held in sundry deposits pending receipts of final rates. This is a heading. If anything that was under this heading, when you receive rupees against that import bills and the amounts that were held under sundry deposits pending receipts for final rates, that is the final rate. We see that in IDT, the rate of import bills get fluctuated, right, with regards to few adjustments, few dates, that dates. Unadjusted balances like dividend warrants, interest warrants, and refund of application money, and margins like sundry deposits for funded facilities. Here, sundry deposits for funded facilities margins held, and here it's for sundry deposits pending receipts of final rates. That is with regards to custom bills. These were the exclusions. What are all the exclusions? All the equity portion, paid up share capital reserves, P&L account, and loans from RBI. This was loans, like a loan from RBI and refinance from Exim and HB, SIDB, NABARD. And these were something that will have to make a special interest to remember that. That is part amounts of recoveries from bad debts, amount received in rupees, not in other currencies, in rupees against import bills and held in these import bills which were held in sundry deposits pending receipts of final rates, and unadjusted balance of dividend warrants, interest warrants, and refund of application money. That's with regards to share capital, apportionment of profits, etc. And margins held as sundry deposits of funded facilities. This is funded facilities, not non-funded facilities. Make a note of it. And what are the inclusions in DTL were net credit balance in branch adjustment accounts, adverse balance in notes through mirror accounts, interest accrued but not accounted for. These were all the inclusions. That's it. And with regards to verification of assets, what we have to check for? We have done with all the internal controls. Now we'll move on to the verification of assets. First, with regards to the cash, banks, and money at call and short notice, what we have to check for? We have to check their existence and completeness on balance sheet. For the cash, physical verification of cash, including all types of cash, that is whether it would be cash in foreign currency or cash in ATM, cash at deposit machine, that is cash depositing machines. They also work like an ATM, but ATM is only for withdrawal. This is for to deposit our cash as close to balance sheet date. Cash balance physically verified should be equal to that. It should be tallied with the balance in CBS or cash register. CBS is a centralized banking system, core banking system. These are with regards to the cash. We have to check these points with regards to verification of cash. With verification of balance with RBI, what we have to check? We have to check the ledger balances to, that is the ledger balances of our system has to be confirmed with bank confirmation certificates and reconciliation statement. These were mostly like a third party certification, third party confirmations. Special attention in reconciliation statement. As with regards to any kind of balances with RBI or other banks, what we have to check? We have to check for the reconciliations. What that reconciliation should not contain. It should not contain what? Interest, and it should not contain any bank charges. We'll see now. A special attention in reconciliation statement with regards to cash transactions remain unresponded. That one. That is, no explanation was given. Items requiring write-offs or adjustments, just as we have discussed about the interest and bank charges, right? Credit entries from RBI statement or remaining unresponded for more than 15 days. These are all the items that we have to take special attention in reconciliation statement. And banks balance with other banks, what do we have to check for? We have to check no debit for the charges and no credit for the interest, and no large transaction at the year end for window dressing. That also has to be checked for. And no station checks sent for collection are credited subsequently. And these were the things that we have to check with regards to balance with other banks. And money at call or short notice, what we have to check? We have to check whether there's a proper system for authorization and compliance of guidance laid down by HO. You see, call loans to the call loans that were taken by the bank has to be tallied with what? Again, third party confirmation, the certificates by the borrower, and the call loan receipts held by the banks. You see, this is call loans when we give to the other banks, and this is when we take call loans. We have to check for that. These are call loan balances. And aggregate balance in the register should tally with the control account as per general ledger, the control account as per the general ledger. This aggregate balance with regards to the money at call or short notice has to be tallied with what? Control account as per general ledger. Subsequent repayment should be equal to the outstanding amount at the year end. That is, all the amount that was at the year end, outstanding at the year end, has to be subsequently repaid or subsequently got collected. And check if the interest was properly or accurately accrued. That is, anything with regards to loans or things, what we have to check? We have to check the credit worthiness. But money at call or short notice, that was mostly in between branches or in between banks, right? So we need not mention that point in specific. But what do we have to check is check the interest of that, promptly accrued or not. And with regards to investments, what we have to check? We have to check its existence, ownership, and valuation. We have to check whether there was existing investment policy, and investment policies conforms with RBI policies and statutory provisions. The investment policies of the bank should not override or be contradictory to the RBI policy or statutory provision. They have to be in conform with that. And outline of investment policy for its own account and on behalf of customers. You see, banks do investments on two purposes. One, with their own account. Second thing is that they do manage its customers also, customers' investment. So they need to have two investment policies, one for their own account and second one for on behalf of their customer. That's what we call PMS. Segregation of duties as executing trades for that front office, and settlement and monitoring of trades in the middle office, and accounting is mostly done by the back office. So this is just with regards to the duties in the investment department, and reconciliation of investment account with what the our investment account balance should get tallied with the securities on hand, and confirmations to the counterparty banks for bank BRs, that is bank receipts, and confirmation of subsidiary general ledger with public debt office. These all the things we have to get tallied for. In regards to acquisition or disposal of investment, it should be verified with respect to the broker's contract note. That is, when we do sale, brokers give a contract note at that one, and the bills of cost. When we purchase, the bills cost and the receipt. We have to check for that and verify the investments were made within authority and compliance of conditions that would restrict the right of ownership. What we have to do, we have to check whether the investments made were within the authority of that manager or that officer or not, and the compliance of that conditions that restrict the right of ownership, like stop selling, etc. And the classification of investments. Investments were classified as HTM, held till maturity, HFT, it is held for trading, AFS is available for sale. Shifting in between them requires a board approval, that is shifting from long term to short term, or shifting between these classifications also require a board approval. Okay, if appropriate method of accounting followed and adequate disclosures if changed. And verify for NPAs if recognized income on receipt basis. If interest or principal is overdue more than 90 days, we call them as NPAs. And you need not remember this, but you have to write it here. We have separate section on the bank audit only with regards to NPAs and sale of NPAs and purchase of NPAs. We'll discuss in detail there. And while dealing in securities on behalf of others, that is starting, we have discussed that there have to be investment policies for its own account and on behalf of customers. This behalf of customers is discussed here now. Where while dealing in securities on behalf of others, that's the customer, prior approvals have to be obtained. Prior approvals is like prior approval on whose behalf we are trading, and any material undisclosed liability from breach of any fiduciary duties. That is, duties like having a trust on. If you breach that, if the bank breaches that, what's the liability of that breach? And if bank's income is recorded fairly stated in financial statement on that commission or etc., whether they were recorded and fairly stated in financial statements. And the next, special purpose certificates relating to investments, maintaining separate accounts for its own investment account and its own PMS client account that has to be audited separately by external auditors also on behalf of other constituents like other banks. And the last point is the bank shall take half yearly reviews. We have seen reviews for yearly for the loans, the advances or the loans that have to be given, and for the investments it is half yearly investment. And now we'll discuss about advances and capital. What are the things we have to check for auditing such kind of items in balance sheet? And with no delay, we'll move on to this. Advances. Auditor concerns with regards to audit of advances, what all he has to check for. Advance amount outstanding as on balance sheet date. No unrecorded advances. They're talking about the completeness of information. What we have also discussed it earlier. Basis of valuation and recoverability of advances. Advance relevant for statutory and regulatory requirements, and appropriate provisions with respect to RBI norms, AS and GAAP, and internal controls over advances. What are the internal controls that have to be followed while giving advances? First thing, it was categorized into two portions. That is prior to making advances and after making advances. First thing, prior to making advances, what all we have to check? We have to check the creditworthiness of the borrower, and we have to check whether the proper competence authority, whether the advance amount was within our authority or not. Third thing is that we have to check for the documents that were in favor of our bank being or not. We'll have to check for that. Area of credit appraisal proposes creditworthiness and loan applications and creditworthiness of borrowers. This all boils down to single point that what we have discussed about creditworthiness. Sanction from proper authorities, as we have already discussed it. Documents executed by the borrowers. We have to check these three things prior to the advancing loan, and compliance of loan policy of bank, and such policy have to be in compliance with RBI system laid down for renewal and renewal of advances. How frequently the advances policy have to be renewed? Yearly once. It has to be reviewed yearly. Substantive audit procedures. What do we have to do? We have to examine all large advances, SMA 1, SMA 2, or quick yearly mortality case. SMA 1, 2 was something like they were not NPAs for 90 days or more, right? That more than 90 days. The SMA 1, SMA 2, SMA 3 were three categories that were categorized into 30 days portion before 90 days. That is either the principal or interest overdue below 30 days, SMA 1, below 60 days, above 30 days, that is SMA 2, and 60 to 90 days segment is SMA 3. And restructured account. Restructured account is that all the overdues that were again converted into principal and or the EMIs were just made it a restructured. Adversely commented by internal auditors. Okay, these were some like red flag areas, red flag accounts. And single customer ID for all accounts of such customer. That is, the customer ID should not be duplicated. And why they're talking more about is that because there could be a chance of window dressing the NPAs through duplication of customer IDs. That's why. Recoverability of advances. What do we have to? We have to review the audit reports, statements submitted by borrowers, latest financial statements, reports on inspection of securities. And these are all with regards to the advances, checking of advances. You need not remember whole thing. Remember something that was repetitive in nature. You see, this was repetitive and this was repetitive. And customer IDs is something that you could easily remember that. And you could also review what you could review. You could review what all the documents were their audit reports or latest financial statements. So what you have gone to audit for? You have gone audit for the financial statements and reports, internal auditor, etc. And to check for the advances completeness or not. And obviously, as we have discussed earlier, for every point, you have to write up a statutory and regulatory requirements. You have to write that. 60% if you write enough, it would be more than enough. Iraq norms. Iraq norms is income recognition and asset classification norms. How you classify that? Verify if CBA is identifying crystallizing the NPA. What is crystallizing of NPA? Crystallizing of NPA is, you see, interest or due date is accrued onto that account. But in case of NPA, only on the receipt basis, you have to recognize the revenue. That is what crystallizing of NPA is. With no manual intervention, that is, you have to crystallize the NPA without any manual intervention. What do you have to examine? Classification of advances is appropriate and secured and unsecured portion segregated correctly. Thus, they're talking about segregating secured, unsecured portion, and advances have to be classified correctly, like standard assets, substandard assets, loss assets, doubtful assets, and loss assets, and review date of NPA. They're talking mostly about that. And with all the things with regards to classification. And what is account regularization? Account regularization is after account have turned into an NPA or any kind of SME, it has all the overdue amount was paid and it was shifted from the substandard asset to a standard asset. So you have to check the payment sources were of genuine. It is not that even though it was done under way before the year-end process, not only for window dressing, you have to make sure that they are from legit sources and not made only for the legit sources. Verify that payment of overdue is from genuine sources. If genuine sources, yes, then it's not an NPA. If not NPA, you have to recognize it as an NPA, even if the overdue amount is paid by the end of the year. If the branch provides further funds, including debentures, carefully assess the sources. And if account has inherent weakness, it's an NPA. Inherent weakness is mostly like overdue, or like an overdraft account or a cash credit account. What's cash credit or have to do is that at least 80% of the sanction, mostly the sales have to fall under this account, right? Only the interest portion is getting credited on that. That's a matter of a weakness, right? That's a red flag account. So what do you have to do? You have to treat that also as an NPA with inherent weakness. NPA shall be recognized on past due overdue concept and not on balance sheet date. Okay. Drawing power. Talking about more drawing power, it's mostly for the overdraft accounts. Drawing power calculated as per credit policy of bank, formulated by board of directors, agreed by the auditors, reflected from respective sanction letters. And special consideration for sundry creditors, stocks under LCs of bank guarantees, working capital advances in construction business, stock auditor comments. These are all the areas we have to put some special concentration there. And accounts with temporary deficiencies need not be treated as NPA, like DP exceeds limits or not reviewed, need not be reviewed. You see, up to for what are the temporary deficiencies were like up to 20% of the sanction limit for 90 days, the DP could be exceed. The DP could exceed. Until then, it is not treated as an NPA. That is what we have discussed in the earlier part. Stock statement shall not be older than 3 months. Obviously, if so, considered irregular. This is what we know. And accounts where limits, regular or ad hoc, are not reviewed from 180 days from the due date is an NPA. You see, stock statements older than 3 months, NPA. If the account or the overdraft account was not reviewed, the limits were not reviewed, the sanction limit or the sanction limit was not reviewed for 180 days or more, then it would be treated as an NPA. And if temporary deficiencies, if not temporary deficiencies, were also treated as NPA. For temporary deficiencies, were not treated as NPA. You see, the asset classification is borrower-wise, not the facility-wise. If debits from devolvement of letter of credit or invoked guarantees are kept in a separate account, the outstanding balance shall be treated as a borrower's principal accounts from IRAC. And that's it. And now we'll move on with government guaranteed advances. If government guaranteed advances becomes an NPA, interest shall not be taken unless interest is realized. That's what we do for all NPAs. If such credit facility is backed up by central government, it is treated as NPA only if the central government repudiates its guarantee when invoked. This exception is only to central government, not to state government. If banks had not invoked CG guaranteed overdue, then the reasons to be mentioned in LFAR. The credit facility that was backed by central government will be treated as NPA only if central government repudiates its guarantee when invoked. That is, so the central government is saying that we cannot pay the bank. You please figure out it yourself. Then that's a situation when central government can't keep up its promise to pay back to the bank, that is called central government repudiates its guarantee. Only then it will be treated as an NPA. Okay, now agricultural advances. NPA norms are applied with respect to crop seasons. That is not 90 days or 30 days. It's with regards to the crop seasons. That is short term or long term. It would be determined by SLBC, means that crop seasons were determined by this committee. And these norms are applicable to all direct agricultural advances listed in Master Circular on lending to priority sectors. As we have already discussed, priority sectors were like housing, education, agriculture. Agricultural loans other than in circular, identification of NPAs is a non-agricultural advances. So this is what all we have to write with regards to agricultural, that NPA norms were applied on base of crop season determined by SLBC, that is whether short term or long term. And these norms were applicable to all direct agricultural advances. Agricultural loans other than in circular, that is, they have few loans that were mentioned in Master Circular. Other than those, it would be applied as a number of days categories, not on basis of crop season. Provision for standard assets. Or even for standard assets, we have to put the provisions category like 0.1 or 0.4 depending upon that, and auditor should check for RBI circulars and standard assets in different sectors, provisions to be created at a variable rates. That is, different sectors have different rates. Bifurcation of standard assets has to be checked and certified at a branch level. We have to check for the classification of the standard assets and substandard assets. And with regards to the restructured advances, restructuring means lender, for economic or legal reasons with respect to borrower's financial difficulty, grants concession to the borrower. That is, they may waive off the interest or may convert the overdue interest convert them into the principal amount and reduce the EMI portion also. That is, the bank is granting some concession to the borrower, which includes like modification of terms and conditions, alteration of installments and additional credit, giving additional credit, etc. And banks can restructure what all the advances it could restructure. It could restructure standard, substandard, doubtful, but it cannot restructure loss asset. Banks cannot restructure accounts with retrospective effect, only prospective effect. It might be asked in an MCQ. Please make a note of it. On restructuring, account will be downgraded, that is standard to substandard, and NPAs will remain in the same category. Or banks can restructure the standard assets. When you restructure, you have what you have to do. You have to downgrade that. You have to convert that standard into substandard asset. Why do we actually restructure? When there was a difficulty, right? Only then we restructure. So it's mostly that. But when you're restructuring an NPA, it was already in substandard, you need not do that. NPA could be over same category. With regards to upgradation of account, upgradation as per RBI guidelines, okay, there might be a possibility of incorrect upgradation on basis of partial recoveries, that is, overdue portion might have wiped out completely, And there can also be a possibility of recoveries after cutoff date and account upgraded on balance sheet date. What they're talking about, they're talking about the upgradation, that is substandard to standard or doubtful to substandard. Whenever the accounts or advanced accounts were upgraded, what we have to check whether they were done as per RBI guidelines, and there shouldn't be any incorrect upgradation on base of partial recoveries. That has to be legit. And there can be also possibility of after the cutoff date and that is only for the window dressing, only for the just before the balance sheet date, if they could put on infuse some amount to not make it as NPAs or to upgrade the accounts. We also have to check for that. And with regards to sale or purchase of NPAs, what you have to do? You have to examine the policies laid down by the board of directors, what all the procedures and valuation of NPAs and delegation and accounting policies. And NPAs has to be sold or purchased only on without recourse. That is, entire credit risk is transferred to the purchasing bank. You see, why do we sell NPAs? Usually we sell NPAs or mostly on a discounting factor. Even after selling it into a discounting, we cannot bear that risk, right? We also already had lost some amount. So we have to sell without recourse. And sale of NPA. NPA shall be sold only if they have remained as an NPA in books for at least 2 years. You see, overdue was more than 90 days, it's turned into an NPA. From the point of that being an NPA, it has to be an NPA at least for 2 years to sell that NPA. Okay, you have to do that. But prior to that, you could put some remedial actions like giving it for factoring or any kind of remedial actions. This is they're talking mostly about the sale of such NPA, sale of that. NPA shall be sold only on cash basis and entire consideration is received on upfront basis. That is, you shouldn't exchange it for the shares or debentures or stocks. What you have to do, you see why they are putting so much instructions with this is a possibility of so much of fraud that could be involved in. So much of public money was involved in banks, right? So there were more regulations were there. We have to just understand the logic behind each regulation, and it would be very easy for us to write in an examination too. NPA shall be sold only on cash basis, and entire consideration is received on upfront basis, not on credit basis. And bank shall not assume any risk for sold of NPAs, and NPA has to be removed from books of accounts. As we have already said, as we say, without recourse, what we should do? We should remove those from the books of accounts and assume no risk. And say if sale price is less than net book value of such NPA, there is a shortfall. So we'll debit that in P&L account. If sale price is more than the net book value, that is excess provision, has need not be revolved and utilized to meet the shortfall of the other NPAs that were there. You need not credit that in the P&L account. You need not realize the P&L account. Purchase of NPA. While you're purchasing NPAs, what you have to do? The bank shall not purchase an NPA if originally sold. That is, if I had originally sold my NPA 2-3 months back and I cannot repurchase that, what all the NPAs that I have sold? That's what they're talking about. The bank shall not purchase any NPA it originally sold, because it's also a chance of window dressing, right? Yes, it could also be a window dressing type. That's why they have specifically mentioned this point. NPAs are subject to IRAC norms. Okay, 100% risk weights are given to NPAs for the computation of capital adequacy. Okay, there is weights. No, by calculation of Tier 1, Tier 2 capital, we have some risk-weighted assets, right? For the NPAs, we have 100% risk weights there. Any recovery from purchased NPA first adjust to the acquisition cost, and then the excess would be treated as profit. You see, can we recognize profit on sale of NPA? No, we have to compensate it with the shortfall that was already done. So we have to create a provision for that. But can we recognize that as a profit on purchase? Yes. Any recovery from purchased NPA, you could recognize that as a profit. First adjust it to the acquisition cost and then excess in P&L account. So you have to check, or you have to make a note out of it. It is something, it could be confusing. And fixed assets, with regards to fixed assets, what all the things we have to check for? Ownership, existence, and their valuation. Internal controls, what all the internal controls are with regards to the fixed assets you have to check for? You have to check the expenditure and accounts and information with regards to that. On expenditure of financial statements, or that with regards to acquired or self-constructed. That is, expenditure of financial statement is what the amount that be in the balance sheet, right? So we have to make a note out of it, whether it had got acquired or whether it was self-constructed. Accountability and utilization controls, and A certain of accounts are maintained at a branch or central level, or there's an or here, if anywhere it could be maintained. Information controls for availability of information. There should also be a proper information that has to be given. If it was maintained in a HO central level, for the branch auditors ask for the fixed assets information, they have to give the make the information available. For that, information controls has to be there. And location of title deeds, evidence in ownership. And okay, obviously title deeds with regards to the ownership and acquisition or disposal by branch properly communicated to the HO. Okay, these are all the things with regards to the internal controls. And you might write about the ownership or existence valuation. You have to check whether there or not information and where it was accounted, maintained, and expenditures. And with regards to premises, verify the opening balances, acquisition of new premises. That's mostly you remember it as a tabular format. Opening balances, any kind of additions that were there, any kind of self-constructed assets, new premises. This is additions were categorized into two: acquisition and self-constructed assets, as we have discussed here. Yeah, in additions and fixed asset register balance, that was closing balance, and for leasehold properties, that is second categories. With regards to ownership, this is one, and for this is under the second category of ownership, that is leasehold premises, like capitalization or amortization of lease premium are to be examined. And if title deeds are at HO, obtain written representation from branch management and communicate to central auditor and mention in LFIR. Okay, with regards to the ownership, we have to do that. And as it's revalued, you have to check for the appropriateness of the basis of valuation, and revaluation surplus or deficit accounting are to be examined. And fixed assets shall not include assets for own use, including employees. And for the other fixed assets, there's nothing much to remember this. For movable financial statements, attention towards recording the movements, that is physical verification at periodic interval. While transfer of asset, what do you have to do? We have to verify the accumulated depreciation. That also has to be transferred. We have to check for that. And intangible assets, you have to account it as per AS 26, impairment AS 28, leases AS 19. On sale of any fixed assets, what do you have to do? You have to check whether the profit or loss that was properly accounted or not. And there's nothing much to remember here. And with regards to other assets, there's a chance of 4 to 5 marks under this heading here. Inter-office adjustments, examining of inter-branch accounts are normally recognized or reconciled at central level. Okay, they are saying that these inter-branch accounts are normally reconciled at central level. Okay, the auditor should report year-end status of such accounts and date of reconciliation. Or what do you have to report? He has to report in his LFA or etc. about such year-end status and the date of reconciliation. The indication of outstanding entries, you have to provide information for debit or credit entries, and discrepancies for properly dealt with books of accounts, and relevant information primarily from branch audit reports. And these were all the things. Interest accrued, and if interest accrued on all loans and advances were taken, special consideration for the overdraft bills that were purchased or discounted, interest in ordinary course of business. No interest to be realized as per AS 9, where it is a significant uncertainty about its collectivity. That is, they're talking about the, we'll see, read it in AS 115, right? If there was significant uncertainty about the collectivity, you should not recognize that income. They are talking same about the interest also. Interest in ordinary course of business. With regards to assets in TDS and advances, what you have to check for? You have to check that for 26 AS has to be equal to has to tally with the claim of IT returns, and all the TDS certificates have to be collected by branch, and the original copy should be sent to the HO. And with regards to stationeries and stamps, it includes exceptional items like bulk purchase of stamp paper valued at cost. They have to be valued at cost. And normal stationery is charged to the P&L, like there are insignificant items. To fiscally verify the stamp papers, and any shortages would expose bank to a potential loss for misuse. That is, a stamp paper can do a lot of things, right? Consumed during the year are charged to the P&L account. That is what all the stamp papers that were valued at cost, what all the stamp papers that were consumed during the year was charged to P&L account, and normal stationery is also charged to P&L account. And non-banking assets required in satisfaction of claims, these are held with an intention of being disposed of. Where it is like mostly if any person had not paid had put some security and not paid the loan or advance amount, right? Then what do banks seize such cars or bikes or such property, right? What do they do? What they not if they seize a bike, they cannot start a biking rental. So what do? They same thing. So there's with an intention to dispose of. Verify relevant documentary evidence like court order or arbitration award, and check if ownership is transferred or not, and provision of liability is as per AS 29, and compliance of Section 9 of Banking Regulation Act with regards to period of holding, till how long they could hold. Different assets have different kinds of holding limits, and that was not in our syllabus. Though on date of acquisition, assets are recorded at net book value of advance or net realizable value of such asset, whichever is low. That is on whose loan, on which non-repayment of the advance that the asset had been occupied, or the asset has been taken if required. That advance amount or the value of such asset, whichever is lower, has to be recorded. And we have to check for the ownership and the documentary evidence, and because it's intention, and also mention its intention also to dispose of. And others, it's like non-interest bearing staff advances. What you have to check for? You have to check for the relevant documentation and policy framed by bank, and ensure the availability, enforceability, and valuation of security relates to employees on roles as on date of preparation of financial statements. Loans and advances to officials and relatives. The loans are sanctioned by the next higher authority ordinarily, and such amount is reported to the board. These are all mostly like a staff advances, and there's nothing much that's not at all important. You could skip that. And security deposits with various authorities with respect to documents having terms and conditions, ensure that those security deposits is not due as per terms and conditions, and its recoverability. Create provision if doubtful to recover. Have to prepare a list of the security deposits that we have with various authorities, and you have to ensure that they were not due. You have already paid that, and you have to check for its recoverability percentage. If they were doubtful to recover, you have to create a provision. You see, for the electricity or telephone department, these are mostly recoverable. But if it's in a GST, you have paid that security deposit with regards to any kind of disputes to a GST department, that's something recoverable. You have to create provision for that. And for suspense account, obtain details of old outstanding entries in suspense account from the management, and if any provisions or written offs is required, ensure that it's made. For suspense account, what you have to check? You have to check old outstanding accounts entries, and any kind of provisions or written offs you have to make. You have to make that. And prepared expenses like reasonable allocation was there or not, and allocation of discounting or rediscounting charges paid by bank to different accounting periods is in consonance with the accounting policy followed by the bank as a whole. That is, they're talking about the bifurcation between two periods. And miscellaneous debt balances on government account recoverables from the HO. You have to review the aging statements. You have to review that and examine the recoverability of the old outstanding items. Something that was recoverable, the balance, you have to check for its recoverability. If you have to make any provisions, you have to make that. And any kind of variances has to be recorded. You review in the and review with respect to previous year figures. You have to do that. And with regards to the final topic, verification of capital and liabilities. What's the things we have to check while checking the capital? We have to verify the opening share capital with respect to previous year audited balance sheet. That is, the previous year balance was should be the opening balance. You have to check whether opening share capital was taken correct or not, and you have to check whether there were any additions to the share capital. Increased share capital is examined with relevant documents like special resolution of board or prospectus issued, and we have to check for the capital adequacy. It is the adequacy of capital resources of bank in relation to risk associates with its operation. We know that banks have to maintain a certain adequacy of capital. They have to be tier 1, tier 2 capital with regards to some proportion of risk-weighted assets, right? They're talking about that, and you have to check for the stress testing. RBI required every commercial bank, excluding RRBs and LABs, where board approves stress testing framework which integrates into risk management systems. Stress tests are designed to understand if a bank has enough capital to survive its plausible adverse economic conditions, like SVBC bank collapse that we have got here. Not that much of effect to the India. Bank maintain enough buffer to stay afloat under extreme scenarios, like all the Ukraine wars that have with regards to the banks of the Ukraine, and they're talking about that. And that is, stress testing is the ability of the bank to survive in adverse situations. And with regards to Basel III framework, it relates to the capital adequacy compliance by bank that it has to achieve as per Basel III Accord. What is Basel III Accord? It strengthens the regulation, supervision, and risk management of banking sector. It is global regulatory standard on capital adequacy, stress testing, market liquidity risk. You see, what is Basel III Accord? It is the capital adequacy has to be maintained as per Basel III Accord. It's mostly like an act for the rules or regulations to maintain the capital adequacy for the banks worldwide. And what is Basel III Accord is maintained for? What it aims for? It aims at improving banking sector's ability to absorb shocks arising from financial and economic stress. Okay, that is it's to maintain some adequate capital adequacy. If all the depositors come and withdraw their money, bank has to survive, right? So in order to maintain that situation, in that economic stress situation, the bank has to how well the bank could maintain or survive, improving risk management and government practices, and strengthening banks' transparency and disclosure standards. And Taiwan capital consists of, we have been talking about the capital adequacy, right? This is what the capital risk adequacy ratio is that Basel III Accord is talking about. Taiwan, its eligibility total capital funds divided by risk-weighted assets and off-balance sheet items. You see, the minimum capital risk adequacy ratio should be the 9%. And what is Tier 1? Tier 1 is total eligible capital funds is equal to Tier 1 plus Tier 2. Tier 1 consists of share capital and some disclosed reserves. And Tier 2 is mostly contains about certain specific reserves plus some subordinate debt. That was mostly in the Basel III Accord. We need not study that for further. It was not in our syllabus though. And reserves and surplus, it contains statutory reserves, capital reserve, share premium, revenue and other reserves, including investment fluctuation reserves, balance in P&L account. They just given a list of all the reserves that contains a risk and reserves and surplus heading. And with regards to the deposits, there were two types of deposits, that is current accounts and savings account, right? Both in connection, we call it them as CASA, current accounts and savings accounts. Verify on sample basis CASA is opened during the year with respect to KYC norms. You have to check for the KYC norms for the accounts that were opened, both for the current account and the savings account. Check that savings accounts are not opened for the business purpose. Savings for the personal purpose, current account for the business purpose. So you have to check that savings accounts are not open for the business purpose. Calculate interest on test check basis and no interest in current accounts. You have to check you see savings bank the balance in savings bank do have some interest that was accumulated, but there shouldn't be any interest for the current account. So you have to check the interest what was made in the savings bank is accurate, and you have to check that no interest has been made in current accounts. Ensure that current account debit balance is regarded as advance and credit balance is as deposits. And you see, mostly savings banks were deposits only, because there cannot be a debit balance in a savings account. Inoperative accounts are higher risk areas of fraud. That is that was not at closed accounts, but there were no transactions that have been taking place. Inoperative accounts are such accounts which were no transactions over a period of 2 years. Verify accounts that are revived or closed during the year. And we have to check for the inoperative accounts. And with regards to the term deposits on sample basis, interest rate, we have to check for the interest rate on bulk deposits, that is 2 CR or more. On closure of term deposit, check for the foreclosure penalty if required. And if a term deposit was made for 7 years and if it's got closed for the 3 years, the interest rate has to be reduced. And moreover, the interest, there have to be a penalty for foreclosure of penalty. When we do audit for the test term deposits, we have to check for that. And recurring deposits opened during the year, and correctness of the interest rate, as whenever there was any kind of accounts for which interest rate was for which interest is payable by the bank, you have to check the interest rate and whether the amount was properly due or not, whether that was correct, calculated correctly or not. And term deposits are issued serially and accounted in register. You have to document that. Talking about the documents there. Deposit designated in foreign currencies. How do you check that? Verify FCNR account, that is foreign currency non-resident account. This account is widely used by NRIs to store their income in a foreign currency. Open during the year to confirm RBI regulation compliances. Permissible debit or credits as per RBI directions and converted into rupees at the rate notified by HO, and the resultant will be debit or credit to the P&L account. And the interest is paid on 360 days basis. Not 365 days, it's 360 days with respect to FCNR. NRE's accounts are repatriable. That is, they have to be brought back to India. NRO's accounts are not repatriable, except all current income is subject to some certain terms and conditions. These are all the things you have to write. This is not tested in the ICA, but make sure to look at one day before the exam so that you could write it. I think mostly it would be a great question here to ask in our current examination. And borrowings in India, how to categorize the borrowings and check for them. Borrowings in India, borrowings from RBIs, other banks or other institutions and agencies, and borrowings outside India. Or what do you have to check? You have to obtain verify the confirmation certificates like agreements or correspondence, and you have to obtain external confirmations like account balance confirmations, etc. Examine. You need not remember from here. You could also write it from the balance with respect to RBI's balance with respect to other banks, or you could write from that. Examine the clear distinction of rediscount and refinance, and borrowing as per money at call and short notice has a proper authorization or not. They have to have a proper authorization. And with regards to other liabilities and provisions, inter-office adjustments. If credit balance is shown under the head, you have tried. We have already discussed the inter-office adjustments there, right? Interest accrued on deposits of borrowings. And with regards to bills payments, officer having signature book shall verify the signatures on demand draft, which we have already seen. All demands issued shall be informed to paying branch by an advice, which we also discussed. And if paying branch do not receive proper information or do not receive a credit, it should take immediate step for that. It's like giving information to the paying branch, etc. And bank should have a reliable private code for coding and decoding the telegrams, that is encrypted, end-to-end encryption. And with regards to contingent liabilities, the claims against the banks, you see these 5 to 6 points you have to remember, and it is widely used in bank audit, right? It's mostly tested portion also. So this is also an A category question. Claims against the banks not acknowledged as debt, liability for partly paid investments, and liability on account of outstanding forward exchange contracts and derivative contracts, guarantees given on behalf of constituents within India or outside India, acceptance, endorsements, and other obligations and other items. Now we'll check how the audit approach has to be for the contingent liabilities. Contingent liabilities are obviously off-balance sheet transactions accounted in books of accounts and supported by underlying documents. The discounted disclosed. You see, these were all not important in contingent liabilities. Only these 5 points were important. You need not remember that, but just I'm giving it a go. The disclosed contingent liabilities do not include any crystallized liabilities. We have seen this crystallized NPS, right? NPS has to be crystallized previously, right? Contingent liabilities are based on the best estimates as per AS 29, including consideration for possibilities of any reimbursements. What they're talking about the documents has to be there, and it should not include any crystallized liabilities. It could be asked in an MCQ. Please give it a go. And contingent liabilities were as per AS 29, and what the audit procedure that have to be followed. Bank guarantees are coterminous with the period of credit reckoned from the date of shipment, and the test of completeness of recorded obligations, and review the reasonableness of the year-end amounts of contingent liabilities. Review whether comfort letters issued by bank have considered for disclosure of contingent liabilities. These were the audit procedures. What the audit procedures are? Bank guarantee should coterminous, that it has to start along from the date of shipment. Date of shipment, that credit period also has to start. And the test, you have to check the completeness of that, and you have to check the reasonableness of the contingent liabilities. And you have to also review the comfort letters also that were issued by the bank with regards to the disclosed contingent liabilities. Auditor's report. You see, what are all the things that auditor has to give report on? You have to give report on the balance sheet, whether the balance sheet was full and fair balance sheet, and exhibit a true and fair view. With regards to the notes of accounts, he has to give report whether it's satisfactory or not, whether the notes of accounts, notes to accounts were satisfactory or not, and the P&L account is showing it, exhibiting a true balance of profit or not, and whether the transaction have come to auditor's notice. What are the transactions, significant matter transactions have come to his notice, and whether the returns received from branches were adequate for the audit. He also have to mention that what all he have to do. We have balance sheet, notes to accounts, P&L account, and the transaction that have come to his notice, and the returns that were received from the branch, whether adequate for the audit or not, and other matters that were brought to him. And all the other matters that were brought to him. And now we'll move on to the next topic, that is rule number 11 of Companies Audit and Auditors Rules 2014. It is nothing to do, but this rule was applicable only when in these 6 scenarios. It is not so important, but we'll just revise it once. If the company disclosed the impact of any pending litigations, with regards to any pending litigations, and if the company made provisions for material foreseeable losses, or if it's a delay in transferring of funds to Investor Education Protection Fund, auditor has to report. And the dividends declared was whether the dividend declared is as per section 123 of Companies Act that we have discussed in the Companies Act. And with effect from 1/4/2022, the accounting software that the entity has should contain an audit trail to walk through the process or walk through the process as per the statutory requirements. And the management has represented to best of its knowledge and belief that no funds have been advanced, loaned, or received on behalf of ultimate beneficiary reasonable and appropriate audit procedures have been performed. And with that said, we'll just move on to the next topic, LFAR. It has to be given by statutory branch auditors and statutory central auditors. Both the auditors has to give LFAR. It's a form of questionnaire. It's mostly like a question where the observations or comments have to be provided by the auditors. And statutory branch auditors have to submit to statutory central auditors, and consolidation is done at HO. Okay. LFAR is submitted to ACB, that is Audit Committee of Board. It's a portion of Board of Directors. It was constituted by the Board of Directors itself. That is mostly the management. LFAR plus any relative agenda note plus board views are submitted to RBI. That is, the responses of board was submitted to RBI within how many days? Within 60 days from submission of LFAR by statutory auditors. And with that said, we'll move on to the next topic. Statutory central auditors provide additional reports. What all those additional reports should consist of? Consist of report on adequacy and operating effectiveness of internal financial controls and LFAR, compliance of SLR requirements that we have previously seen, and treasury operations as per RBI, and with regards to reconciliation of securities, Iraq as per RBI guidelines, and custody of unused bank receipt forms, and authentication of capital adequacy ratio that we have calculated earlier, Ghosh committee relating to frauds, and Jilani committee with regards to internal control. These are all the additional reports that were central statutory auditors have to give. What the statutory branch auditors have to give? They have to give LFIR only. That's it. And with regards to the concurrent audit, this is the last topic in bank audit. An audit which is done concurrently as a transaction takes place. It is not a pre-audit. It is to check the authenticity of the transactions in the shortest time possible. Concurrent audit was mostly done daily or on weekly basis. Scope of concurrent audit. The scope of concurrent audit, we have highlighted C, O, A, D, I. For what? For all the key areas of that. Cash, other items, advances, deposits, investments, forex transactions, and housekeeping were two extra points that we have written here. And when we see over concurrent audit, you need not remember a separate mnemonic that is out of nowhere. You could just highlight it from the heading itself. First two letters and audit, A, D, I, and forex and housekeeping. If you read that 2-3 times, it would be very easy for you to just highlight these two and remember that. Cash, other items, A for advances, D for deposits, I for investment, and then forex, foreign exchange transactions, and housekeeping. And these were all the key areas audit procedure has to be done. And the scope of audit should be clearly and uniformly determined by banks central inspection and audit department. As what we have seen, this is like an audit committee for banks. Audit committee is for the companies in general. Central inspection and audit department is for the specialized banks. The scope of concurrent audit is in branches is at the discretion of the head of internal audit of banks with prior approval of audit committee of board. This is also a portion of board. These were constituted by board. This is not an government authority, etc. This is also within the entity. And with regards to housekeeping, what do housekeeping does? Checking inward and outward remittances, check the transactions of staff accounts, detection and prevention of revenue leakages. Why do check for staff account is whether any kind of fraud that could happen. Detection and prevention of any revenue leakages, ensure timely adjustment of large value entries, early reconciliation of entries outstanding in inter-branch and inter-bank accounts, suspense accounts, sundry debtors account, DDRR accounts, draft accounts. DDRR accounts was such as direct debit request accounts, where if a person has some EMI for car loan, and you could authorize your bank to make payment directly as on the due date of that. That's what the approval is for the bank, so that you could debit it customer account or its bank CASA holder account for that EMI or regular payments. This is with regards to that. And appointment of concurrent auditors. Who appoint them? But at the option of the bank to appoint internal staff or external auditors. Who could be appointed? It could be appointed external auditors or internal staff. If internal staffs are appointed, they should be given a proper training and they should have some experience. If externals were given, they need to have a maximum tenure, like maximum 5 years, and if it's an auditor, maximum 3 years. This is not the term of rotation of auditors. For concurrent auditors, it's way lesser. For a single auditor, it's maximum 3 years, and a firm, it's a maximum 5-year term. If any serious act of omission or commission noticed in the working of external auditors, their appointment were cancelled and reported to RBI and ICI also. And remuneration of scope tenure is fixed by audit committee of board. And these all with regards to the appointment of concurrent auditors provisions. And yeah, with this, we have come to the end of our bank audit. Reporting systems of concurrent auditor, to whom the concurrent auditors report, on what matters the concurrent auditors have to report. A proper reporting of findings in a structured format. There should be a format for that. And a quarterly review. This is quarterly review of key features during the audit placed before ACB. That is, they have to, the ACB who appointed the concurrent auditors have to review the key features during the audit, that report key findings, etc. And zone-wise reporting, annual appraisal report before ACB. Okay. Before submission, auditor shall discuss with branch manager. The fraudulent transactions detected, inform immediately to Inspection and Audit Department of HO. Obviously, there will be an HO and Chief Vigilance Officer and a branch manager unless he is involved. If any fraudulent transactions that were there, whom do he have to inform? He have to inform with Inspection and Audit Department, Chief Vigilance Officer, branch manager, but not to the ACB. ACB, what do they do? You see, they're of a top level management, right? They concurrent auditors don't go with them directly. What do? They actually review quarterly ACBs. That's only the task, and this could be asked as an MCQ. Please make a note out of it. Not ACB. When there was a fraud that was involved, they they communicate or they inform immediately to Inspection and Audit Department, Chief Vigilance Officer, branch manager, unless he's involved. Any minor irregularities rectified should be in a timely manner. They need not report that, and follow-up action should be given a higher priority, and rectification done without any loss of time. As we have already said, what's our golden rule? When we identify any kind of risk, we have to give the remedial measures, and that is remedial measures. After that, we have to monitor that. We have to check whether they're constantly improved and consistently applied. And with that said, now we'll discuss the important topics in bank audit. As bank audit is a vast chapter, we'll just brush up what all the important points are. We'll just know what are the must-do topics here. You see here, bank characteristics. It is so much important, not as a direct question, but to know what the bank audit is comprised of. This bank characteristics, something that's important, and this is not important. This elements, you need not remember that. Just read it once and you'll go. Financial statements of banks and appointing authority was important. And bank audit process, just read it 1 week before the exam, and you need not remember that. This is more, you could write it mostly with regards to the standards on accounting, the stages of initial considerations, undertakings, etc. And all the reporting process. And audit planning memorandum, you have to remember this definition. It could be asked as a 5 marks question. It was not asked until now, but when they asked, you could bank your 5 marks there. And with regards to IT and special consideration in IT environment, you could read it from here or from various other. There were 2 to 3 times that were there in special consideration for IT environment. You could either read it from here, but what I suggest is read it from the bank audit itself, because it covers a vast area. And with regards to security control, 1 week before the exam, you read it once, that's it. And risk-based internal audit is also important. You have to read that. And examples of internal controls, you need not remember everything. What you have to remember is only few. Cash, anyways, everybody will remember. As we already done our articleship exam, we could write it in general also. Remember this clearing one. Read this clearing one. Clearing. And not bills, collection, bills purchase were not so important. You could write it like normal loans account, right? You have to put register and all. You read it once and just leave that. And with regards to loans and advances, you read this one. Loans and advances are widely repeated in bank audits itself. In bank audit itself, you read this portion, and you repeat that whenever they ask in what all context. And demand drafts, not important. Inter-branch accounts were also not important. Credit card operations were so much important. They're important. And CRR, SLR also important. And this audit of CRR, SLR is important. And with regards to verification of assets and cash is not so important. Balance with RBI, it's not important here. And money at call and short notice is important. And with regards to investment policies is also important. And you see, we have learned here, right, the loans and advances, audit of loans and advances here. You repeat that here, verification of assets. In verification of assets, you repeat that and write mostly the same. It covers almost 70% of that. Remember the Iraq norms. Drawing power, important. And government guarantees was like, read it 1 week before the examination. And with regards to restructured advances and upgradation of accounts and sale and purchase of MPAs, these 3 were so important. And with regards to fixed assets, you need not write anything. You could write it from any standards on accounting or etc. You could write it in general. And these are not important. And with regards to capital is important. That is this one, right? Stress testing is important. And this formula was also important. This formula is important. They may ask as a problem for you. And deposits not important. This foreign currencies was important. This is LP test until now, but it's an important one. Borrowings need not be asked. You could write loans and advances portion only till here, like external confirmations and all. And contingent liabilities is important. You have to learn this. You have to write it. All these things. Audit approach under contingent liabilities were not such important. And this audit report is also very good to go. This is all something read 1 week before the examination, and it's mostly the same. And LFIR, these additional reports were also read it 1 week before the examination, and you're good to go for that. And concurrent audit, these key areas were important. And housekeeping was also important. And their appointment is not important. In appointment, also this tenure is important. This is something that's different from normal audit tenure. Normal audit tenure, that is 5 to 10 years. This is 3 years and 5 years. And this reporting is not that important, but under reporting, this fraudulent transactions were important. And these were all the important topics in bank audit. First, we'll see what is an NBFC. NBFC is non-banking financial, but what's as per RBI? RBI NBFC is a financial company. And non-banking business of deposits under any or arrangement or lending in manner. Deposits and lending is business of bank, but it's a but when it's done by a non-banking, it's a non-banking finance company or any other non-banking which has previous approval of government. So as per RBI, NBFC is a financial institution which is a company or a non-banking institution. Business deposits under any scheme or arrangement or lending in any manner or any other non-banking institution prior approval of central government. The audit of NBFC revolves around only a few things. That's RBI and credit rating and accepting deposits and prudential norms like standard, substandard assets and Iraq, etc. Whenever you find any question regarding to NBFC, your answer revolves around all these things. So the next, RBI identify NBFC as whose financial assets were more than 50% of its total assets. Financial assets that right, cash or cash equivalent, etc. And income from those financial assets were more than 50% of its gross income. Okay. So NBFCs was something in order to recognize a non-banking financial regarded or registered with an RBI has to satisfy that its financial assets were more than 50% of assets, and it or both balance sheet and P&L has to satisfy, that is income from financial assets more than 50% of gross income. So as per section 45 IA, no banking company is allowed to commence or carry business of NBF, non-banking financial institution, without obtaining a registration as per RBI. As we have said, the NBFCs they were governed by RBIs and having net owned funds. From 2CR is net owned funds. So again, as per section 45I, NBFC is a company registered under the Act, engaged in the loans and advances of acquisition of stocks, bonds, and ship business, but does not include agricultural activity or sale of goods, services, or immobile property. Okay, don't get mistaken with this chit business. Whenever there's a chit business, business were mostly regulated by state government, but if at all it was included, it's just a part, and it was not registered under chit fund chit acts like here, not as per chit fund act. When an NBFC, they're exempted to get registered from RBI. So we are going to categorize the NBFC. That's two term deposits. NBFCs have seen, right, as per RBI, NBFCs receive deposits. What deposits? There were two types of deposits, term deposits and demand deposits. NBFCs cannot accept any demand deposits like a bank. It's a non-banking financial institution. So it could accept only term deposits. And so that it was categorized into deposit taking and non-deposit taking. For non-deposit taking, it was further categorized into systematically important and non-systematically important. Uh, Depends upon the threshold. There was a threshold limit for the net own funds or the net own funds, which was not necessary to discuss, and it is in study material too. So we need not remember that threshold limit. And it depend upon the activities they do. NBFCs were categorized into ICC, Investment and Credit Company, IFC, Infrastructure Finance Company, CIND. Whenever there's an ND, it's a non-deposit taking. SI, significantly important, systematically important for investment company. IDF, NBFC, Infrastructure Debt Fund, non-banking financial company. NBFC, MFI is microfinances. We have to also check whether it's eligible to do microfinance or not. With regard to while doing audit process, we'll further see that. We all know that factoring SFM, right? Who NBFC, who does that factoring factors, and NBO FH holding company. It's a non NBFC non-operator financial holding company which is not active. We have already discussed that NBFCs were regulated by RBI, but what are all such companies that were not need not be registered under RBI? That's there were various other acts it was governed under. Could see it in like here. The regulators of non-banking companies, where NBFC is registered under RBI. RBI regulates that. For the financial institutions were regulated by National Housing Bank, is an housing finance. SEBI was like merchant banks, company and venture capital fund, and companies who are in stockbroking and collective investments, or Nidhi companies, mutual benefit companies are regulated under MCA, and chit fund companies were regulated by state government, and insurance companies regulated by IRDA. These were all financial institutions, were all NBFCs, but they were regulated under other acts or other regulators. Um, Non-banking, non-financial companies were regulated by MCA. So we'll go, if I take a screenshot of this, is all. If I take screenshot, so it's easier to identify than like a list like this, which was given in study material. I felt this is more convenient to remember and write it in exam if you get a direct question like this. And with regard to core investment companies whose size is less than 100 CR or not accessing public funds are exempted from registration with RBI. And alternate investment funds. And in addition to the NBFCs that were this here, and there were two more, that is co-investments companies who was having asset size less than 100 CR and not accepting public deposits, and alternate investment companies. If you write this, more than enough. And what's the difference between a banks and NBFCs? Have already seen that banks accept demand deposits, NBFCs do not accept demand deposits. The same thing had been written here. And as a part of payment and settlement system and checks drawn on itself, NBFCs cannot draw checks and it do not form part of payment and settlement system. And obviously banks the opposite, vice versa. DCGC, the cover that was insurance that was taken by banks on the deposits that had it had accepted, like if which Malia had taken all such deposits and had gone away, flew away, right? So if the investors of the other small investor who have come to withdraw that, in order to go bankruptcy, in order bank going to bankruptcy, it covers the deposits under DCG cover of all the public deposits it had accepted, so that that amount was given by insurance company. So for that NBFC, it's not available. For banks, it's available. Here, even cooperative banks also, we could get DI cover. What's the minimum exposure to priority sectors? It's another regulation that was introduced by RBI to give loans to priority sectors like agriculture, etc., and rural cottage industry. For NBFCs, it was not necessary. For banks, it's Yes, they have to maintain some priority lending priority loans to priority sectors. And banks, if have already seen, right, and DT or something like sale of priority lending certificate, etc., for part of business in EGBP. I have seen lately that for the capital requirements, we have seen here they have to be year of net owned funds, and here about the capital requirements that was given by RBI for the NBFC. Every NBFC shall maintain Tier 1 plus Tier 2 capital more than or equal to 50% of aggregate risk weight assets on balance sheet, risk adjusted off balance sheet items, bank guarantee, and Tier 1 capital is more than equal to 10% of aggregate weight assets on balance sheet and risk adjusted off balance sheet items. Other than these were not applicable, this was not applicable to NBFCs of microfinance institutions we have seen, and IDF, that is infrastructure. This is IDF infrastructure debt fund, and this one non-banking microfinance. They haven't given what's Tier 1 and Tier 2. Mostly Tier 1 is share capital, etc., and specific reserves. Tier 2 is mostly general reserves, etc. So you have to remember these 2 points. And if it's a gold taking company, it's giving loans against gold, 12%. Tier 1 is more than or equal to 12% of aggregate risk weight assets on balance sheet and adjusted off balance sheet items. How do you know it's against a gold it gives loans against gold jewelry, like the 50% rule we have seen here, because that percent rule that we have seen here because of financial assets for more than 50% of total assets, it's identified as NBFC. Likewise, if the 50% rule is applied also here, instead of financial assets, you put substitute it with gold. I'm lately talking about the risk. We're talking about risk weight assets, right? These were all the assets, and what's the risk that was given? This percentage that have given here. Mostly cash and central government was 0, and if it's of public sector banks and state governments that were in default, not more than 90 days, 20%, and all else is 100%. We'll see. Cash 0, approved securities 0, public sector banks 20%, FDs and shares and COD infrastructure projects 50%. Only the thing that had got 50% and rest all is 100% in the corporate deposits. Anything that's company and state government having more than default period more than 90 days, 100%, and which was all secured, 0%, and staff is also 0%. So you could read it once or twice, get that. Cash 0%, approved securities, public sector banks 20%, FDs 100%, shares 100%, assets covering PPP and COD 50%, stock on hire 100%, the corporate loans and deposits 100, loans to fully secure 0, and loans to staff 0. Loans other secured were 100, bills purchased at discounts 100, others 100. And leased out was 100, premises, furniture 100. Income tax, the amount that was with central government is always 0, and others 100%. And if it's related to sovereign, all central governments were 0, and state government default up to 90 days is 20%, more than 90 days 100%. That's it. If you remember it as in a categories wise, if you categorize and remember, it's more easier to do remember. Income on NPA, all know that income of NPA should be recognized only on realization, and anything income that was recognized previous shall be reversed. And every NBFC shall check the credit weakness and extent of dependence on collateral security for realization and classify as standard, substandard, doubtful, and loss assets. We have seen that audit of NBFCs revolves around RBI, credit rating, accepting or deposits, accepting public deposits, and prudential norms, right? Here is the next part, prudential norms. The class of asset shall not be upgraded due to rescheduling unless it satisfies the conditions of upgradation.
when a substandard asset had been rescheduled, it should not be categorized into standard assets only due to the reason that it had got rescheduled. Only due to reschedule. It's nothing but when a standard asset, something which has no default in repayment of principal and interest. Substandard asset is for, they were given as a 3 categories for substandard and doubtful asset. Easier to remember. NBFC, non-deposit taking, not systematically important, had been an NPA for less than or equal to 18 months. NBFC, non-deposit taking, systematically important, had been an NPA for less than or equal to 12 months. An NBFC, which is systematically important, is been an NPA, has got an asset that was an NPA for less than or equal to 12 months. On assets, terms and conditions have been plus. After this, after all this, there was a fourth condition also, where an asset had been renegotiated, rescheduled, or restructured. 1 year of such renegotiation, that was 1 year it had got rescheduled or restructured for 2 times, that asset is also a substandard asset. Standard asset, no default in repayment of principal or interest. Substandard asset, for NBFC, non-deposit, non-systematically important, less than or equal to 18 months, had been an NPA. For non-deposit taking, systematically important and systematically important. For something that's systematically important, that is 12 months, had about an asset that is less than or equal to 12 months, had been an NPA. For non-systematically important, given a relief that okay, you could go for 18 months and then segregate into substandard. Thus, if an asset that had got renegotiated, rescheduled, or restructured within 1 year for 2 times, then that is also a substandard asset. Doubtful assets, it is less than or equal to, right? It's more than. That's it. Same thing, but more than. More than 18 months, more than 12 months, more than 12 months. Loss asset. Loss asset, an asset which have been identified as loss asset by internal or external auditor. Could be any auditor during inspection. The extent not written off by NBFC. An asset which have been potential threat of non-recoverability, its security, whether it had got erosion or non-availability or fraudulent act or omission by a borrower. So this could be, we have to read one more time for us to understand more. An asset which has been identified as a loss asset. A loss asset is something, an asset that had been identified by the auditors, whether it would be internal or external, as a loss asset, which was not written off by NBFCs. What are they saying? That loss asset have to be written off an asset, or this could be one point, and second point is that the security that was erased or non-availability of security or fraudulent act of omission by borrower is also a loss asset which has to be written off from the books. Have seen here, right? It had been NPA for less than or equal to 18 months. It's a substandard asset. What does the time limit to regard such asset as an NPA is here. All this is here for different assets, different kind of time limit. When an asset's interest is overdue for more than or equal to 6 months, it's treated as an NPA. When a term loan installment or interest is overdue for more than or equal to 6 months is an NPA. Demand or call loan plus interest overdue is more than or equal to 6 months. Here you might get a doubt that NBFCs cannot accept demand deposits, right? Then why they have included this demand deposits here is that this NPA is for whole. It's for either it would for banks or NBFCs. These NPA provisions were the same. The NPA or prudential norms would be same. These were personalized to NBFCs. This NPA is a generic term. So when if you find any such assets with banks, it could be treated as an NPA. That's it. The above were personalized to NBFC, and NPA provisions were in generic. Bills overdue more than or equal to 6 months. Other dues more than or equal to 6 months. Lease rentals or hire purchase installment more than or equal to 12 months. But here comes the specification part, the customization to NBFC. Non-deposit taking systematically important and systematically important, more than or equal to 3 months. If you have observed, for something that is systematically important, they have reduced the term for 3 months. 6 minus 3 months. Here 18 minus 12, 3 months. Sorry, months. Here the gap is 6 months. Here the gap is 3 months. Make a note out of it. Loss asset, we have already discussed, it has to be written off and 100% of provision has to be made. Doubtful asset, for a doubtful asset, 100% up to not covered by security. If it was secured, then up to 1 year 20%, up to 3 years from 1 year 30%, more than 3 years 50% for the secured portion. But if it's unsecured, 100% like a loss asset. Substandard assets, 10%. Standard assets, yes, we even if there was no default, we have to make provision. Even if there is no default for standard assets, we have to make provision, but a nominal provision. It had got again customized here. NBFC, non-deposit taking, systematically important, 0.4% systematically important. NBFC, non-deposit taking, non-systematically important, 0.25% of outstanding amount. And here is the audit procedure of NBFC. For any audit procedure, there were 3 stages: planning, execution, and reporting. It is more easier when we compare it with your standards. Like I said, 200 series, it talks about details before the engagement happens. As a 300 series, during the planning stage, right, you have to first understand the business environment and including its internal controls, and then identify, assess the risk of material misstatements, and etc. And as a 500 series, you could collect audit evidence or audit documentation, etc. Likewise, and 700 series about reporting. So while keeping that outline into mind, first what do we have to do after accepting any kind of engagement of an NBFC? First we have to ascertain its business. How do we know about its business? Through its MOA, AOA, and minutes of board or committee meetings. Here, like, it would be any kind of committee, various kinds of committees were further discussed in corporate governance chapter. Discussion with top level management to ascertain their plan and strategy. And how do you evaluate the internal control system? We know that design, implementation, and maintenance of internal control system is a responsibility of the management. So the auditor should gain understanding. So they were telling is that it's a responsibility of management. Why? What the auditor have to do? What the auditor have to do with regard to internal control system is that he had to know the nature. He had to decide the nature, timing, and extent of such audit procedure depending upon the internal control system that was in company, and review the effectiveness of such internal control system. That's it. And the second part is that since NBFCs or banks, it mainly revolves around with regulators and risk, etc. Right? Here, the regulator is the RBI. So we have to discuss about the registration of with RBI. They have to obtain a copy. We have to obtain a copy of certificate of registration or an application filed with RBI for registration. Okay, verify the registration. Yes, net own fund conditions. Why this? Here we have this right as per section 45 IA. We have to, no banking company shall commence to carry out a non-banking financial institution without obtaining a registration and minimum net own funds 2 CR, right? We have to check the same thing. We have to check whether they have taken a registration certificate and net own funds, conditions, etc. and ascertain investments in prescribed liquid assets plus quarterly returns have to be filed with RBI. Like SLR and CRR ratio, there would be few such kind of assets where the NBFC should also invest in. They are talking about that. NBFC, for in generic, for every kind of NBFC, what do we see? That we have seen again when there was a such generic question that has happened, what do we have to see? We have to see about accepting deposits at credit rating, RBI regulatory, and prudential norms. So we'll write the points revolving around everything. Accepting of public deposit directions. Okay, they are talking about deposits. Obtain a copy of credit rating of NBFCs. When an NBFC give loan to a borrower, it checks its credit rating, whether the borrower were able to pay or not. Likewise, RBI also had put such kind of regulation on NBFC that when NBFC is taking public deposits, so NBFC's credit rating should also be good enough to accept public deposits. So they are talking about that. Check if public deposits are within the limits. For such category of credit ratings, this much amount of this much limit of public deposits can be accepted. Likewise, there were regulations which were not in detail in our syllabus, so we need not by heart such upgrading or downgrading credit rating with increase in decrease in public deposits. Or whenever credit rating gets upgraded, the limit also could go up. When it's down, they have to, what do? They have to decrease such public deposits. When okay, when the credit rating was well below such credit rating, which it cannot accept any kind of public deposits, what do it has to do? What it has to do is that it should immediately stop accepting public deposits, and all the existing deposits run to maturity, and within 15 days, a report has to be submitted to regional office of RBI where the NBFC has registered. They have to test the, auditors have to test the check interest calculations and regularly paying, whether they were regularly paying as per due dates or not, and accepted public deposits only after a written application formed by depositor and verified deposit register. Okay, it's all about, it revolves around, if you see, revolves around the credit rating and public deposits, right? Yes. And now here is a prudential norms. Compliance of Iraq and AS and provisioning, etc. Ensure that Board of Directors granting demand or call shall have frame and implement a policy. Access if prudential norms are followed. NPA income was recognized only on realization. You have to check if an NPA was regularized only as per the directions. We have to classification of frauds by NBFCs. The mnemonic that were given here is microphone. Whenever you find any mnemonic in PDFs or such, you might guess that these might be asked as a direct question and there's no explanation that was required. So you have to focus mainly on recreating it in your examination sheet. So microphone is like misappropriation, and CR is criminal breach of trust. For the fund, it's fraudulent encashment through forged instruments, fictitious accounts, manipulation of books of accounts. It deals mostly with the instruments, accounts and books of accounts, etc. And U stands for unauthorized credit facilities. N stands for negligence and cash shortages. And here I stands for regulatories in forex transactions. There was a star here where for such forex transactions and negligence in cash shortages, if fraud is more than fraud, it was regarded as a fraud. When the cash shortages or the irregularities in forex transactions is above 10K, and if 5K, if detected by management or auditor and not reported on occurrence by cashier. Okay, and the C here is cheating and forgery. So here comes the next part, audit checklist. Audit checklist, what you have to do when you have audit checklist mostly revolves around the balance sheet items and P&L items. If you have a mnemonic or normally picture of the balance sheet or P&L account, you could easily write 6 to 7 points out of these. Mostly what do we find in NBFC balance sheets? Loans and advances, public deposits that were accepted, provisions that were created, and if it had some investments as per RBI, right, the dividends that were there, and any kind of subsidiaries or associate. Why there was subsidiaries and associate that were mentioned here is because of this NOFHC, a non-operative financial holding company, because the category of NBFC is there. Here we have included the subsidiary and associates and any kind of interest that was charged and charges that were paid, etc. And that's it. We'll see. Physically verify all shares and securities held by NBFC. Okay. Not advanced any loans against its own shares. Have we seen this point before? We have seen this point before is that differences between banks and NBFCs. Can it draw checks on itself? No, it cannot draw checks on itself. Likewise, it cannot issue loans on its own shares. Similar point, a kind of similar point. Dividend income declared by companies duly received or not. Okay. Board minutes in purchase or sale of investments, regarding investments. Check bills or contract notes from brokers. When there were a purchase and sale of investment, obviously we get our contract notes from brokers, right? And list of subsidiaries and associates because of that. Last category, charges received or paid, obtain balance confirmation from parties, verify if any adequate system of proper appraisal and follow up of loans and advances. Here comes loans and advances. All investments, associates, charges, and shares and securities, and here comes loans, and check classifications of such loans and advances. That's it. Something, few points about investments and charges and loans and advances. There you go. You get 5 to 6 points of audit checklist. Now, what's the duties of auditor? What's the responsibilities of auditor? As per 45 MA, RBI Act, NBFC, which accept public deposits. NBFCs, can they accept demand deposits? No, they can only accept term deposits. Has to furnish statements and information to RBI. Okay, auditor has to check for such compliance, and if not satisfied, have to give report to RBI and board. The board here is company board of directors. And what all the matters that have to be included by auditor in auditor report, in audit report. With regard to all NBFCs, that is general points. These were general points. And this is with regard to the NBFC that's accepting public deposits. And these are the points that were specified for the NBFC that's not accepting public deposits. We'll see what's in generic, what we could report in an audit report. If it has valid COA, certificate of registration, we have seen how registration and net owned funds were so important, right? And are they entitled to continue to hold such certificate of registration, and whether the net owned funds requirement was met or not. Every NBFC has to file a certificate from its statutory auditor that it is eligible to hold COR within 1 month from the date of finalization of balance sheet, and not later than 30th December. This is in 31st December, with some due care, that's 30th December. This is what the auditor has to report in its audit report. This is the duty of the management, right? After the auditor has given such certificate, it has to be submitted within 1 month from date of finalization of balance sheet, but not later than 30th December. And for the NBFC that's accepting public deposits, we might have already known on what points we have to write that regarding public deposits, credit rating, provisions, etc. Net owned funds is to deposits, it has to be in the ratio of 1:20. If you have 1 rupee of net owned funds, could accept 20 rupees of deposits. Accepting deposits without minimum credit rating, and such credit rating is credit rating agencies. Whether the NBFC is accepting without minimum credit rating, we have already seen here that if the NBFC accept public deposits without minimum credit rating, what it has to do, immediately stop, and all existing go to maturity, report within 15 working days to RO. So here is saying the credit rating, whether they were issued by a credit rating agency which was listed in compliance of CRAR ratio in form NBS 7, violated any restriction on acceptance of deposits, okay, defaulted to depositors, Iraq norms, compliance of liquid assets requirement more than or equal to 50% of fixed assets, and in NBS 3, returns to RBI NBS 1. That's it. So all about few reports that have to be submitted, and mostly about net owned funds and deposits ratio, and about credit rating. That's it. You could get to know. NBFC not accepting public deposits. It revolves around the public deposits itself, whether the board has made any decision with regard to accepting of public deposits or not, whether the board resolution to accept whether they had any board resolution to accept public deposits or contravened by accepting public deposits, Iraq norm, CRAR ratio in NBS 7 and reports, and whether we have already mentioned it before, right? The microfinance institution, whether it's correctly classified or not, and or what all the extra points that have to be there by auditor in audit report is reasons that has to be stated for if they have given any qualified statement, they have to give reasons for that and have to obligation, and they have also an obligation to submit an exceptional report about the company not complied with. And that's it.
Today we are going to discuss about the fiscal laws. This is often we'll leave it as a choice because there's something so much to remember, so much to like by heart and memorize, right? But we'll just discuss in such a way that we need not memorize all the whole 3CD and the clauses and all. We'll just remember how easily we could write. If we understand anything, we need not memorize that. It comes from our heart. We need not by heart that. And with that said, we'll just discuss 3CD, but for a change, we will discuss it from the below. From the last class, that is 44th class, there were only 44 clauses, and these were few important clauses. You need to just revise it just before the exam. You have to really memorize that. You have to really go through these clauses and don't see to memorize that so that we could write it in our examination. If you see all the past question papers, all the MTPs, RTPs, all the questions were asked from only these clauses. Okay, with that said, you are 70% secure that you could write that question from the fiscal laws if you had given an examination. You need not leave it for choice because any question, even if it's for a 1 mark, it weighs so much mark for a question paper. It's important because it carries some marks. But how you have to study is like where to leave or what not to study and what to study. You see, remembering all these 44 clauses just 1 hour before the examination could leave with you a lot of stress for just the 4 marks there. But just 10 to 15 clauses here doesn't make any so much stress. Now we'll discuss about 44 clause, breakup of total expenditure of entities, whether they were registered or not registered under the GST. First thing, we have to write the total expenditure of the entity and expenditure in respect of entities registered under GST. That is, whom we bought from were registered under entities. And first thing, we have to give segregation like exempt from GST. What all the purchases we have made from which are exempt from GST. That is, you see, the purchaser, the supplier of exempt goods may be registered, not registered. If he solely supplies only exempt goods, then he need not, there's no implication for him to register. But if he sells both exempt goods and registered goods, he has a liability to get registered, right? That talking about this here, that is, if you bought some exempted goods from the registered entities, you have to mention it here. And if you bought from composition scheme or composition dealers, you have to write it from here, and other registered entities, you have to write it here. All the three were entities from registered under GST, and the total payments to the registered entities. The summary of all the sum of all these three things here, and the expenditure that is relating to entities not registered under GST. That is, the difference between these two was this, and that's it. And we'll move on to the next clause. Yeah, but before that, I want to tell you that this is an important clause number. Why? Because it was kept hold till 31st March 2022, and it's going to be applicable for the first time for this March 23. That is March 2023 for this financial year end. So this is an important clause that the ICA may test you. Under clause 43, we have to check whether the SC or parent entity or alternate reporting entity is liable to furnish report under section 286(2). What is 286(2) talking about? The CBC report, that is a country by country report. What we have heard this in international taxation BEPS action plan 13, right? Yes, they're talking about the same thing. And if as they are liable to report that report, CBC report. Please furnish the following details: whether the report has been furnished by the entity or not, whether they're asking about the compliance of reporting that, name of the parent entity and the name of alternate reporting entity and the date of furnishing of report. In what report they have to submit? In form 3 CEAC they have to submit. You need not remember that form number. I'm just
giving a brief up of these things to get retrieval for the firm numbers in your international taxation revision. And in clause 42A, whether the SC is required to furnish Form 61, 61A, 61B. Whereas Form 61 is filed when the deposits or withdrawal were more than or equal to 50 lakhs. 61A would be that, and Form 61 is the SC has only agricultural income and they do not have any other chargeable income, only exempt income. 61B is when they file SFTs, the Statement of Financial Transaction. Most banks do that, whether SC is required to furnish those statements or not. Yes or no? If yes, what they have to do? They have to give income tax department the identification number, might be the PAN number, and type of the form, and the due date for furnishing that, and date of furnishing, and whether the form contains any information about all the details. If yes, please furnish the details that are required to be reported. And this is with regard to clause 42. What? This is also an important clause with regards to Form 61, 61A, and 61B. And please furnish the detail. And now we'll move on to clause 41. And in clause 41, they talk about the demands that were raised and the refund that have been issued to the entity that were other than from Income Tax Act and Wealth Act. And with regards to 40 clause, they are talking about some details with regards to turnover, profit, and stock. Total turnover, gross profit, net profit, stock in trade, and materials consumed if it's a manufacturing entity. And that's with regards to 40. And 39 is whether any audit was conducted under Section 72A of Finance Act 1994. What is 72A is service, or if for the service entities, they have failed to declare and compute the value of the taxable services that they're providing, then the service audit would be special audit. Service audit would be on that entity with relation to the computation of valuation of the taxable services, etc. Whether that audit has been conducted, or for under clause 38, whether any audit under excise department, excise act had been conducted or not. And under clause 37, any cost audit that was carried out. And for all these three types of audits, whether any disqualification, disagreement of any item, value, quantity that was identified by such respective auditors, they have to be given 37, 38, and 39. And in clause 36A, whether the SC has received any kind of dividend. If yes, then the amount received and the date received have to be reported. And with regards to 35A, if it's a trading concern, the quantitative details have to be given: opening stock, purchases, sales during the previous year, and closing stock, and that's short or excess. This is mostly like a what? Trading profit and loss account, right? In respect, it's a manufacturing concern. What are the quantitative details it has to be given? It has to, you see, in clause 40 also we have been reporting few things, right? This is on the date of balance sheet. It's with regards to the turnover and profit only the previous year, but with regards to here is only the data that is regards to only previous year. That is the raw material. That is so much in detail here. 40 is just a block of amounts. This is, they have asked so much of segregation to it. Opening stock, purchases, consumptions during the previous year, sales, closing stock, yield of finished goods, and percentage of yield, any short or excess. And for the finished goods, opening stock, purchases, quantity manufactured, sales, closing stock, and shortage and excess. You have to write what, you need not memorize all these things. You have to write what are all the things that were in the question paper, with what are all the things that you have to put in the P&L account. That's it. Nothing much more than that, except the yield of financial products and a percentage of yield. Only these 2 points have to be remembered once. And others, all the things, you have been preparing financials like P&L account. You have prepared hundreds of P&Ls and hundreds of balance sheet by this time, right? So only the 2 extra things were only this. Others all that they have given in the question paper that were to be put in the P&L and balance sheet, you could write it. And now with respect to 34 clause, we have all details about TDS and TCS only. With respect to the amount of TDS or TCS, that is clause A, and with regards to the TDS and TCS statements, that is clause B. Okay, we'll see first one with regards to the TAN number that they have, and the section number and the nature of payment, that is, say, like 195, 192, etc., salary or remuneration, etc., for fees or professional services, and the total amount of payment or receipt of nature of specified in column 3. That is, if you think we'll go with like a salary under section 192,
all the expenditure, all the P&L expenditure that was occurred during the year have to be in column 4. Okay, and on all the salary we don't deduct TDS, right? All that which is applicable, which is required to be deducted TDS have to be in column 5. Okay, on all of that, how much we have deducted, what is required to be deducted, that portion, on what we have deducted, how much we have deducted. If any was deducted, in short, we have to write that amount here, and after that we have to write beside those two columns the amount of tax deducted. That's it. What are they talking about? First thing, the TAN number and the section number and the nature of payment there. As per our example, it is 192 salaries, and in 192 salaries, after the nature of payment, all the expenditure that the entity had incurred, all the expenditure entity had incurred in its P&L account have to be written it here in column number 4. After that, which is required, and segregate this, and which is required to be deducted TDS, have to write it here. And after that, how much we have deducted from the required to be deducted. Okay, how much of amount we have deducted, we have to write it here, and how much we have not detected or deducted less was in 8. And beside that, beside both the columns, we have to write the amount of tax that was deducted, the TDS deducted, and the tax that was deducted or collected which was not deposited comes under last column. And that is with regards to TDS. And with regards to the statements were the TAN number as usual, and the type of form, and due date for furnishing that, and the date of furnishing, and whether the statement has all details or not. If not, provide the details which were not reported there. And that's with regards to clause 34. And with regards to clause 33 is whether the entity is claiming any kind of exemptions under chapter 6A like ATC, etc., and under section 10A, 10A like says, etc., the section and the amount that was admissible for claiming, etc., have to be reported in clause 33. Now we'll see 32nd clause with regards to details of brought forward losses and the depreciation allowances. What all the details have to be given? The assessment year and the nature of loss, whether it's a brought forward loss or an absorbed depreciation, the amount as per returns, and the allowances that are not allowed here. Not allowed if the company opts for 115 BAA, BAC, or BAD, and the amount that was adjusted by the withdrawal of additional depreciation under section 115 BAC and BAD, where the additional depreciation is not allowed, right, in few sections. And the amount as assessed will have to be given. This is the eligible amount. And under clause 32nd A, right, and in B was where a change in shareholding of the company, why they're talking about the change in shareholding of the company. If the shareholding was more than, if it gets changed or substantially changes more than 51% or more than equal to 51%, then the brought forward loss of the previous years would not be carried forward under section 79. That's where they're asking about the change in shareholding. Regards to that, whether the SC has incurred any speculation loss under 73, or speculation loss can be only set off with speculative income. Speculation is like horse races, etc., betting, and trading of shares, and where the SC has incurred any loss under section 73E. 73E is like specified business, that is the business that were covered under section 35 AD. Okay, those one. And in case the company has any deemed speculative business under section 73, have to be reported it here, and that is with regard to clause 32. Now we'll see clause 31. In clause 31, we have a lot of sub clauses that were given here. But in order to sum up that into very simple portion, first we have to learn these 5 words. This is set A, that is check bank draft, RECS, that is electronic clearing system. And set B, account payee check and account payee draft. You have to remember these two, and we'll use them to make this clause 31 so simple. In A, what is with regards to 269 SS, where you have particulars regarding the loan or deposit that exceeds the limit. What is the limit? 20,000. 269 SS, loan and deposit. And again here in B, 269 SS. But here it's specified sum. Why they have put specified sum here? It is like advance that was given for transfer of like immobile property, etc., right? Those advance sums and on any other amount, like an advance, that was covered under here. A, 269 SS, loan or deposit. B, 269 SS, specified sum. Okay, now we'll see BA here.
With regards to 216 and ST, that is receipt of amount, right? That is 1 lakh. Receipt of any amount, we have to write it in BA. And in BB, what we have to write? 269 ST, again with respect of receipt of the amount only. But what's the difference between BA and BB? Here comes the two sets usage here in clause in BA, that is otherwise than by check, bank draft or electronic clearing system, that is set A, otherwise than set A. In BA, 269 ST of the amount received otherwise than by our set A. In BB, otherwise than our set B, that is account payee check and account payee bank draft. Okay, that is with regards to that. We'll go in detail what all the details have to be given later. In BC, 269 ST. By this time, you would have understood that all the sections were repeating twice. 269 SS twice, 269 ST also have been repeated twice till now. But 269 ST here comes 3 times. That is again with respect to the payment. That is, you see, receipt. For the receipt, it has repeated for 2 times, for 2 sets. And here, for the payment, it has again repeated for 2 times for the same thing. Otherwise than for set A, otherwise one for set B. Okay, 2 times, 2 times. Okay, and now C, and we have D and E here with respect to 269T. Okay, third one 3 times. First one 269 SS 2 times for the loan and deposit, and 269 SS for the specified sum 2 times. And after that, BA, ST receipt other than set A, 269 ST for receipt other than set B, and second time 2 times 269 ST payment other than set A, 269 ST payment other than set B. That's it. And now we have move on to the 269T, that is repayment of the loan in cash, that is 20,000 the limit is with respect to repayment of loan 269T, where the repayment was made as per set A, and this is the repayment was received. You see, for D and A, it is received. Okay, it is received otherwise than set A. Okay, this is made as per set A. This is received otherwise than set A. Okay, and this is also received only, but otherwise than set B. That is, they will have received by through a check or bank. That is other than or account payee check or account payee bank draft, that is otherwise than set B. Okay, made otherwise, made as per set A in what? C. D, received otherwise than set A. E, received otherwise than set B. And with that said, we have completed our 31st clause. And what all we have to we have to give information is with regards to the name, PAN, and the amount of the loan or amount of the amount that was received or made or repaid. That's it all we have to talk about. And regards to 30C, whether the SC has entered into impermissible avoidance agreement as per section 96 during the previous year, if had agreed to the such arrangement, you have to write about the nature of that impermissible avoidance agreement and the amount of tax benefit regards to that. And with regards to clause 30B, when the SC had incurred expenditure, that is interest expenditure, exceeding 1 CR rupee, then as per section 94B, again international taxation, where only 30% of that interest was allowed when that was more than 1 CR, right? So we have to write the details with regards to the amount of interest and EBITDA and all. This relates to that. And as per 30A, whether there were any primary adjustments that were happening or any kind of adjustments that were made, and the amount of that has to be repatriated to India, and the interest if not repatriated. Yeah. With regards to 30th clause, the details of any amount that was borrowed on hundi that was otherwise than account payee check. And with regards to 29B, where any amount that is included as income chargeable under the head other sources were referred into section 56 of 210, that is other source of income, right? They are talking about the other source of income there and the nature of income and the amount that was included there. And 29A was whether any amount that was included under the head income from other sources under 56 to 9. What is those 56 to 10 and 56 to 9 were? That is 10 is the gift that was more than value of for
50,000 and all. And for 9, it is the forfeited advance that was received and the property was not charged. And 29th clauses where in the previous year the SEC received any consideration for issue of shares which exceed the fair market value, we have to write here. And whether the in previous year received any property for an inadequate consideration. If so, we have to mention the details here. And in clause 27A, the central value added tax credits and the value added tax credits, any credits were there, we have to mention it here. And the particulars of income expenditure prior period credited or debited to the profit or loss account with regards to such. And in 26th clause, in respect of the sum referred in clauses A to G of section 43B, the liability of which pre-existed on the first day of the previous year. What is 43 and 43B? 43B talks about the expenditures that were allowable in PGBP chapter. And there was a whole case scenario with regards to this, and we have explained that in detail there also. Okay, what they are talking about is that the expenditure that is like pre-existed expenditure that is outstanding that were paid during the previous year and not paid during the previous year. You see, paid during the previous year, that is the current year for which the tax audit was being prepared, and not pending. That is outstanding is still outstanding for this year. Okay, which were incurred in the previous year. That is current expenditure in the PG. And paid before the due date of filing of ROI, they have paid. And if not paid, that is, they were still outstanding here. Next year, this outstanding only will shift to here. Okay, that's what they're talking. This is a very important clause one have to see. Any amount of profit chargeable to tax under section 41 has to be written here, and the amounts deemed to be profits under section 32 AC, AD, AB, ABA, etc. AC have to be written it here. And the particulars of payment made to a person with regards to 40A2B and the interest that was admissible under section 23 for the micro, small and medium enterprise have to be in 22. You see, something which I'm not so much stressing about is something that was not so important. Now we'll move with our favorite clause here. Yeah, 21. This is the biggest clause, and after this everything goes super fast. Okay? The first one is please furnish the details about the amounts debited to P&L account being in nature of capital, personal, advertisement expenditure, etc. Obviously, capital expenditure is something we have to not put it in P&L account. That's why we are asking. Personal, we have to not put that. What are the something that we have to with regards to advertisement expenditure? We'll see. Capital expenditure, yes. Personal expenditure, okay. Advertisement expenditure in any souvenir brochure published by a political party, okay. We have to not advertise in any souvenir or brochure or pamphlet that was published by a political party. That is what the qualification for advertisement. Okay, if advertisement was like this, then you have to report it in 21A. Okay, expenditure incurred at clubs being entrance free and subscriptions, and at clubs being for cost for club services and facilities used. This is the entrance fees, and this is for the facilities that we'll be using for any clubs at clubs. Okay, expenditure by way of penalty or fine or violation for the time being enforced, the penalties also have to be given here. And any other penalty which was not covered above. This is the any law for the time being enforced. These were not covered above means that have been stopped being enforced, but you have paid penalty for that. Then you have to write it here. And the expenditure for any purpose which is an offense or which is prohibited by law has to be written it here, like any kind of bribes, etc. will be here. And that's for A. With regards to that, all the capital, personal expenditure and advertisement with regards to the brochures on the political party and expenditure at clubs with entrance fees, subscriptions, cost of the facilities that were used, and with regards to penalties for the acts in force, for the acts not in force, and any other for which prohibited by law. 3 kind of penalties, and that's it. And of B, inadmissible under section 40A. That is, these expenditures were not allowed as per PGBP Act, PGBP chapter. Okay, the payment were non-resident. With regards to that, details of payment for which tax was not deducted, 100% disallowed was here. And details of payment on tax has been deducted but had not been paid. That is, after deduction, they has to deposit with government within 7 days, right? And all the due dates, if they have not done, this has to be here. And for details of as payment referred in subclause 1A, that is this, details with regards to that, and the details about the tax that has been detected and has not been paid with within the due date of the ROI, within submission of ROI has to be given there. And the amounts debited. Don't put so much concentration on the these points. These anyway we could write, because anyway they will give us a situation or something, or we assume a situation. What we have to write? We have to write about the name of them, or the tax has to be detected, the amount on which it has to be detected, date we have to detect, on the payment we have to make, or the due date. These are something so generic. Don't put so much effort on writing this. You need not write whole thing. If you write 3 to 4 points, they will just reduce a mark or so. And for that 1 mark or so, don't put so much stress, and don't make a mess over here. Okay, this is so simple. Remember all the things what you have to remember. Okay, what is important. Okay, and amounts being debited. Don't put so much concentration on all these things. Okay, remember as a human how much you could remember. Amounts debited to P&L account that were interest, salary, bonus, commission, which were inadmissible under section 40B, 40BA. As we know, only a certain portion of the remuneration or interest like say 12% or bonus or some commission, that they have some limits, right? Other than that, were inadmissible here, so we have to write it here. T for disallowance with regards to 40A3, we all know that more than 10K expenditure in cash, that has to be disallowed here. And with regards to that, on basis of we have to provide details with regards to the payment and nature of payment and amount and their name, etc. And this is also same thing. Provision of payment of gratuity. The gratuity is only allowed when it was paid before due date on the day, so it has to be given here. If not paid, any sum of the SC employer not allowable under section 49A9 was something that is expenditure with regards to any trust or contribution fund which was not approved, was given here. Particulars with liability of any contingent nature has to not be in financial statement. There had to be only provisions. Contingent liabilities have to be given in disclosures. Okay, the amount of deduction inadmissible under section 14A, that is expenditure on income that was not form part of the total income. You see, on any income, in any income that is which were in the return and you're paying tax for it, you can claim expenditure on that, but you cannot claim expenditure on the income that were not showing in the return itself. Okay, and amount inadmissible under section 36(1)(3) is with regards to interest on the capital that was borrowed, and with regards to that, this is what for 21 clause. That's the biggest clause we have completed, and move to the 20th, as any sum paid to employee in a bonus commission for the services rendered by him, otherwise payable by him as profits or dividend. You see, in FO, we have come across few problems such as like if this manager had crossed this amount of percentage of profit, this portion, a portion of that would be distributed to him likewise. This is also talking about the same thing as with regards to you're sharing the profits or you're sharing a form of a dividend, but you're giving it as on the name of a bonus or commission there. All that amount has to be written here. And with regards to any contribution received from employees, mostly like PFs, etc., like 12% there, 12% here, right? Those details have to be given it here. And this is all admissible. We in 21 we have written all the inadmissible, right? We'll write all the admissible expenditure here with regards to the section down there. And 18th one is particulars of depreciation that was allowed with regards to the assets and all, and any adjustments, additions, etc. has to be given here with regards to depreciation, 18th clause. And the 17th clause with regards to compulsory acquisition and all, but it was not there in effect, like it was substituted by some rules over here from that. So you need not read the 17th clause. And with regards to 16th is amount not credited to P&L account, which should have been credited. And 15th is the following particulars of the capital asset that was converted into stock and details of that. And with regards to 14th, the method of valuation of closing stock and any kind of deviation from the method of the valuation. Okay, and this with regards to the valuation of closing stock. And with 13th is the method of accounting that was employed, and whether there have been any change in the method of accounting that was employed. And with regards to if change, whether they have increased profit or decrease in profit, the impact on the things and any adjustments there and the ICDs that were followed. If any deviations there, any adjustment, the net effect of them have to be also stated there. And 12th clause is the P&L account includes profits of any kind of presumptive basis. We have to mention it there. And with regard, and in clause 11, we have to mention whether the entity has to maintain books as per section 44A and the list of the books it's maintaining, and the list of books and the nature of the relevant documents that have been examined. And 10th is the nature of the business or profession and whether any change in the such nature. And in 9th, whether it's a firm or a person, and the number of partners or members, it has any change in the profit sharing ratio, etc., which have to this. And in part A of 3 CD, all the basic details like the relevant clause for 44AB for which audit is being conducted, the assessment year, previous year status of that PAN, and whether the liable to pay indirect tax like excise duty, service tax, GST. If so, that number, PAN, address, and name. And that's it. We have completed our form 3CD. And now we'll move to our next part, that is concept takeaways. That is, these are all the important clauses that you have to remember and revise it one day before the audit exam. That's it. You have to revise it. And you need not revise more than this because no question has been asked till now. Apart from these clauses, you have to check. You may go and check all the previous question papers and all the questions that were asked from this clauses only, and you have to just revise it once. And we'll just move on.
Special aspects of auditing in an automated environment, CA Final syllabus. An automated environment is an ecosystem that combines people, process, and technology within a business environment. It's driven by computer-based systems, information systems. We know that automated environment is something which auditing more efficiently. And people, and what does it consist of? It consists of people. It consists of some predetermined process that has to be followed by such people and technology through which they follow the process that were there. And while talking about technology, more technology is nothing but some applications through which they access the data that was there and or do the process that was defined by such people. So business applications are of three types. There's package software, small ERPs, and ERPs. Package software is mostly opted by micro and small enterprises which are not customized or not mostly tailor-made. That was like Tally and QuickBooks. Small ERPs are for small and medium enterprises which have some not tailored one but have some specified or custom modules depending upon the area or industry that were working, that they were in. ERPs were used by mostly medium and large enterprise which were tailor-made like SAP, ECC, Oracle, Business Suite, etc. An automated environment consists of the following layers. I think you could expect this as a direct question or an application-based question where you have to point out what are all those database. We go from micro to macro level. Database or operating system, application, networks, and physical and environmental physical and environmental. Database, if you think of a database, the PDF that you're reading right now, operating system is a Windows that was in the system, and application is the software that I'm using to open the software that I'm using to open that PDF. That is like would be a robot, etc. And network is the network through which we are connecting. LAN is used mostly in big corporates for private networks. WAN is the Wi-Fi that we normally use. VPN, virtual private network.
Physical and environmental is the keyboard or mouse or monitor or the camera that we are using right now. The next topic in automated environment is the real-time environment. The real-time environment is that it gets initiated, processed, and recorded immediately, like a GPA transactions. As soon as we initiate that split wise bill 30 rupees to your friend, and it gets immediately processed and reflected as credited to your friend account, and then recorded in your books and his books.
So, what are all the components? What are all the IT components that were used to make that real-time environment live? Is that application like GPay or Paytm or Beam UPI, etc. And middleware is the bank servers, and networks is the Wi-Fi or mobile data, and hardware is the mobile or the laptop that your mobile laptop tab that where you that through which you are accessing your applications. We have seen this real-time environment in individual point of view, but for the corporates, we are auditing corporates, right? For the corporates, it would be that GPay would be Oracle Business Suite or CBS, like for the banks and SAPs, etc. And middleware is the networks or source website web servers like Oracle Fusion, IIS, Apache. What is mostly thing middleware is that, in order to give you a brief point, it's like if you have various branches and wanted to know which product is out of stock, or so that you could communicate with your supplier. It's like your supplier network and your retail branch network and your head office network to initiate the transaction have been connected. This is a middleware. Through how do you connect? It's again Wi-Fi, local area network and wide area networks. For the example that we have seen for the retail shops and suppliers, we use wide area networks. For the HO like purchase department and accounts department, uh, we use private networks, local area networks. Hardware, obviously data center, servers, storage devices, monitors, etc. Any failure in one component, applications, middleware, network, any failure in one component could render real time system unavailable. Obviously, right? We have so bring it back to a GPay transaction. Bank servers not there. Mobile data was not there, and again, you don't have mobile itself, and you do not have any kind of applications. The most real-time and environment and accessible through public domains and internet, hence vulnerable to network and cyber attacks. Why this point? This point is for the risks that there were like restrictions. The restriction, so that if any component that was not there in the following components like application, middleware, and networks, real-time system is not available. That's a restriction that a real-time real-time environment has, real-time system has. And what is the risk that real-time system has is that network and cyber attacks. This is a restriction, this is a risk, and how to overcome this hits here. Identify and resolve the issues and failures. You have to constantly monitor. This is what the remedial action is. Understanding and documenting the automated environment. The next chapter is, have you heard like similar things like in standards in 300 series, right? We have to understand and understanding the business environment, including internal controls. SA 300 series. The auditor understanding the automated environment should include the applications that are being used, IT infrastructure, IT components, organization structure, policies, IT risks and controls. So these two are like macro. This is a gray area, that IT risks and controls. Whenever there was an IT, there have to be a special consideration for the risks and controls that were being used. Mostly you could see that in audit of banks, like mostly. Or they were merely telling about the components, applications, infrastructure, organization, policies, and risks. So easy. And SA 230 is like documenting automated environment. How do you document? I think if you're in Big Four article, I need not stress more about documenting than you all know. Like real-time environment components, IT components, you have to, what are you have to document? It's the same thing like IT components. What are the applications that are used? What is the middleware they're using, and what are the networks, and what's the hardware they have? Considerations for automated environment. For any audit, there were 3 steps. There's planning, execution, and completion. That was same for all audits. So what's the special thing is that those steps were also the same, like risk assessment, that is 200 series, understand and evaluate 300 series. That's for operating effectiveness is also like 200 testing and of operating effectiveness. It's nothing but the internal efficiency, internal controls efficiency. This is 700 series. And what's the risk assessment that we have to see in an automated environment is like, what do they do? What do we see in 200 series? We see were there any audit risk from the financial statements or the audit reports of previous auditor,
significant accounts and disclosures, and quantitative and qualitative considerations. All the key points in 200 series. We're going to soon discuss the 200 series. It's not about the direct question, it's about the applications questions. We have to know what are all the key points or what are the topics that would get used in this 200 series. When have to we mention that question? When have to mention that relevant points in 200 series in that particular question? We're going to soon discuss that. But before that, we just when financial statement assertion. These were the assertions that the management has been given. Identify the sources of misstatements. Written representations from we could get that from written representations from the management or TCWG, and the risk of IT. Wherever there was IT, you have to write like a risk. And for the second step, understanding and evaluation, you have to document the business process in flowchart narratives and risk control matrices. This is a single point, but in a different kind of way. Understand and design the process through walkthrough. This is a saying, they were saying the presentation portion here. And here they were saying the process that has to be followed. And here entry-level controls and segregation of duties is internal controls and general IT controls and application. We're gonna soon in this video go more detail about that. Testing of operating effectiveness, it's like whenever there was an internal controls testing, we need to have nature, timing, and extent, and source of reliability of the source data, and testing of report, sample testing, and competence of independence of staff. Or why such independence of staff was more is that the frauds that the staff does is easily identified than they were properly curated by management. They were very well designed so that it couldn't get that. We have to test the independence of the staff also. Reporting is a 700 series. You need to have the evaluate control deficiencies or its internal control deficiency, as we have been testing the internal controls all over here, and any significant deficiencies and material weaknesses, and these two were all internal controls. And remedial, after we see after we tell something that was risky or restrictions, like here, like this was a restriction and this is a risk, we immediately said the remedial action. Likewise, when we find out some deficiencies or weaknesses or any kind of risks that were there, we immediately say the remedial actions. And internal control memo or management letter, internal controls memorandum, and then auditor's report. The second thing is enterprise risk management. Due to dynamic environment, the associated risks have increased and the companies have continuously managed the risk. Obviously, the main duty of CEO is to mitigate the risk and manage the risk of the business. And what are all the risks that we have to consider is this, technology and security. Why there was security and technology? Because of privacy, because of privacy concerns. Here, what they have said, network and cyber attacks, that was what security of data. Environmental risk is for the carbon footprints, environmental risk, the carbon footprints that were, and regulatory compliance. When there were regulators, we have to comply in something. So there was compliance risk also exists whenever there was a regulatory. Market risk, operational risk, financial risk, credit risk, etc. ERM is a formal program that is implemented across an enterprise for enabling risk management. Risk management is a combination of process, people, tools, and techniques. Have you heard these three before? It's an automated environment, is an ecosystem, combines people, process, and technology. Here, the same thing, but they were telling it as tools and techniques within the company to identify, assess, respond, mitigate, and monitor risk. Any risk that has to be identified. Go to 200 series. Any risk that has to be identified, and we have to assess that. That means quantifying whether it's quantifying like more risk or not, and what do auditor has to do? Auditor has to respond. And what meetings? Whenever we see, we have to what? Mitigate or put remedial actions. With remedial actions, we could mitigate that. And then for consistency, it's not a one-time deal. It's a continuous process. Business goes on continuous, and remedial actions also should be monitored. PRM is
So risk management is a combination of process, people, tools, and techniques through which company it identifies risk, assess risk, respond to risk, mitigate risk, and monitor risk. ERM is implemented by Board of Director TCWG or employees by way of board report, internal control report. Also, ERM is most common for implementing suitable ERM. It's just an information who is going to implement that. When there what is the responsibility, who has to implement that, right? Considerations for risk assessment process. Anything risk, whenever there's a risk assessment process, the risk stands in the first place. We have to prioritize the risk, and risk has to be identified. Identify the risk and indicators, like you have to assess what you have to assess, how you could assess. You could assess by risk indicators, risk appetite, risk scales and scores, and then assess the risk. With the use of that, this is the second step that has to be done. And how do you respond? You respond to the use of data and metrics and qualitative and quantitative factors, and then mitigate by benchmarking and key performance, and then monitor the risk. This is how you maintain or you have to see the risk assessment process. First, you have in order to investor, if you're a portfolio manager, you have to identify first your investors' risk appetite, or how much A amount he wanted in T time. Likewise, define the business objectives and goals, and identify the events and achievements of business objectives. The same with the market trends, stock market trends, or the new instruments that have been introduced into the market, and assess the likelihood and impact. Like increase in interest rate or decrease return, or might likewise. You have to assess such events and impact to our objectives or goals. And whenever, as we all said, was a key rule, whenever you find any restriction risk, you have to respond and then mitigate the risk, and then assess the residual risk, because after mitigating, you still left with some risk. It's like mitigating, not eradicating. Consideration while assessing the risk assessment. Entity level aspects of risk, like governance, organization, and management of IT. Risk in IT process and procedures have been followed. IT risk at each layer of automated environment. Have you come across this? If so, here it is. Understanding and documenting automated environment, organization policies, and IT risk. Right? The same way. Controls on to mitigate IT risk. How do you control to mitigate IT risk? Is that whenever there's IT, there's risk. Whenever there's a risk, have to respond and then mitigate that risk. How do you use that is general IT controls, application controls, IT dependent controls. General IT controls, or also known as pervasive controls or indirect controls. General IT controls are policies and procedures that relate to many applications and support the effective functioning of application controls. They apply to mainframe, miniframe, and end user environment. General IT controls maintain integrity of information, security of data over pandas. What are the pandas? Program change, application system acquisition, development and maintenance, data centers and network operations, access security, system software acquisition and maintenance. Okay. In order to find a situation for us to relate is that what are those who all could access the systems and what are the applications that they could access in an overall business environment. Application controls, they include both automated and manual controls that operate at a business process level. Automated application controls are embedded into IT applications and help in ensuring the completeness, accuracy, and integrity of data in those systems. IT dependent controls, they are manual controls which make use of data, information, report system from IT systems and application. Its design and effectiveness depends upon reliability of source data. In order to relate this general IT controls, we could think of our Tally, like who could start a company in Tally. And for the application controls, who could enter the entries into the Tally, and IT dependent controls is the who could use the reports or data in order data into such Tally. Entity level risks and controls. The controls that operate across the company, whenever any controls that operate across the company, they are pervasive controls. And
at all levels from board and top management to department and transaction level. PLCs are a part of internal control framework and relate to internal control components other than control activities. PLC system nature so required application for more professional judgment. There are two types of PLCs entity level controls. First, operate at a higher level than the business activity like code of conduct or prospectus or memorandum, such as a business process, sub-business process, account level at a sufficient level to prevent, detect, or correct in a timely manner. Direct ELCs operate at a higher level than business activity or transaction level, such as business process or sub-business process or account balance level or at sufficient level or at a sufficient level of precision to prevent or detect or correct a misstatement in a timely manner. Example like business process reviews, like we have seen in SCP, right? If you remember that balance scorecards, etc., and any kind of monitoring of effectiveness of control activities in internal audit function. And indirect analysis do not relate to specific business process or transaction or account balance level, so cannot prevent, detect misstatements. They contribute indirectly to the operating effective operation of direct ELCs and other control. Direct ELCs operate at a higher level than business activities or transaction levels, such as business process or sub-business process, account balance level, or at a sufficient level of precision to prevent, detect, or correct a misstatement in a timely manner. Prevent, detect, correct a misstatement in a timely manner. Like business process reviews, in SCMP, if we see balance scorecards, business process reviews, etc., and monitoring and affecting control activities at internal by internal audit function. And indirect ELCs, they actually do not relate it to specific business process or transaction or account balance level. So they cannot prevent, detect, or correct a misstatement. They contribute indirectly to effective operation of direct ELCs, like code of conduct and HR policy, job roles, etc. And the next topic here is that whistleblower policy. So whistleblower policy comes into picture when there was any fraud that was happening in a company. Whistleblower policy through a small questionnaire, and the questionnaire is that we have to first, the first point is that existence, whether the company had a whistleblower policy, yes or no. Is the company documented and approved, whether it was legally enforceable, so it is documented and approved. Has a whistleblower policy been communicated to all employees? The uh, the main beauty of the whistleblower policy comes into existence when it is used by the employees of the organization. So in order to use the whistleblower policy, it has to be first communicated to all its employees, and all the employees should be aware and understand its purpose. It's not that, okay, whistleblower policy is there, but how do you apply that by knowing its purpose and its obligation towards the employees? Has the company taken measurements for training the employees to understand the contents and purpose of all this? Yeah, the employees were aware. If not, employees were there. And what are all the steps that were taken by company to make their employees understand? First thing, whistleblower policy there or not there? It is approved or not approved? Communicated, not communicated? Okay, do they know the purpose and obligations? Yes or no? Does company have taken any kind of training to its employees to make them understand the whistleblower policy? Does the company monitor? After, whenever it's a remedial action, as we have discussed earlier, whenever there was a remedial action, we have to write about the monitoring the thing. Since if you think fraud is a risk, whistleblower policy is a remedial action, and the company has to monitor the effectiveness. How does a company deal with any deviations and non-compliance? Whenever there are obligations, there might exist some non-compliance. How the company is dealing with such non-compliance. And now entity level risk, right? Now you're going to see the process level risk and control. As per SA 315, auditor has to understand the business process that makes, right? So try to not
take gist of this PDF. This was already a gist of study material, and don't worry, no topic or no keyword has been omitted from study material. All the gist have been come. All the gist of study material had come into this PDF. We just why this PDF is that we have a very limited time before the exam. That's just that's just 1.5 day. That's just 1.5 day. We have to grasp as much quickly as possible. We have to grasp the material or revise or retrieve the things as fast as possible. So we have to be more. We don't have time for all the unnecessary things that doesn't matter in the examination. What is in the PDF is completely more than enough for your examination. You have to do question. You could take any question bank. A question bank is not necessary with some particular question banks and all. It's more retrieval process. For the retrieval process, I think Samaya would help further. I think Samaya would bring up with some new remedial actions, because ICA do not award you marks for the number of revisions you have done or number of hours you study. It only award you marks for your retrieval capacity, how much you have put your answer into the paper. So try to retrieve as much as possible. Know what have to be retrieved and what question. That is the main important point. You have to write correct relevant answer for your question in your examination. So you need to have a bit of practice for that question bank. You have to definitely do your question bank after watching the revision video. CA 315 auditor has to understand the business process that makes up account balance or financial statement line item. Process level risks and controls. As per SA 315, auditor has to understand the business process that makes up account balance or financial statement line item. What is a financial statement line item or account balances are debtors, creditors, lands and buildings, travel expenditure, etc. The business process is a sequence of activities. As per 315, auditor has to understand the business process that makes up account balance. How do he know? Through walk through process. We have seen it here, right? Walk through. It might come in an MCQ. It's that. Account balance or financial statement line item, it's like debtors, land and building, that we know. A business process is a sequence of activities that takes place from initiation of transaction, recording, approving, posting and reporting. For the real-time environment, we have seen a similar kind of series of events like initiation, process and record. Here, saying it in a bit different way, but mostly the same. Initiation, recording, approving, posting, and reporting. After initiation, you got recording. Why? Because that we have seen it in individual point of view. Here, it's mostly in the big corporates. You need reporting for everything. You need to have approval for everything, and then reporting. A business process is a business process is typically made up of sub-process, a logical grouping of related activities. It's just a adjective on adjective. The auditor should document this understanding of company's business process and flow of transaction in audit file as per 230. 230, we have seen it somewhere documenting data analytics. Data analytics, it's like analyzing the data or database. Database is a layer of automated environment, which is an integral component of any kind of business. Data stored and processed can be used to get various insights. This data can be useful for preparation of MIS reports, high level of snapshot of business performance. Data stored and processed can be used to get various insights. Obviously, that's right. This data can be useful for preparation of MIS reports and electronic dashboards. MIS reports was like what we CAs do mostly in industries. after we get qualified, if you have been into any event. Generating and preparing meaningful information from raw system data and using process tools and techniques. Have you heard this before? Automated environment, people, process, tools, and techniques. That's technology and tools are. We have seen this in tools and techniques. It's known as data analytics. Nothing but raw data you're converting into meaningful information through process and tools and techniques. Data analytics is an audit, also known as CAT, computer assisted auditing techniques. What are the components of aspects where what are the areas that CAT could be used? Friend seeking, friend fraud, fraud risk assessment, evaluation of deficiencies, non-standard journal entries, control testing, and preliminary analytics. This could be a direct question. You have to memorize the way it is. We find a mnemonic here. It's something that was direct and it has of it. But always remember, you have to retrieve the correct information. You have to retrieve the correct information for that question. That's the main aspect. Fraud risk assessment. For risk assessment, evaluation of deficiencies, non-standard journal entries, control testing, preliminary active analytics. One more time. Fraud risk assessment, evaluation of deficiencies, non-standard journal entries, control testing, and preliminary analytics. And what's the audit approach to use the CATs? First, you have to understand the business environment, including IT 300 series. You have to define the objectives and criteria, identify source and format data, extract data, verify the completeness and accuracy of extracted data, apply criteria on data obtained, validate and confirm results, report and document results and conclusions. 230. 300 series, wherever we started, 300 series and 230. Here we have started with 300 series and ended with 230 documentation. Okay, how do you memorize this? Again, first you have to understand the business environment. 300 starting point and ending point will be the same. And you have to define the objectives and criteria. You have to, because you're discussing more about data, you have to identify the source and then the format of data. And you have to extract the data. Obviously, that might be a raw data, right? You have to extract and verify the completeness and accuracy. And apply criteria is nothing but filters. Mostly, in order to sync it with our day-to-day life, is that applying filters to Excel data and validate and confirm results, report and document. And here is a glossary that we could look it into. Just 2-3 days, 10 minutes a day, we have all this. And that's it for today. And now we'll discuss liabilities of the auditor. In this chapter, we have 4 sections like professional negligence, civil liability, criminal liability, and liabilities under Income Tax Act. First, we'll see what is professional negligence. It consists of mostly the definitions of all. And first thing, they have given a line with regards to that. The auditor is a watchdog, not a bloodhound. That is what the difference between an audit and an investigation. In audit, the auditor throughout the audit will have some professional skepticism and all throughout the audit has to maintain professional skepticism, but he should not be of a pre-notion that already a fraud had already happened and I have to investigate that. It should not be that thing. It should have a questioning mind whether these controls could lead to a fraud or not. That's it. A bloodhound is something like fraud had already happened. This is mostly used in investigation part at all. And negligence, which is culpable. Culpable is something deserving a blame. It was like his blame, or auditor is liable for that blame for professional negligence. And consists of 3 elements. First of all, there has to be anything that was negligent, means he had got some duty or something responsibility and he breached that due to some negligence and all, which led to loss or detriment to the other parties. So this is the definition. You see, if you need not write like this in your examination, you have to write like this. Okay. An existence of a duty or a responsibility owned by one party to the another to perform some act with certain degree of care and competence. This party is the auditor. And occurrence of breach of the duty and loss or detriment that being suffered by the party to whom the duty was owed or a result of negligence. This loss or detriment could be they're talking about might be the shareholders or the regulatory authorities, etc. in this context. Professional negligence would constitute to failure perform duties with regards to professional standards. What professional negligence means, he's doing what duty, he has some professional responsibility and professional duty as per professional standards, but he breached those and caused loss or detriment to the parties. And for that, he got some civil liabilities under Companies Act. First, we'll discuss the civil liabilities. And civil action against the auditor may be taken for claim of damages. Auditor should compensate for the damages he made through his professional negligence. And damages for negligence would be, you see here, misstatements in prospectus under Section 35 of Companies Act 2013 are whereas a person subscribed for securities of a company acting as any statement included. You see, there was a statement included in the prospectus, and a third party had subscribed for the securities like APO or FPO for inclusion or omission of any matters, omission of any litigations, etc., inclusion of any window dressing items like a lot of trade receivables and bogus contracts and all in the prospectus, which may be misleading and sustained any loss or damage as a consequence thereof the company and every person who, you see, who has to pay negligence damages to negligence. Director of the company while issuing the shareholders prospectus, that is director at the time of issue of share prospectus, not who was appointed after the prospectus date. Okay, and has authorized himself to be named in the prospectus as a director or has agreed to become such director. You see, who is a director or who himself added his name as a director or represented himself as a director and a promoter and has authorized to issue the prospectus and an expert and shall without prejudice to any punishment which any person may be liable under Section 36 to liable to pay compensation for every person. Every person means here who subscribed for the securities and had incurred some loss, had sustained such loss or damages. You see, it is very difficult to remember like this, right? And now we'll see the prospectus of Nika, which was about like a trend or something had been in the market, right? You see here. We thought of directors, right? First, we'll see, you see, someone who is authorized himself as a director on behalf of some trust. He's Falguni Naika. She is also liable for that. And as a director, CFO, and Arvind Agarwal, who is also liable if at all had occurred any kind of loss or damage. I'm not saying this is had occurred some loss or not. I'm just saying the how we could find all the responsible parties. You see, the director here, Milind Sarvate from Thane, and we also have Singapore directors from either India or foreign also included. And with regards to any kind of companies also authorized signatory, not only for the trust, for also the companies authorized signatories and trustees for this. And I want to show you something. Yes, this shareholding, selling shareholders were also liable. So all these, what are they claiming that? What are they claim that a name was there and how they were acting if they were director or authorized representative or selling shareholders, CFO, their designation would be here. And what they are saying that they hereby confirm and declare that all statement disclosures in this red herring prospectus were true and correct as far as their responsibility. Now you see what the directors are claim. They declare that all relevant provisions with regards to few sections were correct and they are certifying that all statements were true and correct. Okay, and as they were giving like declaration like this statements, if at all any misstatement, omission, or any thing what was included like to mislead the subscribers of or prospectors, shareholders, and all, they were liable for civil liability, and they have to make good for all the compensation to every person that had made a loss due to that statement. And who were not liable for this civil liability was who need not pay certain negligence damages were when, having consented to become a director, withdrew his consent before issue of the prospectus. They have withdraw the consent before issue of the prospectus, one thing, and after, and that the prospectus were issued without his knowledge, and that became aware of the issue and gave a reasonable public notice, and it was issued without his knowledge and consent. First thing, that is, before the prospectus were issued, he withdrew his consent. That's fine. And after the prospectus were issued, he have to give a declaration. He have to release a press note, or just go for any other kind of things, or make an advertisement like that. And after the issue of what he has to do, what he has to tell that were issued without his knowledge, and he was when he was becoming aware, he's releasing this press note, etc. And with regards to any misleading statements that were made by an expert where he had a reasonable ground to believe up to the issue of prospectus, at that time also that expert is not liable for the damages for the negligence and all. Notwithstanding anything to the above section, the prospectus have been issued with an intent to defraud the applicants of securities. That is, you see, the difference between fraud and error is intention. The company had issued the prospectus only to defraud the who applicants of the securities or a public at large. So even if the intention is to defraud, even the persons referred here were also liable for paying of damages, etc., without any limitation of liability. With regards to liability of misfeasance, is something, there was a breach of what duty or trust, etc. And this is what the misaffiance means. The company would be guilty of misaffiance if he had been guilty of any breach or trust in the performance of his duties, which he had resulted in some loss or damage to the company or its property. It's same as above, but just 2-3 words difference. That's it. Apart from the liability for the professional negligence, an auditor would be also penalized under Section 147 for the failure to comply with any provisions contained under Section 143 and 145 of the Act. What are those penalties? You see, under Section 147, if the auditor of a company contravenes provisions of 145, he shall be punishable with a fine which is not less than 25,000 rupees. That is minimum 25,000, but it could be extended to 5 lakhs or 4 times the remuneration, whichever is lower. This lower is with regards to the maximum limit, that is 5 lakhs or 4 times the remuneration, whichever is lower, but a minimum of 25,000 rupees. If he had contravened knowingly and willfully with an intention to do that, so he shall be punishable with a imprisonment for a term which may be extended to 1 year plus a fine, which shall not be less than 50,000 rupees. That is double. Okay, this is 25,000. This is double of that 50,000, but which may be extended to 25 lakh rupees. That is, this is square. 5 square 25 lakh rupees, or 8 times the remuneration. Again, double for the 4 times remuneration, whichever is less. That is with regards to the willfulness. Okay. And now with regards to Section 143, if the auditor does not report a matter of fraud involving any amounts which may be, he'll be liable for the punishment. Okay. And with regards to, whenever you have to write this, you also have to write, he will be also liable under professional ethics also, right? Schedule 2. Okay, with regards to the criminal liabilities in Companies Act now, if there was a misstatement in prospectus, or the auditor had given a false statement. Okay, with regards to the misstatement in prospectus, which is not immaterial, which shall not be immaterial, that is a material misstatement, then the auditor would be liable. Every person would be liable who authorizes the issue of the prospectus under 447. Or with regards to punishment of any false statement, like any written report, certificate, financial statement, or prospectus, any person makes such false statement would also be liable under 447, which is also a material fact. Both has to be material, not immaterial for application of that criminal liability. And now we'll see what happens if they are liable under section 447. If the fraud amount is at least 10 lakhs or 1% of the turnover, that is, the fraud amount is minimum 10 lakhs or 1% of the turnover, whichever is lower, then the person shall be liable for imprisonment which is not less than 6 months, that is minimum 6 months, and which may be extended to 10 years. For 10 lakh or 1% turnover, the imprisonment could be extended till 10 years, 1010, okay? And shall also be liable for a fine which shall not be less than the amount involved in the fraud, and which may be extended to 3 times the fraud amount. That is, it could be minimum of the amount involved in the fraud or 3 times. Okay, if it involves a public interest, like question they were like defrauding a people, a community of at large, and there involves a public interest, the term of imprisonment shall not be less than 3 years. That is minimum 3 years for the, if it's a question of public interest. It may also be noted if the fraud amounts less than 10 cr, 10 lakhs and 1% of the turnover, and it does not involve public interest, then the person guilty shall be punishable with imprisonment which may be extended to 5 years or with a fine extended to 50 lakh rupees. You see, when it is minimum, that is less than 10 lakhs and 1%, they haven't given minimum imprisonment. So the imprisonment could be 7 days, 14 days, 3 months also, but which may be extended to 5 years, where the amount was lower and the also do not involve any public interest. If at all there was involved any public interest, a straight cut minimum 3 years imprisonment. Public interest is in relation with the imprisonment. It has public interest has nothing to do with the fine amount. Only the fraud amount has something to do with the fraud, with the penalty amount, fine amount. Okay, if it is less than 10 lakh or 1%, it could be maximum of 50 lakhs if at all it does not involve fraud. Okay, if at all it involves some public interest, then maximum was not at all given, minimum 3 years imprisonment. If at all it is less than 10, if it is minimum of 10 lakhs and 1% turnover, then they have minimum 6 months imprisonment which may be extended to 10 years, and a maximum 3 times, 1 time the fraud is the minimum, maximum 3 times the fraud amount. With regards to this, there were 3 situations. Okay, you have to remember that. And now we'll see with regards to the direction by tribunal, the central government had made an application to the tribunal that there had been happening some fraud etc in the company. Then what the tribunal has to do, tribunal has to pass an order within 15 days from receipt of that application from the central government. What that order should contain, that the auditor of the company shall not be serving the company, and there has to be removed, or there has to be a change in that. If at all, a central government may appoint that. And there's a cooling period also. The cooling period is 5 years, that the auditor shall not be appointed as an auditor for any company, not only that company, for any company if he is liable under section 447. And in case of a firm, the liability shall be of that for every partners. Instead of directors, they are putting partners and all, and that's fine. And with regards to the fraud, they have been said what all the provisions which we have discussed earlier in our time limits, monetary limits PDF. And with regards to the liabilities under Income Tax Act, there were 4 parts. It was segregated into 4 parts. First one, we'll see 271J. If an accountant, merchant banker, or a registered valuer, that is other than auditor, okay, furnishes incorrect information in a report or a certificate under the Act, the AO or Commissioner Appeals may direct him to pay a sum of 10,000 rupees for each such report or a certificate by way of penalty. Penalty is something that was levied by the central government or the government of India. Fine is something when court was involved. You see, It is not for the auditor. It's for any accountant, merchant banker, and registered valuer, which an chartered accountant could also provide those services. If had given that AO and commissioner applets, AO and CA here, minimum of 10,000 rupees. Okay, that this would be asked in the MCQs, like they would ask the authorities who would give penalty and all, who could authorize to make him penalty and all, or they may ask these professions, or they may ask the amount, time limit. You have to remember all three things. You have to also remember the section number, 4 points to remember in everything. Under Rule 12A of Income Tax Rules, a CA who is acting as authorized representative for an SSE, what he has to do? He had got some account statements or other documents from the SSE to him. What the chartered accountant has to, who is acting as an authorized representative, he has to conduct an examination of those records and give a report which he knows or believes it to be true, untrue, or false. Okay, in under Rule 12A of Income Tax Rule, what he has to do, if a CA who is authorized representative who believes that the accounts, records, or documents that were given by the SSE, he has to give a report which he believes those were untrue or false. Okay? And don't get tensed up by looking at it to 2019 and all. We have already checked all the limits on the penalties. It was applicable for your May 2023 examination. Don't get stressed out of that. Okay, you see, under 288, chartered accountants could be acted as an authorized representative, but when that person has been convicted by any offense with related to income tax proceedings or had got penalty under section 271 and all, he is disqualified for representing an SSE. Okay, the Chief Commissioner or Commissioner of Income Tax Act has given powers to determine the period of such disqualification for that person. That is, they determine for how many years he could not be acted as an authorized representative for SC and all. This is a point to remember. Who has power that to prevent a chartered accountant from acting as a authorized representative for the SC? That is CCIT or CIT. Okay, and the CA had found of guilty of any professional misconduct, and what the ICA had done, the council had disqualified that person from practicing. In that disqualification period also, he cannot act as an authorized representative. And under section 278, if a person abates or induces another person to make and deliver an account or statement, that is the person who is doing or the person who is encouraging the other person for a declaration of any income that was false or which was believed not to be true, to commit an offense, that is tax evasion. The person who is doing and the person who is encouraging would also be liable under section 278. In what cases? In a case if the tax amount or the penalty amount which has been accepted true, which was willfully attempted to evade. It's a willful, the condition one, and it was evaded, which exceeds 2500,000 rupees. What language it is, right? It's 25 lakh rupees. Even in the act, it was the same thing, but in our normal communicative terms, it's 25 lakh rupees. If it exceeds 25 lakh rupees, if it is 25 lakh rupees, this second point would be applicable. If it exceeds 25 lakh rupees, then a rigorous imprisonment which shall not be not less than 6 months, that is minimum 6 months, which may be extended to 7 years with a fine. Okay, fine they haven't mentioned anywhere. Court will decide that minimum 6 months, maximum 7 years, which exceeds 25 lakh rupees. If it is 25 lakh rupees or below that, then minimum 3 months, which may be extended to 2 years, that is maximum 2 years, and a fine decided by the court. And with that said, we have completed our liabilities of auditors.
Audit. The first subtopic under here is section 141 regarding to the eligibility, qualification and disqualification of auditors. We'll see the first eligibility. Eligibility of what? Who? A statutory auditor. Eligibility of a person to be appointed as a statutory auditor. A person, that is, who is proposed to be a statutory auditor, shall be eligible only if he is a chartered accountant. A firm, any firm, shall be eligible if majority of its partners are practicing in India. The firm, including LLP, when appointed as an auditor, only partners who are chartered accountants shall be authorized to act and sign on behalf of the firm. That is, that such firm, any kind of firm, whether it be a chartered account firm or a mixed firm, also contains lawyers or architects, etc., or some other professions. Majority of such partners shall practice in India, and only that partner who is a chartered accountant shall act and sign on behalf of that firm with regards to the statutory auditor. And what are the qualifications? The qualifications here were the negative list. Negative list is if any condition that was fulfilled by such person or that firm shall not be eligible to be appointed as an auditor. If that firm is a body corporate other than LLP is not eligible to be appointed. Any person who is officer or employee of the company, what company that client, to the company whom the statutory auditor was to be appointed. If that person is an officer or employee, not eligible. Partner or employee of such officer or employee of that company is also not eligible. Officer or employee of company not eligible. Partner or employee of an officer or employee of the company is also not eligible. A person, relative or a partner. For what? For these three conditions. What are the three conditions? Holding any security or interest in CSH, ASH, company, subsidiary, holding, associate, subsidiary of that holding. Indebted excess of 5 lakhs in such companies and guarantee or security with regards to such indebtedness in excess of 1 lakh. Only for the relative there was some relaxation that relative may hold up to 1 lakh of face value. If he acquires more than 1 lakh, then the corrective measure has to be taken by the auditor, because he is seeking the employment right within how many days? 60 days. So the auditor shall not hold even a single share, but relative can hold up to 1 lakh of face value, and these 2 points would be applicable same to both relative person or partner with the indebted excess of 5 lakhs and had given security or guarantee with respect to indebtedness in excess of that 1 lakh. And first point is that who has direct or indirect business relationships, except they held some exceptions where the had been with the commercial transaction as per Chartered Accountants Act 1949 or commercial transactions which are ordinary course of business at arm's length price. That if an auditor has an Airtel SIM, he can audit the Airtel company. If he had LIC policy that was taken, he could be auditor of that LIC office also, LIC. So they were ordinary course of business, and relative or director of KMP is not eligible to be appointed as an auditor. Full-time employee elsewhere. Here the employee of the company, here full-time employee of company or somewhere else. And full-time employee cannot be appointed as an auditor, and a person who has exceeded 20 companies threshold limit. What does this 20 companies in order to count the 20 companies threshold limit, these 3 companies were not included. What are those 3? OPC, small company, a private company whose paid up share capital is less than 100 CR. That is, if it had 99.99 CR, also not eligible. But if it's equal to 100 CR, that is 3 digit, it is included in that 20 companies limit. When it is convicted by court for fraud and 10 years have not elapsed from date of conviction. From date of conviction, okay, directly or indirectly renders Section 144 services. Section 144 services were such services which helps the company to function, like providing accounting and bookkeeping services, internal audit, investment advisory services, investment banking services, actuarial services, management services, and design implementation of any financial information system, or rendering any outside financial services or any other kind. accounting bookkeeping, internal audit, investment advisory, investment banking, actuarial management, design implementation of financial information system like SAS, and rendering outsourced financial services like what do most BPOs do, payroll expenses, etc. And what's the manner on appointment of auditors? If the first auditor and it's an other than a government company, it was appointed by board within 30 days. In case of its failure, members in an AGM can appoint within 90 days from expiry of such 30 days, and such first auditor hold the office till the conclusion of first AGM. And for it's a government company where it's a first auditor, for the government company, we know it's C&AG within 60 days from date of registration of such company. In case of failure, board within 30 days. And in case of failure of board also, members in an AGM within 60 days. And hold the office till conclusion of the first AGM for the first auditor, enough. And for the subsequent auditor, for a government company, it has to be appointed by a C&AG within 180 days from the commencement of the year and hold till conclusion of AGM. Here, for the government company, it's only 1 year term. But for a subsequent auditor, for the other than government company, till the conclusion of 6th AGM, it was appointed by members in board. Here, board of directors do not come into picture, board of directors or members. Here, members are appointed in an AGM and hold till 6th AGM, conclusion of 6th AGM. And here are few notes that were given here to the company and here to the auditor. What were those? Before appointment, a written consent from auditor and certificate that his appointment is in accordance with conditions as prescribed under section 141, which we have seen earlier, section 141. And what does that certificate shall consist of? A written consent and certificate. What this certificate consists of? That he is eligible and his proposed appointment is as per act, and his proposed appointment as per limits. What limits? The 20 company limits. List of proceedings against auditor, firm or partners with respect to professional matters stands true and correct, and that's it. These points we'll see somewhere later in cost audit report. In cost audit appointment provision also, mostly the same would repeat. And here for the company shall inform for notes to the company or duties, the company shall inform the auditor with respect to his appointment and also file notice with register within 15 days from which the auditor is appointed. Don't get carried away with as 30 days. Here it's 15 days because mostly when we think of board or when we think of register, we think or something that was filed to ROC, will tend to write it as 30 days because we often see 30 days, but please make an extra effort to remember that it's 15 days here. And a retiring auditor is appointed if he is not disqualified for reappointment. No notice for unwillingness and no special resolution was passed for not to reappoint him. How to remember these 3 points? Not disqualified as per Act, A4 Act, not disqualified for reappointment, and no notice for his unwillingness. That's the person itself, the auditor itself had not had unwillingness, not expressed his unwillingness as per C. For the company had not passed any special resolution not to appoint him as a auditor, reappoint him as an auditor. If these 3 were met in AGM, if no auditor appointed, existing auditor or retiring auditor shall continue. That's it. With regards to the casual vacancy for government companies, who comes into picture for any kind of appointment? C&AG within 30 days. C&AG for the first auditor 60 days, subsequent auditor 180 days from commencement of the year. For casual vacancy 30 days. In case of failure, board of directors 30 days. For the other companies, board of directors 30 days. In case of resignation or appointment by board of directors, should be approved by company at a general meeting. Okay. Casual vacancy by resignation. Auditor shall file ADT3 indicating reasons. If it's a government company, to whom he shall file such ADT3 with regard to company, registrar, C&AG. But if it's not in a government company, no need for C&AG, company and register, enough. Failure to file ADT3, general 50k, remuneration whichever is lower. For continuing failure, 2 lakhs or 500 per day, whichever is lower. This would be the penalty section for not filing the ADT3. Removal of auditors. Now the auditor had resigned. That's his right to resign. Now we are talking about the right of company to remove the auditor. Auditors can be removed before their expiry by a special resolution after obtaining prior approval of central government. We have to make note of two things. Form ADT2 plus fee within 30 days of special resolution and shall hold AGM within 60 days after response from central government. So there were two things. AD2 fees with regard to such special resolution 30 days and with regard to prior approval of central government, AGM has to be held within 60 days, and it is obviously after reasonable opportunity of being heard has to be given to the auditor before such removal. Okay. If tribunal is satisfied that the auditor involved in fraud, it may direct company to change its auditor. How do tribunal knows that auditor involved in a fraud or not? Inspection, investigation, inquiry, investigation, inspection chapter in law, right? Yeah. From there, auditor satisfied that auditor involved in fraud and it may direct company to change its auditor. If it's applied by central government, if such application was made by central government, tribunal shall give its order within 15 days. It shall give order within 15 days, and what that order shall consist of? The order shall consist of CG may appoint another auditor and existing auditor shall not function, and such auditor or against whom the final order was given shall not be eligible to be appointed for 5 years from date of passing the order, and auditor is liable under section 447. Okay, that's with regard to the removal of auditors. Now appointment of auditors other than retiring auditors. A special notice for resolution at AGM has to be given for what? Appointment of auditor other than retiring auditor, or expressing that retiring auditor shall not be eligible for reappointment. Okay, on receipt of such notice, company shall send notice to retiring auditor. Okay, this is what the procedure. How do you appoint an auditor other than retiring auditor? Special notice has to be given, and such notice should also be sent to retiring auditor, and then retiring auditor will give a representation in writing and request to notify to members of the company. If there was no adequate time to distribute such to all the members, then auditor may read out at the meeting. Company in any resolution may state the fact, the representation, and send a copy for representation, a copy of such representation. If not sent due to any other reason, auditor may read out at the meeting. Okay, if tribunal is satisfied that representation right that was given to the auditor is being abused by the auditor, that is what defaming the company or etc., or create a panic in public at a large, likewise, then the representation need not, which was not fact actually, which was not fact, only his opinion, and the representation need not be read out nor to be sent to the members. Okay, and with regards to rotation of auditors, and all companies, a few kinds of class of companies have to follow the rotation of auditors, including listed company. If it's a listed company, it has to follow rotation, but if it isn't a listed company, three classes were there. It's easy to remember. Unlisted public company paid up share capital more than or equal to 10 CR, that is a minimum 10 CR. All private limited companies having paid up share capital minimum 50 CR. Listed company without threshold limit. Unlisted public minimum 10 CR. Private limited companies minimum 50 CR. And if companies have not satisfied with the paid up share capital thing, but they had borrowings of more than or equal to 50 CR from public borrowings. That's minimum 50 CR borrowings. If you have taken from any public financial institutions, you are eligible to follow rotation of auditors. As per section 139(2), the above companies shall not appoint or reappoint an auditor. An individual or firm, individual more than one term of 5 years, form 2 terms of 5 consecutive years, consecutive immediately, one after the another. That is 10 years for the firm and 5 years for the individual. As on date of appointment, no audit firm having common partner shall be appointed to any other audit firm whose term got expired. That is, the retiring audit firm that has to retire as per rotation, and the new audit firm shall not contain any common partners. Okay, the right of company to remove and right to auditor to resign shall not be prejudiced, and that's a normal question or regarding that. And now we are going on with the manner of how the procedure, how the auditors rotate. First, the audit committee shall recommend to board and recommend to the board the auditors whom you are replacing the existing, that is proposed auditor, and a company is required to constitute an audit committee if the audit committee has to be constituted, or there exists an audit committee in the company. The board shall consider the recommendations. If board has any other reasons to disagree with the recommendations of audit committee, it should cite reasons, and but it's not the discretion of the board to consider or not consider the recommendations of the audit committee. Board shall consider. This was tested in various case scenarios, or many case-based questions. So it was highlighted here. And incoming auditor shall not be eligible if under the same network of the audit firm. Likewise, we have said, right, should not contain a common audit partner firm, or they were saying same network is regards to the common friend circle, etc. And what are the threshold limits that has to be met in order to form an audit committee? Here, audit committee, all public companies having paid up share capital more than or equal to 10 CR, minimum 10 CR paid up capital, or minimum 100 CR turnover, or having loans more than 50 CR. This is not minimum 50 CR, that is more than 50 CR. But here, for the rotation, applicability of rotation, it is more than or equal to 50 CR. That's minimum 50 CR. Here, more than 50 CR. Please make a note of it. Special attention here. And rule number 3 of CAR 2014, manner and process of selection and appointment of auditors. If the company had audit committee, then the committee, if not board, if it does not have any committee, board shall take into consideration the qualification and expertise, experience of such individual, and also the size in case of firm proposed. Moreover, any order or pending proceedings relating to professional matters against proposed auditor before ICI or court. Okay, what are all the conditions that have to be taken into consideration? The qualification and experience, any kind of orders that were proceedings that were pending, and if the audit committee may call for such other information which may deem fit. What's the procedure? Audit committee recommend to board. Board will recommend to the AGM. If no audit committee, board will recommend to AGM. Audit committee have recommended to board. Board agrees, AGM. If not agreed, it have to refer back to audit committee citing reasons. Audit committee also considered audit committee, after considering the board's reasons and decides not to reconsider, then board shall record reasons for such disagreement and sends its own recommendation in AGM. Okay. Auditor appointed in first AGM shall hold till conclusion of 6th AGM, that is one term of 5 years. And remuneration of first auditor is appointed fixed by the board, and if it has an audit committee will fix, or remuneration of subsequent auditor fixed in AGM. Remuneration includes expenses or any facility provided by him. And here are the rights and duties of the auditor. What the auditor have come for. The auditors have come to audit the financial statements and give a report. That's it. And auditors have to be accountable for whom? Accountable to its members and investors at large. So with regards to these points, we'll figure out what the rights and powers of the auditors and duties of the auditors. They have right to access books. So they have come for that, to check the books. Right to obtain information and explanations from officer. It's like external confirmations or written representations from the management, etc. And they have right to receive notice and attend general meeting, where in general meeting mostly the financial statements were approved and auditor annual report was published, so which consists of audit report. So he has right to receive the notice and attend general meeting, and has right to report to members of the company on accounts examined by him, as he's accountable to the members of the company. And he has right to lien on books placed at his possession for non-payment of dues. He could access this right with a condition that the books were placed at his possession and has non-payment of dues. These were unconditional. This is something conditional for non-payment of dues. That's it. And duties of auditor, inquire on certain matters, okay? And with regards to like standards on accounts, accounting or any other company law, provisions with regards to act, and they have to comply standards on accounting, and they have to report, duty to report and sign the audit report and report on frauds to the government or any other kind of regulatory authorities, etc. And duty to state reasons if at all he had given any qualified or negative report. These were the duties of the auditors. And here it's not so important point, but just remember in one go. And where members can qualify the audit report if the accounting policies required to be disclosed under Schedule 3 or Companies Act were not disclosed, and proper disclosures regarding changes in accounting policies were not made. That is, accounting policies were not properly disclosed and such changes were not made. Such changes in accounting policies, disclosures were not made, and accounts are not prepared under accrual basis, and going concern was not followed while doing and this fact was while doing financial statement, and that fact was not disclosed in financial statement. Okay, you may leave this. This is not so important. And now we have joint audit, branch audit, cost audit. After these three kinds of audit, we go to further part of the company audit. Joint audit means pooling together resources and expertise for more than one firm to render an expert job, which may be difficult to be accomplished while acting individually. That is, they were pooling the resources that are like two or more audit firms work together, pool their resources and expertise, and provide a better service to the client. What are the issues of the joint audit? Sharing of expertise, sharing of workload, improving service to client, lower staff development cost, healthy competition for better performance. Obviously, they could share their expertise with regarding different fields, and they could share the workload and improve service to the client, specific services, and lower staff development cost in order the training cost, etc. for such other fields, and healthy competition for better performance. What are the disadvantages of joint audit is you could write it mostly like a behavioral consequences that you used to write in your SCMP with regards to superiority complex of auditors and problems in coordination of work, common area being neglected, and fees being shared. Okay. When a joint auditor come across a matter which is also the responsibility of other joint auditors, which requires the special attention or disclosure, discussion, or any kind of judgment, that said auditor shall communicate to other auditors in writing prior to the completion of audit. Anything, any common area that was their responsibility of other joint auditors also. Such auditor who had found that has to communicate to other auditors in writing prior to the completion of audit, not after completing the audit report, etc. signing, but prior to completion of audit. Joint auditors require the issue, as there were 2-3 firms doing audit of single client, they have to issue only one audit report. But if there was a difference in opinion, they could issue 2 different audit reports, but referring the other audit reports each one. Joint auditor required to issue common audit report. When a joint auditor is in disagreement, he shall express his opinion in a separate audit report. And audit of a branch office, whether it would be in India or outside India, what do they have to do? The company has to prepare and keep it in a register office, such books of accounts every financial year, which gives true and fair view whether that branch located in India or outside India, that shall be kept in an accrual basis and double entry system. Accrual basis and double entry system. Books of accounts may be kept at a place where board of directors decide. That is, any other place other than register office. What do they have to do? They have to communicate to registrar within 7 days in writing the full address of such other place. Okay. If the branch office is situated outside India, the branch accounts has to be audited by the company audit or company auditor or accountant or any person who is duly qualified as auditor in that country where the branch is located. But at last, the branch audits also should be audited. Branch auditor shall prepare a report on branch accounts examined by him and send it to auditor, including any fraud. Okay, with regards to the cost audit is an audit process verifying the cost of manufacture or production of a particular article with regard to utilization of material, labor or any other cost. Whether everybody have to maintain cost records? Only after, voluntarily yes, but only after meeting a specified threshold limit. What's that threshold limit is that if your turnover, overall turnover including any products or services that you have given, touches 35 CR, you have to maintain cost record to inform CRA 1. More than or equal to 35 CR, including foreign companies, excluding MSME companies. Do it have to do a cost audit? Yes, voluntarily yes, but in order as per applicable law, if it's from a regulated sectors, if its overall turnover is more than or equal to 50 CR, that as soon as it touches 50 CR, overall turnover, you have to do cost audit. Or if an individual product or turnover touches 25 CR, you have to do the cost audit. That is or here, either 50 CR or 25 CR of single product, you have to do your cost audit done for the regulated sectors, but for unregulated, the overall was added to 100 CR, and for the individual turnover it's 35 CR. Try to remember these. That's it. Cost audit shall be appointed by board of directors of such remuneration, and no person appointed under 139 who are statutory auditors shall be appointed for conducting audit of such cost records. Cost auditor appointment procedures. As you have seen, we will also find few common points with regards to appointment of cost auditors. You could find them. Appointment within 180 days of commencement of financial year. The written consent and certificate shall be obtained from cost auditor. Cost auditor shall be appointed within 180 days from commencement of financial year. That is subsequent auditor's appointment in government audit. Same time. Written consent and certificate. Okay. We have seen this. What that certificate shall consist of? That individual or a firm is eligible under Companies Act and CW Act, satisfy the criteria, eligibility criteria under section 141. Starting, we have eligibilities, qualifications, right? And proposed appointment is within limits, as per limits, 20 company limits. And the list of proceedings that were with regards to professional matters were true and correct. That's it. Same points were repeated. Every company shall inform cost auditor's appointment in form CRA 2 within 30 days of board meeting in which appointment was made, or 180 days from the commencement of financial year. And the cost auditor shall continue till when? Till expiry of 180 days from closure of financial year, or till he submits his cost audit report. That's it. With regards to removal, a cost auditor may be removed before expiry of his term through a board resolution, because he is appointed by board only, no? After giving a reasonable opportunity of being heard and record reasons in writing. With regards to casual vacancy due to any resignation, death, removal shall be filed by board of directors within 30 days of vacancy and inform central government within 30 days, inform CRA 2. Appointment as normal auditor CRA 2. Appointment with regards to casual vacancies also under CRA 2. Remuneration with regards to company which has audit committee shall recommend cost auditor and remuneration. Board of director, what do they appoint cost auditor on recommendation of audit committee. What do shareholders do? Shareholders subsequently ratify. And if you have no audit committee, what do board of directors do? Board of directors directly appoint cost auditor and fixed remuneration, and shareholders, what do they do? Same duty, subsequently ratify. Submission of cost audit report. A cost auditor shall submit cost audit report in form CRA 3 within 180 days from closure of financial year to the board. To whom the cost auditor shall submit his report is to board of directors in form CRA 3. Company, after receipt of such cost audit report within 30 days, shall send to central government in form CRA 4 XBRL. The cost audit rules are not applicable to few categories of companies. What are those? Whose revenue from exports in forex is more than 75% of its total revenue, or something operating in a SEZ, or it was engaged in generation of electricity through captive generating plant. Under section 147, the punishments with regard to non-compliance were, these were penalties, something which we always hate. Bear with us for 2 weeks. We'll figure out something, how to remember the penalties that were there in the whole audit, and we'll figure out something so that before the examination you could just refer that 2-3 pages and go and give your examination. That's last minute. Contravene 139 to 146, minimum 25k to 5 lakhs and for the company, and minimum 10k to 1 lakh for every officer in default. And if you contravene 139, 144 and 145, minimum 25k to 5L or 4x the remuneration, whichever is lower. Auditor, willful contravention to deceive the company, 1 year imprisonment plus minimum 50k to 25 lakhs or 8x the remuneration, whichever is lower. Auditor convicted shall be liable to refund the remuneration and pay damage to the company. Okay. CG may appoint an officer for prompt payment of damages and required to file a report. When the audit is conducted by an audit firm, the partners are jointly and severally liable, but in case of a criminal liability, only the concerned partner who acted in fraudulent manner is liable. And with these were 147 punishments for non-compliance. Try to read once more and you could get that.
Part 2 consists of mainly financial statements, dividend and LLP audit topics. We'll see the financial statement topic. Financial statements required to follow accounting standards, which in consultation with and examination of recommendations of NEFRA. In order to prepare the financial statements, we require accounting standards. In order to audit the financial statements, we require auditing standards. Where these auditing standards come from? Who gives us? NEFRA formulates and recommends the accounting standards. Financial statements are required to follow accounting standards, but insurance, banking, electricity companies need not follow because they have special act and special format of financial statements. So as per section 129, these companies, insurance, banking, electricity companies need not follow accounting standards. Financial statements shall give a true and fair view of the state of affairs of the company at the end of the financial year. That is why we are following the accounting standards. We are following accounting standards to give true and fair view. Items in financial statements shall follow what? Accounting standards. Okay. After preparing of financial statements, can we reopen the books of accounts? Yes. How could we reopen the books of accounts? As per section 130, a company shall not reopen its books of accounts or not recast its financial statements. Recasting is nothing but shifting from current to non-current, non-current to current, etc. And unless an application made by central government, income tax authority, SEBI, or by an order of tribunal or court. What does applications or order consist of? They consist that the relevant earlier accounts which were prepared in a fraudulent manner, or the affairs of the company were mismanaged, casting a doubt on reliability of financial statements. You see, financial statements were prepared using accounting standards to give a true and fair view, but they were made in a fraudulent manner or which cast a doubt on reliability of the financial statements. Then they have to reopen the books of account by an application by central government or IT or regulatory authorities, but not beyond a period of 8 years. Can we reopen the books of account for beyond a period of 8 years? Yes, when the government issue a direction under section 128(5). When it extends the time limit, we can go beyond 8 years also. What about the company voluntarily revising its financial statements or board report, etc.? As per section 131, the financial statements or board report, when they do not comply with 129 or 134 sections, they may prepare revised of financial statements and board report for any of the 3 previous financial years. It's not mandatory to revise all the 3 previous financial years. It could go for any of the 3 previous financial years after obtaining a approval from tribunal, and a copy of order of the tribunal shall be submitted to the registrar. That is, if in order to revise the financial statements of board report, what do we need to do? We need to apply for the tribunal, and that tribunal order shall be submitted with the registrar for revision of such financial statements or board report. With regards to CFS, as per section 129(3), CFS is mandatory for the company having one or more subsidiaries or associates, which shall be led before the annual general meeting. That CFS shall be led before AGM. CFS should be prepared with respect to Schedule 3 and other accounting standards. The provisions also applicable to preparation, adoption and audit of financial statements of holding company shall also apply to CFS. That is, all the provisions that are governing the holding company also govern CFS. Is it mandatory for every company to file CFS if it has subsidiaries and associates? There were few exceptions for that. What are such exceptions? As we already seen it in FR, right? Whether it's an investment company or if a company that is subsidiary, it's a subsidiary. Make a note that it's a subsidiary, not a holding company. It's a subsidiary and its members who are entitled to vote and not entitled to vote. Even members who are not entitled to vote shall also be considered. Intimated in writing that they do not object company for not presenting consolidated financial statements, that they are curtailing their right. Here, the ultimate company or intermediate holding company files CFS with registrar as per AS accounting standards. That is, a company can object. Plus, the ultimate company shall file its CFS with registrar company. That is, even though the subsidiary is not filing CFS, its holding company or intermediary holding company shall file it to the registrar. Then it can take such exemption. Plus, the company's any securities were not listed in any stock exchange, whether inside or outside India. Okay. Financial statement disclosures were not made as per AS. What do we have to do when any kind of disclosures that were have to be made as per AS were not made? We have to write what deviation has occurred and what are the reasons for such deviations and what the financial impact of such deviations. Just like an audit finding, just like an audit finding, so deviation and reason for that and financial impact. If the managing director or full-time director, CFO, board member have not complied with such provisions that were discussed above, a penalty of minimum 50,000 to which could be extended to 5 lakhs and an imprisonment up to 1 year could be done. And with regards to the provisions of constitution of NEFRA, who constitutes NEFRA? NEFRA, as per section 132, CG may constitute NEFRA. For what? What's the duty of NEFRA? NEFRA to adoption for making the companies to follow the accounting and auditing standards, formulate the auditing standards and accounting standards. NEFRA has power to make recommendations to central government on formulation and laying down accounting and auditing standards and monitoring those compliances, whether the companies were following the auditing and accounting standards. With regards to company and with regards to the auditor, NEFRA does both ways. It monitors the companies and it monitors the auditors also. So, it oversees the quality of the service of the profession and suggests improvement in any quality of service. And this is the gray area to perform such other functions which were mentioned by central government. NEFRA has powers. Does NEFRA rule all the companies? No, it rules only few companies whose securities were listed in any stock exchange or unlisted public companies whose paid up share capital is greater than or equal to 500 CR. That is, as soon as the paid up share capital touches 500 CR, NEFRA is applicable. Aggregate total turnover touches 1000 CR, NEFRA applicable. Aggregate outstanding loans, debentures, deposit touches 500 CR, NEFRA applicable. As on 31st March, previous financial year. and insurance, banking, electricity companies, or any companies which were set up under special acts, NEFRA applicable, or any company on whose reference made by NEFRA by central government with public interest. That is, central government had referred a company out of public interest to NEFRA. NEFRA is applicable. NEFRA rules were applicable. That company has to report to NEFRA. Any body corporate or company registered outside India, but it is a subsidiary or associate of the above set, NEFRA applicable. Okay, how do these companies report? Other than the above companies, when NEFRA rules came in, when the NEFRA rules had started, if you think these companies were set A, all the negative A shall report within 30 days in form NEFRA 1. And all the newly formed A companies, all these category A companies, after the NEFRA rules were in force, it shall within 15 days intimate NEFRA in form NEFRA 1. Please make a note out of here. These were negative A as on the date of NEFRA rules. They continue to govern for NEFRA. NEFRA continue to govern for 3 years after it ceases to be listed or above limits were not met. That is, even after once the company, any company had come under the umbrella of NEFRA, even though it does not satisfy any kind of these criteria, NEFRA will be, you have to report to NEFRA up to a period of 3 years. Even such limits were not met. Every auditor, as we have already seen, the NEFRA regulates both companies and auditors. For the companies, it's form NEFRA 1. For the auditors, NEFRA 2, form NEFRA 2, where on or before 30th November every year, they have to file form NEFRA 2. When such provisions were or rules or regulations that were formed by NEFRA were not satisfied or not complied, a penalty for individuals minimum 1 lakh up to, it could be extended up to 5 times the fees, and for the firm it's minimum 5 lakhs and it could be extended to 10 times the fees. And it could also go for debarring the firm or member for a minimum 6 months to 10 years. These were again penalties. And for the balance sheet formats should be of vertical format, that's mandatory. And Schedule 3 is applicable to all companies except insurance, banking and electricity companies and other special act companies because they have their own format. And Schedule 3 consists of 2 divisions. Division 1 for the accounting standards and Division 2 for Ind AS. Part 1 was assets and liabilities. Part 2 is P&L for the under Division 1 and under Division 2, Part 1 balance sheet, Part 2 P&L, Part 3 CFS. P&L is always Part 2. Just a small reminder for that. Features of Schedule 3. What do Schedule 3 consists of? P&L balance sheet, right? With the picture of a P&L or balance sheet in our head, we'll just figure out all the points that were given here. What are the disclosures? Disclosure requirements in Schedule 3 are in addition but not substitute to the disclosure requirements as per Act. As we already know that Act supersedes the Ind AS, right? You have to not miss a disclosure, only the reason that it was not present in Schedule 3. But if it is have to be disclosed under Act, you have to mention that. And it requires presenting information through notes to accounts. Yes, how do we disclose that? Through notes to accounts. We have to give cross-reference numberings to the notes to accounts, and all the notes to accounts shall contain corresponding amount of previous year. Okay, we know that, right? Current year, previous year amount. Okay, what are the features of Schedule 3? Disclosures, notes to accounts, numbering of that notes to accounts, in corresponding previous year amount. In order to ensure, how do we know financial statements have to follow the accounting standards? For what? That financial statements were true and fair. How do we know that financial statements were true and fair? What do a financial statement contains of? It contains P&L balance sheet. P&L contains what? Opening stock, closing stock, expenses, profit. Balance sheet consists of assets, liabilities, right? So, we'll see with P&L account, assets are neither undervalued nor overvalued. They're talking about the opening and closing stock. No material asset is omitted, no material liability is omitted. Balance sheet and P&L was prepared as per Part 2 of Schedule 3 and balance sheet is prepared as per Part 1 of Schedule 3 and accounting policies were followed consistently. Simple. P&L balance sheet, that's it. And now we are moving on to the second portion, that is dividend portion. Dividends can be declared from the following. What are the sources of dividends could be declared? As soon as we get profits, we cannot distribute everything, right? So we need to have few plans with regards to the taxes or reinvestment opportunities or any kind of such things, right? So we'll see what all the things that revolves around dividend. Out of what balances we could issue the dividend is out of profits of current year, out of the profits of previous years, and out of balances of the above, that is like generic reserves, and out of money provided by central government or state government. Please mention a note that these were not specific grants. It's like a general grant, generic grant. So it could be issued. That is profits of current year, previous year, and general reserves and money by central government or state government. And what are the factors that determine the dividend policies? Okay, as soon as we get profit, we cannot distribute everything. We have to see what all the things that have done, nature of earnings. We have sold some factory or immovable property, right? Immovable property. So there was current year the profit was low. So we cannot issue whole sum as dividend, right? We have to reinvest that property and buy in any other kind of immovable property because it's that income, that profit was out of capital nature. So the nature of earnings also have to be taken into consideration while issuing the dividend policy, and reinvestment alternatives and the liquidity and our working capital requirements and new capital requirements and market value of our shares and tax bracket of our shareholders and stability of the dividend. So all these factors have to be taken into consideration before declaring the dividend. Okay, after the dividend has been declared by taking into consideration of all these factors, and what's the process of declaring that dividend? What the process of payment of that dividend to the shareholders? Further, dividend should be deposited in a scheduled bank within 5 days from the date of declaration. Within 5 days, you have to deposit in a separate bank account. Within 30 days, you have to pay that to the whom you will pay? To registered shareholders. How will you pay? You have abandoned non-moving stock. You cannot go and give that as a dividend, right? You have leftover Diwali sweets and you cannot go and give that as a dividend, right? You have to give that dividend as cash, check, warrant, and on an electronic mode. Only these were the eligible modes of issuing dividend. And okay, some shareholder have dues with me. When I have called for the money he didn't pay, can I cut that money and give the rest as a dividend to him? Yes, you could do. The board may deduct the payables by member due to pay. And if articles authorize, they can pay dividend in proportion to the paid up share capital. So with regards to the paid up share capital, that few were fully paid and few were partially paid, you could give dividend with regards to that proportional amount, and profits reserves can be capitalized by issuing bonus shares with regards to SEBI regulations. Okay, these were the provisions with regards to payment of dividends. Dividends should be deposited in scheduled bank separate account within 5 days from date of declaration. Dividends after declared becomes liability of the company and must be paid within 30 days. Payment of dividends should be made to registered shareholders, and dividends are not payable except in cash, check, warrant, or electronic mode. Profits or reserves can be capitalized by issuing fully paid up bonus shares subject to SEBI guidelines. If articles authorize, can pay dividend in proportionate of paid up on each share. Board may deduct the payables or members are due to pay. Okay, for any for any contraventions on payment of dividend rules, every director imprisonment up to 2 years and a fine up to 1,000 per day. Company simple interest 18% per annum has to be given. Exceptions when these time limits were not followed due to what act. Whenever there was any money involved, what you have to you don't come here and read that these all were the exceptions in examination, right? What you have to think, whenever there was some money involved, there exists some rules and regulations, laws, right? Very stringent. So whenever there's any delay in payment of any money, what has to come to mind? We have to write about some laws and regulations. When there were any few exceptions here due to operation of law, whenever there exists a law, disputes and whether that could be lawfully adjusted and by the direction of the shareholder. These were the exceptions which you could normally write. And for the unpaid dividend, okay, you have tried to reach all your registered shareholders and pay dividend in 30 days, but a few whose bank accounts got freezed and was not accepting any kind of credit, what do you have to do for that? Within 7 days, you have to transfer to unpaid dividend account. And the if dividend is not claimed within 30 days from declaration and company transfer to unpaid dividend account, such transfer shall be made within 7 days from expiry of that 30 days. Okay. The company shall pay 12% interest if not transferred within 7 days. The company required to prepare statement containing name, address, and unpaid dividend within 90 days and put it on its website. This is like making the registered shareholder, or it's a way to reach out the shareholder. And any money transferred to unpaid dividend, if not paid within 7 years, that shall be transferred to Investor Education and Protection Fund. Such details of such transfer shall be informed DIV 5 to authorities. What authorities? SEBI or the SEBI authorities. If any contraventions in with regards to this unpaid dividend provisions, the penalty would be for the company minimum 1 lakh and rupees 500 per day for continuing failure, maximum 10 lakhs. For any officer, it is 25,000 and 100 per day for continuing failure and maximum of 2 lakhs if it contravenes the provisions with regards to unpaid dividend. Now we have in our third and final topic, LLP audit. LLP is required to maintain annual accounts in true and fair manner. Okay. A statement of accounts in solvency shall be filed with every LLP with registrar every year. Audit is mandatory when the turnover more than or equal to 40 lakhs. That is, as soon as its turnover touches 40 lakhs, LLP audit is applicable. And its contribution touches 25 lakhs. Contribution is a capital contribution, touches 25 lakhs. LLP audit is applicable. No mandatory insurance is prescribed. Here, it could be asked as a true or false question, and for your MCQ, which would gain you a mark. The creditworthiness of LLP is addressed through solvency declaration. Every LLP required to file annual return in Form 11. How do you remember this 11 LLP? This remembers you 11 with ROC within 60 days from closure of financial year. Every LLP required to file statement of account and solvency in Form 8. Solvency 8 within a period of 30 days from the end of 6 months from the financial year. Okay. We have went in a hurry, right? Now we'll go it in detail. LLP is required to maintain its annual accounts. So there was no prescribed limit to maintain books of accounts. So if it's an LLP, it has to maintain annual accounts. In what format it has to maintain it? It has to maintain in with regards to accounts and solvency. Whether audit is mandatory, no, audit is not mandatory. Until it touches 40 lakhs, it's mandatory. Whether the capital contribution touches 25 lakhs, it's mandatory. And the credit worthiness of such LLP is addressed through solvency declaration. And these were the compliance provisions. With regards to annual return, Form 11, solvency, it is 8. Solvency 8. 30 days from the end of the 6 months. Here from end of 60 days from the closure of financial year. Things to remember. Registrar has power to obtain information from partner or employee. He can also summon if not furnished or not satisfied with the information or documents that were submitted. Documents available for inspection. What are all the LLP documents that were available for inspection with the registrar were? Incorporation document, names of the partners, statement of account and solvency, annual return. Incorporation document, names of partners. These two were the compliance requirements that they have to submit to the registrar. What are the fees for inspection? Rupees 50, that's for the common people, and for the certified copy we need to pay rupees 5 per page. If LLP not filed relevant documents within due date, less than 300 days, normal filing fee plus additional fee. If it's beyond 300 days or more, normal filing fee plus additional fee plus liable to be prosecuted. Who appoints auditor of an LLP? Designated partner appoint auditors of LLP when? At any time before the end of the financial year, at least 30 days prior to the end of financial year. Auditor is appointed by designated partners at least 30 days prior to the end of financial year. Filling of casual vacancy and caused by remover was appointed by designated partners only. All the power was with the designated partners. LLP's books of accounts shall contain what is books. Every LLP has to maintain books as and when it got registered under LLP, right? What books it has to maintain? All sums received and expended. It's basically a cash flow statement. Record of all assets and liabilities, something similar to a balance sheet. A statement of cost of goods sold, inventory, similar to P&L statement, and such other particulars or any other kind of information. What are the advantages of audit? Not only with regards to the LLP, it could be a generic question also. What do we usually say? What are the advantages of audit? We could get a loan. We could get investment, right? And what we could do? It could be help in future disputes, right? Future disputes between the partners, etc., right? So with regards to those scenarios or those circumstances in mind, we'll figure out all the points here. What are the advantages of audit? Is to detect errors or frauds in the financial statements, whether kinds of any disputes, or to obtain loans. That is, banks and financial institutions lend money to firms only on the basis of audited accounts, and periodical visits which help improving the management, to improve the management, and settling accounts between partners at time of admission, death, retirement, insolvency, etc. So in order to detect any kind of errors and to resolve any disputes, so to banks to lend money and improve management and settling out of accounts between partners. Auditor's duty with regards to audit of LLP. Auditors should get definite instructions in writing as to work as to the work to be performed by him. That's they're talking about the scope of the audit. The auditor should mention whether the records of the firm appear to be correct and reliable, whether he was able to obtain all information and explanation necessary for his work, whether any restriction was imposed on him. This is with regard to SA 200 series, like his auditor's duty to obtain true and fair view, and here is to obtain sufficient appropriate audit evidence and whether there were any restrictions that were imposed on him. The auditor should read what the auditor should read was the nature of business and the amount of capital that was contributed by the partner and the interest that they were getting and the duration of partnership and the drawings that were made by the partners and the salaries payable to partners, borrowing powers of the LLP, rights and duties of the partner, and method of settlement of accounts between the partners at the time of admission, or any loans that were advanced by the partners. That is, all the money related transaction to and fro between the partners with regards to any kind of capital or loans that were given or any kind of salaries, commissions, interest, all has to be read and seen by the auditor. These were the duties of the auditor, and this comes to the end of the. And now we'll see Schedule 3. It's also something which we often forget to revise, but ICA was recently starting. It was widely with regards to the disclosures requirement and all. We need not learn a whole thing because there were a few important categories which ICA had already asked the question and it was repeating the same thing. And we'll also see which was widely repeated by ICI and would be asked by the ICI, which were really important, like the crypto, etc., and some Binami transactions, which were very significant in with regards to some serious issues, significant matters. And now we'll see Schedule 3. With regards to the rounding of provisions, even it has been discussed in the monetary limits PDF, right? Monetary limits PDF, where the total income, the gross income, less than 100 CR. It could be even for the nearest hundreds, thousands, and millions. If it is more than 100 CR or 100 CR to the lakhs. Okay, whenever it touches 100 CR, it has to come into the lakhs. Okay, and with regards to that, and it has to be uniformly applied to that. And for your remembrance or memorization, we have just highlighted the headings of that. And you have to see the balance sheet pro forma also, what all the things headings were there, like for equity and liabilities, shareholders funds, you have something like share capital, reserves and surplus money against warrants, etc. You see, you need not by heart these things, but you have to know these things in such a way that whenever you find something like, okay, when there was a reserves and surplus, under what heading it should come, under what layer also. It is first layer is equities and liabilities, under that first one shareholders, in that we have one reserves and surplus, etc. You need not remember these all things also, it could be shifted by. And some you have to remember in it's such portion, okay, that you have to put any individual points in what layer it has to come in the current liabilities, etc. All the short-term provisions and all, you have to remember like that. You have to just go through it 2 days once, early morning, etc., and that's it, you're good to go. And try to practice that with practice only, with iterations and all, you could easily acquire the things which were something which was not logical. There was no logic with regards to remembering all these things under only these kind of, you see only for deferred tax. Is there any logic with regards to remembering C with regards to deferred tax and all? No, there was no logic with regards to that. So for all the illogical and dry items, we have to remember in such a way that if we see something like this, we have to get to know that it will come under some heading like that, etc. And that's it. And with regards to some general instruction which is widely repeated in the ICI exams and all, and I said it was, you see, when you remember this just one point, it was repeated 4 times in the same PDF, and we'll just go through that.
asset which is classified as a current. What do we think? When it is realized in normal operating cycle and it was primarily for training and expected to be realized within 12 months, and that's it. And this D point always differs. You need not remember that, obviously. Okay, if you have some extra time to remember, you could just go through like this. Okay, it was all highlighted and it would be shared in your Telegram channel. In our Telegram channel, you could go download there and just revise it in the day before the examination. Okay, and obviously we'll be doing that in our frantic hour revision after you have completed your SFM or 7 p.m. After you have given your SFM, by that 7 p.m. you'll be all reaching your homes and right, you have got freshed up and all. Just come and open the channel and just listen what all the frantic topics that were frantic revision, where all the important topics that were repeated in the ICIs, MTPs, and RTPs, all the category problems and all the tricky points in the MCQs and RTPs, etc. We'll be discussing there for just like a last revision. Okay. And with regards to the operating cycle, if the operating cycle was not there, we have to assume at 12 months. And if this liability, all the same things have obviously repeated. Expected to be settled in normal operating cycle, primarily for purpose of trading and settled within 12 months. And receivable, if it's a trade receivable, it should be normal course of business. Payable, normal course of business, trade payables. And these all the 5 points you could write whenever they ask for general instruction for preparing balance sheet, even in AS and Ind AS also. Okay, and Ind AS will discuss it further. And with regards to the share capital, you have to give the authorized and subscribed and fully paid up share capital and per value share, and any rights, preferences, restrictions, etc. And that's it with regards to that. And another point is that each shareholder name, when they hold more than 5% of shares, and any kinds of options or contracts or commitment, we know that like few or transactions with regards to even in 115 Index 115, and with regards to the options that will be given for as an employee benefits and all those have to be also given. And with regards to the calls unpaid and forfeited shares, whenever you just skim up all the points that were given in FR, right? These are all the things which we have got touched in our FRs, right? If a few points here and there and there, so it would be very easy. You need not by heart that thing. Regards to the next point is, yeah, trade payables. With regards to trade payables, MSMEs were an important point. The principal amount and interest paid for the buyer with regards to that each accounting period, and the interest with regards to the delay in payment which was unpaid, and the pro forma. This you have to also remember this pro forma less than 1 year, 1, 2, 3, and total. Once you remember this, it gets repeated 4 times again, like the asset things, right, which will get repeated. We'll just see that. And you also have to remember these 5 points here. MSME are those, disputed dues and disputed dues are those also. Okay. And later on we have PPE. It was asked in the MTP or RTP. I didn't remember that. It had been asked, and I have to remember all these things. Lands, buildings, and all, which was under lease and reconciliation, and in any change with this more than 10% or equal to 10%, any reduction of capital or valuation of assets, like, and same with regards to the intangible assets. You have to remember these, and the same points gets repeated here also. And with regards to the trade receivables schedule, only remember for everything it's 1 year, even for the MSMEs and for the further things that we see here, all the trade for this trade payables, it is 1 year, right? And now you see, if you see here, if for the trade receivables, it's less than 6 months. Okay, less than 6 months, and you have to segregate into a different kind of categories, like which were doubtful and which were considered good, etc. This table also have to be remembered, which would be also repeated later. This is under the heading other non-current assets, and we'll be also having trade receivables under current assets. Both has the same type, same format, like less than 6 months, 6 months to 1 year, and all. Even for under other non-current assets, there was also trade receivables, which also have this format. The same format repeats for both non-current assets and trade receivables under the heading current assets. Okay, and with regards to cash and cash equivalents was also an important thing that was asked by the ICI. And with regards to the contingent liabilities and commitments, we also have to know, everybody has to know, without knowing this contingent liabilities, like claims against which are not acknowledged as debts and guarantees and which were contingently liable, amount estimated from contracts and uncalled liability and other commitments. It was repeated even in kinds of banks also, right? You have to remember what are contingent liability. It's a must thing. You have to, if you haven't remembered till now, or if you have skipped it or overlooked that, do remember that, make an effort for that. And with regards to the title deeds of a mobile property, how this could be asked is that there's a case scenario in the ICA module, I guess, with regards to the property. They have bought some building or plot somewhere other else, but that was not registered in the name of the company, but used the funds of the company, and it was registered on the name of some director or somebody else. So we have to ask why, when the funds of the company were used, why not the title was not on the company's name. They have to give reasons for that, and on whom's name the title was made, etc., and all the things, the details have to be given here. With regards to that, you have to also remember the table with regards to this. And the shareholders or loans and advances that were given to promoters, directors, key managed person, and other related parties have to be also given in this format. And with regards to intangible assets under development, anything with regards to that, and with regards to benign party transactions, you have to give the property there. There's a slight difference between this benign property held, and with regards to this here, there could be a cash over there. So just decide in which situation whether it could be this or it could be under this benign property held. Okay, and with regards to the willful or defaulter and relation with struck of companies, and with regards to the layers of companies that have to be maintained, and with regards to the ratios and all, you just go through it once, and that's it. It would be fine. And with regards to P&L account, there's nothing much more. Only disclosures that were most concentrated on balance sheet. And with regards to forex transactions, you have to remember this, and you have to remember an extra point that it would ask what you have to give in your P&L statement is only the net of foreign fluctuations and all, not a gross thing. And with regards to CSR and details of cryptocurrency or virtual currency and all, profit or loss with regards to cryptocurrency and the amount of currency that was held as on the reporting date. And with regards to that and CFS, you have to need not remember that. Just remember the format that was asked. Anyways, your pros in doing the CFS from your FR, right? And with regards to India also, I haven't highlighted anything because it was already repeated in the above the same thing. And remember the same thing, same round offs, etc. Same, everything was the same. And remember the balance sheet format here with regards to India's, and all this again repetition, um, again repetition here, and trade receivables also as a repetition here. Other financial assets, that is, it consists of security deposits, bank deposits which are more than 12 months maturity, and others. See, where was there? It was here. Where? In Proforma also, we don't find that. It is the fourth option, that is the other financial assets. Not, it doesn't comes under investments, trade receivables or loans, but a fourth point, other financial assets. If you want a clarification, I'll just give you here. Yes, under financial liabilities, they have all the things, and at last they had other financial liabilities like that only. Even in the financial assets, they should contain a or like a sub point that other financial assets. In that point, we have three things. What are those? Security deposits, bank deposits which are having more than 12 months, and others. Okay, and you have to specify that. That's a point there. And with regards to again trade receivable schedule under current assets, and with regards to the shareholding pattern of the promoters, and current maturities of long-term warrants shall be disclosed separately. It's an important point for the MCQ, just to highlight for that. And trade payables aging schedule, it's again or less than 1 year, etc. You have to remember whether it's 1 year or 6 months, depending upon the aging schedule. Just make a note out of it, okay? And again, contingent liabilities, they were repeated again, and title deeds repeated here. And with regards to intangibles under development, Binami property, repetition, willful defaulter, stuck of companies, and ratios. And with regards to utilization of borrowed funds and share premium, it would be more more important whenever they were asked about the disclosures in Schedule 3. You also have to mention the CARO disclosures also. So that's why, or just a point to remember for that. And with regards to that, if at all they ask in the CARO with regards to the utilization of funds raised, etc., you could also mention under Schedule 3 if at all they ask, or if at all it contains 5 marks, etc. And with regards to profit and loss account under Ind AS, all the revenue of operations, it should include the sales of product, include excise duty. That is one point to remember, and you have to remember the items that have to be presented in the OCI. And with regards to additional information, the employee benefit expenses should be shown separately with regards to these. What like MCQ has also been given, right? A few points were whether they have to be included in staff welfare expenses or not. That is non-training expenses, right? Or when it's expenses were non-training, you need not put it under employee benefits as they were not related to training expense. Okay, and that expenditure and a separate item has to be given if that is exceeds 10 lakh rupees or exceeds 1% of revenue from those operations, they considered as material. That's a disclosure with regards to that. And CSR repeated, crypto repeated, and regulatory deferral account balances also a note to mention, especially for this Ind AS P&L account. And that's it. And with regards to CFS and all the subsidiaries, all the joint ventures which have been consolidated, and reason for such non-consolidating. That's all with regards to Schedule 3. And with that said, first we'll see the fundamental principles of the Code of Ethics of ICAI, that is integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. You have to remember all these 5 points. That is, see this, there is no professional skepticism here. It was mostly asked in the MCQ, very often asked. That is, it is professional competence and due care, but not professional behavior. What are fundamental principles of Code of Ethics as per ICAI is integrity, objectivity, and professional competence and due care, confidentiality, and professional behavior, not professional skepticism. And with that said, but nevertheless, the auditor has to maintain professional skepticism throughout the audit. And with that said, these are few regulations before shifting into the clauses and schedules. Okay. First, the member in practice, the member of the institute is now permitted to use the word CA. That is, if you are a member of Chartered Accountants ICAI Council, you could use the word CA. But there were few cases where if you are in practice, you could use CA, that's fine, but you cannot use any description like specialization in GST, or you have got AIR, All India rank and all. You have to not use all that kind of things when you are in practice. But if you're not in practice, that you're a member and you have been to industry or doing a job, etc., then you can use the word prefix as CA. If you are using that CA, you have to not use any kind of description. But if you're not using CA, then you could use description if you are not in practice. This option is not available for members in practice. And with that said, we'll move on to the second topic, that is maintenance of branch offices. That is, as per section 27 of the CA Act, every person, every office need to have a member of institute as a separate in charge for that office. However, there were exemptions that were given if the members were practicing in hill areas. Those conditions were the temporary office in a city that is in plain, that is not under hilly region, for a limited period not exceeding 3 months in a year. That is, he could move to plain, that is less than 3 months, or at least 3, that is maximum 3 months he could be at plain. That is, maximum he has to be to practice in hill station. Then he need not
have a separate in charge for this temporary office that is here in the plains. The regular office that is which was in hilly region need not be closed during this period, and all correspondence can continue to be made in the regular office. The name board of the firm in temporary office should not be displayed. Temporary office is again at the plains, should not be displayed at the times other than the period of such office that is permitted, that is 3 months here. At that time the office has to be open. Only at that time the board has to be displayed. The temporary office should not be mentioned in the letterheads, visiting cards, or any other place of business of member of firm. Okay. And before commencement of every winter, it shall be obligatory on the member to inform the institute about opening of the temporary office. After the office is closed at the expiry of the period of permission, an intimation that effect should not also be sent to office by institute by a registered post. What does he say? At the time of opening, at the time of close, they have to intimate to the institute. You see, temporary office not exceeding 3 months. Temporary office at plains. Regular office that is at hilly region should need not be closed, and the name of the board in the plains that is temporary office should not be displayed other than those 3 months, and temporary office address should not be there at any letterheads, etc., and they have to intimate to the institute. And you see, after with regards to the branch offices and all, what happens if a chartered accountant has 2 offices? Okay, if there were 2 offices, the other person, other person who is in charge of the second office has to be a partner or a paid assistant. He has to be associated with the chartered accountant as a partner or a paid assistant. If he is a paid assistant, he has to be in whole-time employment, and that's one point. And with regards to some conditions or with regards to some council decisions, there were few points here. With regards to the use of name board, there is no bar in putting up the name board in place of residence of the member. Even at his home, he could put the firm board, and with exemption may be granted to a member or a firm in practice who have second office, without such second office being under a separate charge of the member. You see, there were 2 conditions that were here. You see, for a temporary office, there need not be a separate charge for second office. If at all there have to be a second office, it has to be under either partner or paid assistant. And the second exemption that the second office need not be at a separate charge is by satisfying all these 3 conditions. If a chartered accountant is practicing in hill area, he could go for this one, and if not, he has to check this for any other person. The second office is located in the same premises in which first office is located, or in same premises, or the second office is located in the same city, or the second office is located within 50 kilometers, same premises, same city, within 50 kilometers. If any of these conditions were by the chartered accountant was satisfied, he need not have a separate charge for that office by the another chartered accountant or a paid assistant. As the chartered accountant is maintaining 2 offices, if he satisfies any of these conditions, 3 conditions, then he have to declare one office as his main office for his professional business. And the CEO in practice also has to comply some KYC norms with regards to his clients. So he has to take these all documents in order to comply with the KYC norms, which are mandatory. They were mandatory in nature. So when a client is an individual or proprietor, what all he has to take? On category A, we have some general or generic information with regard to the client, that is name of the individual, any identification cards like PAN card or Aadhaar card, or business description, what his business into, and a copy of latest audited financial statements. And with regards to the engagement that he is going to perform for the client, that is individual or proprietor, the type of the engagement they were talking about, client was engaged into. And if the client is of a corporate entity, what's the generic information with regards to the entity? Name and address of the entity, business description, name of the parent company in case of a subsidiary. If this corporate entity is a subsidiary, then the name of that parent company and a copy of latest audited financial statement. You see, name, everything was right, but in place of PAN and other, we have asked for the parent company, like for anything, and remaining all were the same. And for the B category, that so B section, that is engagement information, the type of engagement information, and for the regulatory information which is not present in
individual proprietor, client, or you have to have company PAN, which we have missed, right? Company PAN, company identification number, that is SIN number, and directors' names and address, and directors' identification number, that is DIN number. SIN, DIN, and company PAN, and director's name and address. And if it's a corporate entity, if it's a non-corporate entity like a partnership firm or a trust, or the general information, he has to take name and address of the entity, copy of PAN, description. You see, PAN and PAN was compulsory for all clients. Business description, but only for the corporate client it was in C category, that's regulatory info. And partners' names and addresses along with their PAN and DIN if at all they have, and copy of latest audited financial statements. And if with regards to engagement information, the type of engagement. And now we'll go over discipline procedure mechanism under ICA. If any member of the ICA have against them have received any complaint or any information that they have done misconduct, then what a disciplinary director will do a prima facie analysis and form a prima facie opinion. Then if he finds that the member against whom the complaint was given it found not guilty on a prima facie opinion, then it submits all the information to the board of discipline. What the board of discipline do? It either accepts or rejects. If it's accept that the member is not guilty, then the matter was closed. And if it's rejected that the member is not guilty, that is, as per the opinion of board of discipline, the member is guilty, then what it will do? It will do three things. It will further advise the director of discipline to further investigate, or it may proceed if the member is guilty under first schedule, and it will forward if the member is misconduct or is guilty under second schedule to disciplinary committee. Board of discipline could do three things. Further investigate, it may proceed if the member is guilty under first schedule, or it may forward to the disciplinary committee if the member is guilty under second schedule. This is what with regards to on the prima facie opinion that the member is not guilty. If the DD, disciplinary directorate, thinks the member is guilty, if it's under first schedule, to whom he has to report? For the board of discipline, as it was all discussed or dealt with board of discipline with regards to the misconduct under first schedule. If it's guilty, if the member is guilty under second schedule, then he will forward to disciplinary committee. Okay, first we'll see if he is misconduct under, if he is guilty under first schedule. The matter is placed before board of directors, and board of director rejected that he is not guilty, then the matter is closed there. But even for the board of discipline accepted that the member is guilty under first schedule, then it would conduct an inquiry, and in that inquiry, if the member found guilty, then he will be primand the member. That is, they will primand the member means to remove from what all the position he was in. If he was auditor of some companies, he will be immediately they will remove them from that position and remove the name of the member from the register of members for up to period of 3 months and impose a fine up to 1 lakh. If it's all, if he is guilty under schedule 1, that is first schedule. If he is not guilty after the inquiry, then the matter was closed. If the member is as per a disciplinary director, he was guilty under second schedule, they will forward the matter to disciplinary committee. And after disciplinary committee examines that, if he rejects that, the member is not guilty, then the matter was closed there. If disciplinary committee also believes that the member is guilty under second schedule, then it will conduct an inquiry, and if they found yes, that is the member is guilty, then primand the member. Primand the member is to remove from the job whatever they were in. Remove the name from the member permanently. You see, here is up to 3 months on first schedule. This is they'll remove permanently or for any other duration. They have not given any maximum time limit for that, and impose a penalty up to 5 lakhs. If after the further inquiry, if the member was not found guilty on the second schedule, then the matter was closed. Okay, now we have left with 2 case scenarios where the members were found guilty under first schedule and second schedule, and any member or director discipline aggrieved by the order of the board or disciplinary committee, that is board of or disciplinary committee, that is the one who has been here, right? And who is director of discipline? We have seen him here, right? That is when the Board of Discipline thinks he was not guilty. That is, he was guilty. The member is guilty when disciplinary directory thinks they were not guilty. Then they can prefer an appeal within 90 days. What the appellate authority could do? It could either confirm, modify, or set aside the order that were given by the Board of Discipline or Disciplinary Committee, or impose, set aside, or reduce or enhance penalty. This is with regards to the penalty. First thing, with regards to the order, what all they could do? Confirm, modify, set aside the order. Second thing, impose, set aside, reduce, or enhance the penalty. Remit the case to Board of Discipline or Disciplinary Committee for reconsideration. They can refer them back and pass such order that authority thinks fit. And now we'll discuss the main portion of clauses here. And first clause, with regards to a member and chartered accountant in practice would be guilty if he allows any person to practice in his name as chartered accountant unless that person is a chartered accountant. That is, in order to practice in his name, he has to be compulsorily a chartered accountant, and he has to be either a partner or he has to be an employee of that firm, employee of him. And in clause 2, if he pays, he would be guilty under clause 2 if he pays or allows or agrees to pay or agrees to allow directly or indirectly any share, commission, brokerage. If he pays or allows to directly or indirectly any share or commission, brokerage in fees or as profits from the professional business, which is his main source of income, to any person other than member of the institute or any person other than any other professional body. That is, member of ICA allowed, member of any other professional body allowed, and partner allowed, retired partner also allowed, or legal representative of deceased partner is also allowed. 3 partners and 2 professional members were there, and they have to be allowed where they renders professional services inside or outside India, no problem. Treatment of goodwill in case of death of CAs in practice, if it's a partnership firm, if at all the partnership agreement contains any kind of provisions to share the profits to the legal representative of the deceased partner, they may continue to receive the share. And if the proprietary firm, no sharing of fees was allowed for the legal representative and the one who purchased that partnership firm. But however, the payments of that could be given in installments. And if the death is after 3899, 8, provided such sale is completed in all aspects within a year of such proprietary concern. That is, sale was completed within 1 year. The name would be kept in abeyance and not removed on receipt of the information about the death. And if there was a dispute with regards to the legal hire, and that dispute should be kept, that dispute should be intimated to the institute in order to not remove the name till 1 year. And this was not relevant for now. And if all partners in the partnership firm dies, then council will decide. And the member would be, the CA in practice would be guilty under clause 3, part 1, first schedule, if he accepts or agrees to accept any part of profits of the professional work who is not a member of the institute. That is, he is accepting. Here he was giving the share of profits, etc. Now here he is accepting the profits from the professional work of not member of the institute. And fourth clause is enters into partnership in or outside India with any person other than chartered accountant in practice, or a person or a member of any other professional body. You see, then he is guilty under clause 4 when he enters into partnership other than the member of the institute or any other professional body member. In clause 5, he will be guilty if he secures either through the services of any person who is not an employee or not a partner, or by means not open to chartered accountant, any professional business. That is, he's securing work through the services of a person who is not his employee and not his partner. In clause 6, solicits clients or professional work either indirectly or directly from a circular, advertisement, personal communication, interview, or by any other means. That is, he's trying to attract the clients or professional work through that. That's strictly prohibited under clause 6. But a chartered accountant may apply or request for inviting some professional work from another chartered accountant in practice, not through by means of circular, advertisement, personal communication, or interview. And a member from responding to tenders, he is allowed, provided minimum fees was there in the tender document itself. And he'll be guilty under clause 7 if he advertises his professional attainments, even his degree other than chartered accountant, unless it is a university degree, on professional documents, visiting cards, letterhead, signboards. These were all negative list. So here he cannot advertise his professional attainments unless he could advertise through a write-up or setting out service provided by him or particulars of the firm, etc. in a guideline. And in clause 8, he would be guilty if he accepts a position as an auditor without previously communicating to the previous auditor. And clause 9, he would be guilty if he accepts the appointment without ascertaining or without complying with the requirements of section 225 of Companies Act 1956, or that is what the eligibility criteria, right? 139 appointment of director, 140 and 141, all the ethical requirements and all. And he would be guilty if he charge percentage based profits. That is in clause 10, he would be guilty if he charges the fees as per percentage of profits. But there was some general exemption that were given with regards to the fees. If the member is acting as a liquidator, then he could charge a percentage of fees on the realization of the assets. If he is auditor of cooperative society, he may charge the fees based on a percentage of paid up share capital and working capital. Remember this was asked in the MCQ, and this could be asked in various MCQs, right? But mostly this was asked. In case of a valuer, they may charge based on a percentage of value property of the valued. And the case of management consultancy services, they may take percentage on contingent upon the findings of such work. If he is doing any kind of fundraising activities, a percentage on fundraised. If he is doing debt recovery services, percentage of the debt recovered. And he is giving services of cost optimization, percentage on the benefit derived. Any other services decided by the council. These were the restrictions that they were exempted, where he could charge his fees based upon the percentage of the work that he is doing. And he would be guilty under clause 11 if he engaged in any business. But exception was he could be a director unless he is an auditor. Director is a positive list, but any business or occupation is a negative list unless they were permitted by the council. And clause 12, he would be guilty under clause 12, part 1, first schedule, if he allows any person not being a member of the institute to practice as a member, not being his partner, to sign on his behalf of the firm any balance sheet or profit and loss account, etc. We have completed our first schedule, part 1 and all clauses. We'll move on to part 2, where the professional misconduct when members were in service. These all part 1 is for the chartered accountants in practice. Now they were in service. First, they will be guilty under clause 1, part 2 of first schedule if they pay or allows or agrees to pay directly or indirectly any person any shares of emoluments like any incentives or cash payments of the employment undertaken by him. That is a part of his salary if he is paying. And second clause was if he accepts or agrees to accept any part of fees or profits or gains from a lawyer or a chartered accountant or a broker engaged in such company, firm, person or agent or customer of company, firm, that is the lawyer, CEO or broker of the company that he's working in, he should not accept any kind of profits or any kind of shares or fees. And as per clause 1, he should not pay also. And now we'll move on with part 3 of first schedule. Under that, clause 1. Part 3 talks about the professional misconduct in relation to members in generally, that is both the one who were in practice and the one who were in service were also included here. Under clause 1, part 3, first schedule, not being a fellow of institute, acting as a fellow of institute. That is not being a member, he's acting as a member. And under clause 2, he'll be guilty if he do not supply any information that was called by all the parties that we have seen in the disciplinary system mechanism, right? The board of discipline, disciplinary committee, director discipline, etc. And under clause 3, he would be guilty if he gives false information while inviting professional work in which he was allowed. That is while what we have discussed here, right? Through write-up and setting up of services or with guidelines and all, he could advertise his professional attainments and all, right? In that, if he gives any false information, he would be guilty under clause 3, part 3 of first schedule. Under part 4, there was other misconduct. This is with regards to the professional misconduct, and this is with regards to other misconduct. If he had been, he would be guilty. If he had also been offended as for punishment for imprisonment for a term not exceeding 6 months, that is till 6 months, it comes under first schedule. After first schedule, that is after 6 months, it comes under second schedule. And in clause 2 of part 4 first schedule, in the opinion of the council, it brings disrepute to the profession, that he has done some act that which brings disrepute to the profession, is he would be guilty under clause 2 part 4 of first schedule. This is with regards to the first schedule. Now we'll see second schedule part 1, that is clause 1, when he discloses any kind of information that he had attained through his professional engagement, that he would be guilty if he discloses that. And under clause 2, he would be guilty if he certifies or submits his name or firm name on report of examination of financial statement, unless that were done by him himself or partner or employee. That is, he should not certify or include his name or firm name unless he do the examination of the financial statements. And third thing is giving his name on the estimations of earnings, like financial projections, etc. He should not use his name. And with regards to 4, when he expresses his opinion on a firm or any kind of business in which he is substantially interested in, he should not do that. So, or when he fails to disclose a material fact which is not disclosed in the financial statement, clause 5, and 6, when he fails to report a material misstatement, and clause 7, he do not exercise any due diligence or grossly negligent with conduct of his professional duties. Under clause 8, he would be guilty if he fails to obtain sufficient information with regards to the expression of an opinion. So these all are the basic duties of the auditor. If he do not comply with them, he would be guilty under second schedule. When he fails to invite attention to any material departure from generally accepted procedure of audit that is applicable to the circumstances. And you see, the auditor has to do audit as per standards of auditing. But when he got some circumstances that he has to deviate from the standards of auditing, he has to give the information. He has to draw an attention to that. If he fails to do that, he would be guilty under clause 9. And if he fails to keep monies of his client other than fees or remuneration, that is like tax amount, if anybody pays GST amount and all, auditor would pay them for all the OTP purposes and all. If he expends that and he do not put it in a separate bank account, he would be guilty under clause 10, part 1 of second schedule. And now we'll see part 2 of second schedule. This is general professional misconduct in general, where chartered accountants in service as well as in practice do. When they contravene the provisions of this Chartered Accountants Act, they were guilty under clause 1, part 2, second schedule. And clause 2 is, if being an employee, discloses confidential information that he got through his course of his employment. And clause 3 is, includes any information that is false with regards to all the parties in the disciplinary provision. You see, here if you don't provide information to them, it is in first schedule. If you provide false information, it is in second schedule. Okay, please make a note out of it. And clause 4, defalcates or embezzles money received in professional capacity. And there was also part 3 with regards to that. He would be guilty with any kind of civil or criminal court offense which is punishable with imprisonment of a term exceeding 6 months. That is part 3 of clause 1. Only one clause is there in that part 3. And thus we have completed our professional ethics summary. And now we'll do some important questions and apply these concepts. And do check out the PDF that was given in the Telegram channel, where we have included few kinds of regulations from which general permissions have to be given, which need not be remembered well. So we have not discussed that in detail, but it has to be useful. It would be very useful in writing answers and answering the questions that what we have seen with regards to that, and how the network could be formed with regards to the chartered accountants firm. And since auditor could use write-up for advertising, how could he use that write-up, and what all the recent questions in ethical standards board which might be asked. All the important portion will have been already discussed. This is for the students who don't want to take a chance or who are preparing for the rank exemption. And that's it. Do check out the channel and read this. And now we'll just quickly wrap up or find a way to remember the clauses there, as we have read a lot of clauses. And as part 1 of first schedule and part 2 for second schedule, and since these were 10 and 12,
We just prepared only for this because in examination we often write it in a rough note like this in order to not write wrong answer, wrong clause number and all, because writing correct clause number is very efficient even to gain marks. If the clause number itself is wrong, they would bluntly wrong the answer. For that, for the first one, part 1 of first schedule, we'll see part 1 of first schedule, name. This is, and name is the one here, and 2, commission is the way you get this commission, and 3, the R like this here goes with the profits here. This is to remember, this is to train your mind to write it, or if you write it in your like in rough notes in the examination, it is to train your mind to write the correct keyword against the correct number. Obviously we remember numbers. And for the 4 here, it is like partnership. Most of us who was cursive writing write F like this, right? For that we have turned it into P, like partnership for this. And this 5 is like more secure business. 6 is soliciting of clients, and 7, the dash here goes with the A for dash advertisement is professional attainments. 8 for acceptance of without information, that is without giving intimation to the previous auditor. 9 for not checking the compliance of the act and all. 10 is taking percentage of profit. 11 is for the business, and 12 is for sign, that is sign here, that is even with cursive writing. This is to train your mind while writing the rough notes and on the bit of a last page of your answer sheet, so that you don't miss out the keyword. And for the disclosures here, the part 1 second schedule, for the disclosure clause 1, disclosures L big 1 here, and for the 2, where the auditor gives his opinion for not examining a financial statement, this was like this, for no examination. And the future here, for this is for the projections, financial projections for the future, and the express here, expressing opinion on which he was substantially interested in. For the 4th clause, a bit angle difference, expressing opinion. Disclosures for the 5 and 6 for the report. And 7 is prohibiting due diligence or maintaining a gross negligence. And 8 for sufficient appropriate audit evidence. And 9 is for attention. And 10 is for the money. And this is what with regards to some tips to remember while you're writing the rough notes in your exam. To remember the keywords for the clauses of part 1 of both schedules. And with keeping these in mind, try to write it 2 to 3 times. It is not something you read. You have to train your mind to write this against the correct keywords. And with that said, we'll just move on discussing the important questions that were asked in MTPs, RTPs, and few past examinations. And with that said, we'll be completing all our 3 stages, and you have to do the compiler portion, just 30 minutes. It would be enough, more than enough. Now first we'll see one question here which was asked in mock test paper that was recently released. Okay, and CA Vasu, a newly qualified professional with certificate of practice, approached CA Anant, the auditor of the father's company, and allowed this Anant allowed Vasu to have some professional or practical knowledge, and he allowed him to sit in his office, that is Anand's office, and allotted a small shampoo. What do Anand do? Anand do some tax consultancy work, and he also allowed Vasu to file few IT returns and represent himself before various tax authorities on behalf of the firm. That is, Vasu is representing himself before tax authorities on behalf of firm, even though he did not have any kind of employment, or neither he was a partner nor he was an employee of the firm. He did not get any salary. He's not an employee or share of profit or commission, that is, he's not a partner. And he agreed only to pay usual expenses like conveyance. And after the end of the period, he was given a lump sum amount of 2 lakhs by CA Anand for out of gratitude. Okay, give your comments with reference to CA Act. Okay, you see CA Anand, what he had done, he had allowed CA Vasu to provide what, like some representation services and filing IT returns and all, and use his name on behalf of his firm, that is, use the name of the firm and himself, who is not a partner, not an employee of him. But under which clause he would be guilty? He would be guilty under clause 1, part 1 of first schedule, that is, allowing his name to be used by a chartered accountant who is not a partner or an employee. So we'll see how it is written. First, they have given the
clause name, and then they have written the provision with regards to that the chartered accountant in the practice shall be deemed to be guilty of professional misconduct if he allows. This is from where the colorful para starts there. If he allows any person to practice in his name as a chartered accountant, unless that person is also a chartered accountant in practice or in partnership with him or employed by him. And this is till here they have written the provision or introduction provision for that. For this mark, you'll get 1 mark for the writing correct clause, and you'll get a entry ticket for the examiner to read the remaining portion. If you write this clause part only wrong, the examiner will not check the whole part, whole answer, even you have written the same correct. And for the provision, you'll get 1 mark. This is for 5 marks. Okay, and the above clause is intended to safeguard the public against unqualified accounting practicing under the cover of qualified accountants. This is the reason that they have given the intention of the provision. Okay, if you know, you could write, or you may adopt from it here. There's no importance with regards to that. It ensures that the work of the accountant will be carried out by chartered accountant who may be his partner or his employee and would work under his control and supervision. In this instance, this is all with regards to the understanding, how you have understood the provision. This is the clause, and till here the provision, and this is how you to interpret the provision, how you have interpreted. This portion you could write it your own. You need not by heart this portion. Okay, or you may adopt it from here in the instant case. That is, after the clause introduction and your interpretation of the provision, you have to write the present case. You have to jump into the scenario here. CA Anand allowed Vasu to sit in his office. This is what the question talks about. And he also allowed to appear before various clients on behalf of the firm. This is need not to write it from your own head. You could write it from the question itself. CA Vasu was reimbursed his full expenditure and given a lump sum of 2 lakhs for his gratitude. And for this, you will get 1 more mark. For what you have written from seeing the question itself, you will get 1 mark. Thus, in the present case, this is the conclusion. CA Anand will be guilty of professional misconduct. You have to write whether he's guilty or not. And as he allowed, you have to write reason for the conclusion there. And for the chartered accountant and Vasu is neither in partnership nor in employment. This is how to you segregate. This 5 marks is divided into 1 mark for the clause and 1 mark for the provision and 1 mark for interpretation of how you have understood the provision. This one you could write it your own, and 1 mark for the question, bringing the examiner into the scenario here. That is the situation, and giving a conclusion, another more mark. Total 5 marks. You could bag it in your pocket. And now we'll move on with the next question here. Vishal, a practicing chartered accountant, issued a certificate of circulation of a periodical without going through into most elementary details, okay, of how circulation of periodical was being maintained. That is by not looking into financial records, bank statements, passbooks, not examining evidence of actual payment of bills, and not caring to ascertain how many copies were sold and paid for. After you read this, how many clauses have come into your mind? There were mostly 3 clauses that should have come into your mind. First thing, with regards to no examination, as they have used no examination of no examining evidence of actual payments, right? So second clause, part 1, second schedule should have come into your mind, and grossly negligent has to also come into your mind, because they have given a list that he did not do, he did not do. And third one is the sufficient appropriate audit of that he did not taken sufficient information to express an opinion. So how do you select 1 clause out of 3 that have come to your mind? First thing, first priority. What they have asked for, they have said that without going into most elementary details. Details means information. That is sufficient information. That is clause 8, part 1, second schedule. We'll see the answer here. Clause 8, part 1, second schedule. What all the extra information that have given were just supporting the without going into most elementary details portion only. The main hero here for the question is without going into most elementary details. Like the same thing, we have another question with regards to clause 7 of part 1, second schedule, that is gross negligence, etc. Right? We'll read the question and determine how this clause 7 has to be determined. Mr. Nemi, a chartered accountant in practice, is the auditor of Sum Limited. He advised the managing director of the company to include orders under negotiation in sales
to reflect higher profit. You see, he is only advising for higher profit orders under negotiation where the sale agreement was not put in place. Sale agreement was not at all entered, and better financial position. That is his window dressing. Mr. Nemi thereafter gave clean reports on the balance sheet prepared accordingly without informing the without examining the accounts. Even for here, we have 2 to 3 clauses that comes to in our mind. Here, without examining, clause 2, part 1, second schedule, not examining. And there was like gross negligence also, 7th one. And 8 is with regards to sufficient appropriate information, and 4 with regards to expression of opinion. A lot of clauses come into our mind. But how do we decide that is these clause 7 part 1 second schedule? We have to again go with the first thing, first priority. That is he advised. That is he only had intention. He only had intention to window dress the balance sheet. That is what gross negligence or without due diligence, acting without due diligence. That is what. That is why they have more weight have come to clause 7 part 1 second schedule. Not to second clause 2 part 1 of second schedule, that is not examination of financial statements and all. Okay. So what all the question that they are talking about, first we have to bifurcate the main hero of the film, the keyword of the question, to all the extra information, all the extra adjectives that describe this hero element. Here also what they have said. They have first said that he advised. What the act he had done first, he had advised. And later on what he advised, they have described the things. We have to know, while deciding the clause, we have to not go in detail for the description portion and all. We have to first catch the clause at the first act that the auditor is doing. And for this second question, we have decided this is how you have to decide the clause. And failure to obtain information, that is he had without going to the most elementary details, that the basic details also. So as per, he would be guilty under clause 8 part 1 second schedule, and this is for this 1 mark. And we have to write the provision that the accountant on practice fails to obtain sufficient information to warrant the expression. And this is what with regards to the provision, that is second mark. You'll get 2 marks here if you write these two. If you write this clause itself wrong, you will be end up with 0 marks in the instant case. You see, here what they have done, since it is have given for 5 marks, they have interpreted the provision on the intention of the provision. Since it is for only 4 marks, you need not interpret the provision. You could directly write the question itself in the answer. That is, you have to bring all the information that was given in the question. For that, you will get 1 mark. And for the conclusion, the chartered accountant should not express his opinion before obtaining data. So he would be guilty. He would be held guilty under clause 8 part 1. For this, you will get 1 more mark, total 4 marks. 1 mark for identification, 2nd mark for the provision, 3rd mark for the question that was given while bringing down putting the situation into the answer. And 4th mark for the conclusion. This is how you will be attain marks. And if it's for a 5 mark, what you have to do in extra is, after writing provision, you have to interpret the provision, intention of the provision. And as we have already discussed this NEMI portion, we'll just complete that one first. Mr. NEMI, the chartered accountant, advised to increase the profit while in window dressing, while making the orders under negotiation also as sales. Now, this is what gross negligence is. Clause 7, part 1, second schedule to the Chartered Accountants Act, 1 mark. And that's how the chartered accountant practice should be guilty of professional misconduct if he do not exercise due diligence or he is grossly negligent while conducting his professional duties. This is what the provision is. And with also that clause 2, part 4 of first schedule to the said act shall be the member of the institute which in practice shall be deemed to be guilty of such other misconduct. What is that clause 2 part 4 of first schedule is giving this that is disrepute to the profession. That is, he's bringing disrepute to the profession. You see, auditor is the one who has to find the fraud in the financial statement. But what this NEMI is doing, he's encouraging the directors or encouraging the entity to do fraud, to do window dressing.
This is what disreputing, this is what bringing disreputation to the profession. And so the two clauses were there here, and whether or not related to the professional. Okay, in this case, see, this is for the first clause, 1 mark, identification and writing provisions, another mark, and then the clause 2, part 4, first schedule, this is also identification of another clause. We'll discuss in detail way before the examination what what clauses need to be accompanied with what, like what are the supporting clauses and all, like something that would support each other. We'll just discuss it later in another video. And I'm writing about the question here with what all the things that the NEMI asked the management to do, and we have to write a conclusion that he was guilty of the professional misconduct, 4 to 5 marks. That's it. You see, these all the questions that we are discussing right now here were from the latest RTPs and FTPs for May 2023. So this was so important. If you read these, if you know how to, if you understand how to write the questions answers for this, it would be very easy for you. You see, professional ethics was a very limited kind of chapter where you need not learn a lot of things. The chapter is also very simple. You need not learn a vast amount of data like for the banks, and you need not have various mnemonics that were held in a like automated environment. But if you write it simply, these are like this, the structure of the answer is also very simple. If you write this, you could bag 4 to 5 marks for which the question. And now we'll see an interesting question which we often do not put so much of attention while reading to professional ethics chapter. This was even asked in MTP here. You see, all the questions that were asked were in MTP, RTP. Mr. Seetal is a practicing chartered accountant, okay? Due to natural calamities and misfortune, he almost lost all his wealth and became undischarged insolvent. After few court hearings, he finally declared as a discharged insolvent and obtained a certificate from the court that stating that his insolvency was caused by misfortune without misconduct on his part. See, the certificate stating that he is insolvent, yes, but his insolvency is caused due to misfortune and not misconduct on his part. You are required to comment on the above situation with reference to the CA Act and schedules thereupon, referring to Section 8. We see what Section 8 talks about. Section 8 talks about that when a chartered accountant or who is a member and whose name was there in the members register has been declared by a court as a discharged insolvent, the name has to be debarred from the list of the, it has to be removed from the register of members unless that this insolvent was due to his misfortune, not by his misconduct. If it's that, if he got a certificate with that, then the name will not be removed from the register of members. This is what we are writing here. Section 8 of CA Act enumerates that. See, they are writing about, till here they are writing the provision. They have identified the section and they're writing the provision here. Actually, they have not identified. It was given already in the question. Enumerates that the circumstances which a person is debarred from having his name, that is, entered into the register of members, if he is a discharged insolvent and not obtained from a court the certificate of stating his insolvency was caused by misfortune, not misconduct. When the name will be removed, when he do not obtain a certificate from court stating that the insolvency was caused due to misfortune, not his misconduct. Since he bought certificate that, so he's not liable to get his, he's not debarred to remove the name from the register of members. So we are writing that only here. And after the provision, what you have to write what they have given in the question itself for that extra 1 mark, and write the question there and write the conclusion there. Mr. Seetal is not violated the provisions of Section 8 and he's not debarred from having his name entered into register of members as he had obtained certificate from court stating that insolvency is caused due misfortune, not misconduct on his part. Now we'll move on to the next question. Mr. Nageshwar, a CA in practice, was elected as a treasurer in RC of ICI. Okay. The RC had organized a tour for its members. During the audit of RC, it was found that the treasurer, Mr. Nageshwar, had received a personal benefit of 40,000 from tour operator. Okay. What are all the clauses that will come to your mind? Since this is with regards to the money, you will get clause 10, part 1 of second schedule, this money. But make sure this clause would be only active when the auditor for the auditor in practice. Here, though he was in practice, but he is acting as a treasurer. He was a treasurer now. He's not an auditor in practice. This is not with regards to the entity or the client. This is with the tour operator and the treasurer. Okay. So that clause was not stands good here. And the what that comes to your mind, thus bringing disreputation to the profession. Okay. First schedule or second schedule? You see, this comes under the other misconduct. There was no professional duties that were being carried here. What is a professional duty and other duty was? Professional duty, he was doing like audit, giving certificates and all, attestation engagements, etc. These were the professional responsibilities. But being treasurer is not the professional responsibility. This is actually a service that could be done by many of trust and etc. And this is also mostly we don't find it often in when we revise the professional standard. The section 8 that we have revised before and section 21 here is provides a member liable for disciplinary action under misconduct. They have given both part 4 of first schedule and part 3 of second schedule other misconduct. And you see part 3 of second schedule why they have given is for not compliance with the Chartered Accountants Act, and why they have given part 4 of first schedule is bringing disreputation to the profession. That's why they have given here, and you have to write the provisions if you asked for more marks. And the council had also laid down some things, and misappropriation of office bearers and RC was a misconduct. They have referred to some provision here. In the instant case, again writing the question here and writing a conclusion. That's it. And now we'll move on with the next question. Mr. Bahubali, CA in practice, wrote 2 letters to 1S firm of chartered accountant requesting him to allot some professional work, and another letter to PQ, a firm of chartered accountants, for securing professional work. Could he do that soon? Yes, he could do that. He could secure or by writing a letter or by communicating from another chartered accountant. That is allowed, but not through any kind of circulars, etc. was not allowed. So is he guilty here? No, he's not. This is actually a straight cut question. Clause 6, part 1, first schedule, and you have to write the provision there. And since it's asked for 2 marks, you have to need not elaborate the provision and write what was asked here and write a conclusion that he's not guilty of any professional misconduct by soliciting the professional work from another chartered accountant. And now we'll see our last question with regards to this. Mr. S is a practicing chartered accountant, and during weekends he do himself some equity research and advise his friends other than his clients. That is, he do not charge any kind of money, etc. And apart from this, what he's doing, first he's doing equity research. Second thing, he is also a paper setter for accountancy subject in his school, which he studied. Okay, and he also owned an agricultural land, doing agricultural during his free time. Okay, multiple of income, multiple streams of income here. 3 streams of income. He is an equity researcher, paper setter, and an agriculturalist. And due to his natural calamities and misfortune, there were heavy losses in agricultural activity and lost almost all his wealth. And after court stating that his insolvency was caused due to misfortune without any misconduct on his part, this portion is something we have already seen, right, in one question. Okay. They're asking about his guilty of misconduct. First thing, what is doing? He involved in 3 activities. He's an equity research advisor. Second thing, paper setter and agriculturalist. First thing, with regards to equity researcher, he could be an equity researcher as per CA Act, but he cannot publish a retail report with regards to that. Okay, so he's not guilty of any professional misconduct. So with that one, we are set. And for the second one, being a paper setter and agriculturalist, he is involved in business or profession. Well, he should not involved in business or profession other than the council permits to do. Whether those 2 things were permitted by ICA or not, we have to check in regulation 190A. Yes, they were allowed. What are those? Owning an agricultural land and valuation of paper setter, these were allowed in as per regulation 190A. And so he's not guilty of any professional misconduct. And the third thing is he was insolvent. He was discharged as insolvent. We have already seen that since he obtains a certificate from court that he's not he's insolvent, not due to misconduct but through misfortune, then he is not debarred from register of members, to remove the name from the register of members, so he is not debarred from section 8 as well.